Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power.
This is Bloomberg.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
It is our sense that something fundamental is going on.
We think it is a buying opportunity for the market.
People are making more money. They're feeling very depressed about inflation, but they're still spending.
There's a lot of issues right now that are somewhat inflationary.
Volatility is going to persist until we have a clear inflection in the direction of the real economy.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
This really may be the most important week of the year. Good morning, welcome back. This is Bloomberg Surveillance. Tom Keene, Jonathan Farrow, Lisa Abramowitz, Tom and John still on their cruise. They are enjoying the twirly slide. They're going to stay for another day. I bribed some of our favorites to come back and be alongside us, Damian Sassower and Gina Martin-Adams. We are so lucky to have you share your insights on a day of incredible import, heading into a week of incredible import. I want to start, Gina, just by what we're expecting to be the most important on a week where we get Apple earnings, we get the Treasury refinancing agreement, and we get central banks galore.
Well, you name it. There's just too many things to cover. But I do think Apple earnings are probably the most important thing to watch within the S&P 500 for the extent to which tech stocks can specifically continue to carry the index. We have seen earnings generally beat expectations, but some uncertainty around the outlook with respect to the dollar, with respect to what's happening at the 10-year seems to be really weighing on stocks. So Apple could still help to sort of keep some stability in stocks.
Damian, I imagine that you're watching things outside of Apple.
Do you think that the quarterly refunding announcement can actually be more important than the Fed?
That's what everybody's saying.
I think so, yeah. I mean, absolutely, right? But I mean, for me, I'm an emerging markets guy, so I'm looking at central bank activity in places like Brazil, Czech, Malaysia, you name it, and it's important stuff because we're going to see how they respond to some of the recent weakness in their economies. Are they going to continue to try and cut rates in the face of their currencies coming under pressure via King Dollar? I'm not so sure they can.
I'm glad that you mentioned this because it's not just the big majors that we're going to get central bank decisions from. It's all around the world coming out to give a sense of the state of play of where we are. And it's coming at a time of incredible uncertainty. And we saw this expansion of the ground operation in Israel heading into Gaza. Why do you think, Damian, the markets are so sanguine about it?
Well, you're right. I mean, oil and gold are coming off here. That haven bid's kind of declining. And I think it does have to do with the uncertainty over the central banks this week, right? I mean, the focus does shift to the Fed. It does shift to fixed income, in my opinion. We have Apple earnings, but, you know, we're pretty much through a lot of the earnings cycle here. And I think now that we've seen the NASDAQ and the S&P kind of crash through their 200-day moving averages, or at least kind of come below it, I don't know if it's time to buy this dip, but certainly people seem to be sitting on their hands here.
Yeah, and I wouldn't say the equity markets are sanguine at all. Small caps made a new low. Right, last week, as of the close on Friday, small caps are below their 2022 lows. which is pretty consequential for risk tolerance. If you think small caps, emerging market equities are generally the leaders of risk tolerance in the broader markets, looking at the S&P 500 breakdown doesn't tell you the whole story. And I do think that stocks are completely breaking down amidst all of this action.
Let's get to stocks because our next guest has a lot of insight just on this. You are seeing a buy the dip kind of moment, particularly led by the NASDAQ. Once again, S&P futures up 0.7%, 4164, although poised for the third straight monthly decline, which is unusual. Euro gaining just a touch, 10-year yields inflecting upward, but still well below that 5% mark, 4.86%. Crude off. Again, this goes to the haven bid, this question of why are people relatively sanguine about the idea of escalation when there kind of have been some escalatory moves and words coming up for this week. We've been talking about how important this week is. We get the Bank of Japan rate decision on Tuesday. Will they drop yield curve control? The Fed on Wednesday, does it even matter based on the Treasury finance agreement, and Bank of England on Thursday, as well as a host of emerging markets, which Damien will remind us of pretty much every hour on the hour. Throughout the week, on the economic data front, we get U.S. employment cost index on Tuesday, U.S. job openings on Wednesday, U.S. initial jobless claims and productivity on Thursday, all leading up to the big event, which is the U.S. employment report on Friday. Gina, does it matter?
Yeah, it does matter. I do think that ultimately what we're looking at is stability in the economy, which is creating some degree of earnings recovery amidst a slowdown in inflation. And that is at least half of the equation for what drives stocks. I realize that over the last 6 weeks, we've been completely captivated by the macro, and it's all about rates, and it's all about what central bank's doing. But ultimately, it is about that long-term cash flow growth, that long-term earnings growth. And if you have a stable economy, you have consistent spending in that economy, some of the recession worries really get put to bay.
I like that we're going to be having balance sheet discussions about Apple and about other companies. We are going to get Apple on Thursday. On Wednesday, we get another financial discussion, which is the Treasury funding announcement, as you mentioned. Damien, a lot of people are saying it does take precedence over almost everything else. To me, I think it's going to be most interesting to understand how bonds and stocks respond to some of these particular economic and other data points. That, to me, is going to be the big mystery.
And the dollar. How's the dollar going to respond to that QRA? I mean, the dollar and its sensitivity to the long end of the U.S. yield curve, forget about twos, I'm talking 10s and 30s, has been as tight as you've seen in recent months. And so I'm definitely looking at the QRA. I mean, I think the street expects it to go up from here, certainly. It's the extent by how much. And so I think that's really where the rubber meets the road for me.
So let's get right to it, because this really is a question of, is the headline figure is really masking the underlying pain that Gina was just talking about, that stocks really aren't holding up. Lori Calvasina joining, head of U.S. equity strategy at RBC Capital Markets. Do you agree with that when you look under the hood, you're seeing massive breakdowns that are reflective of a great deal of pain that people really gloss over?
I think that's fair, Lisa. I mean, I think Gina hit the nail on the head when she talked about small caps making a new low. I always tell people about small caps, even if you can't buy them, they tell you a lot about what's going on in the broader market. And I think what's going on is that they're really taking the brunt of the pain as regards to the big increase in 10-year yields that we've seen. Now, of course, the tech stocks and the big cap part of the market are getting knocked around by that as well. But small caps, it doesn't matter to how many charts I can show people suggesting that the balance sheets are not that bad. People simply don't want to hear it. And there's a view that small caps are simply not going to be able to weather the storm that's created by the surge in interest rates, whether it's 10-year yields or Fed funds. And again, I have so many charts, Lisa, that I've been showing people for the last 6 months saying, hey, small caps have done a good job of shifting towards long-term debt. The variable rate's down. The weighted average maturities are really not that bad, on average about 4.5 years. People simply don't want to hear it, Lisa. There's just been a long adage that small caps don't weather higher interest rates very well. And I think that's one of the big reasons why they're getting punished right now.
Lori, can you talk about sector performance within the small cap sectors? Because I do think that the sectors are telling an interesting tale in small caps that maybe we're not picking up in large caps.
So if you think about, think about it from a valuation perspective, I will say that most sectors in small cap look cheap relative to their large cap counterparts. But where it gets really interesting is on some of the cyclical sectors. So it's not just small cap financials that are dragging down the Russell 2000 from a valuation perspective. Healthy sectors from a fundamental perspective, like industrials, also look pretty cheap relative to large cap in the small cap space. Consumer discretionary stocks really look kind of left for dead. If you look at valuations there, they're deeply, deeply cheap, and they were actually really down around recession-type lows last summer. So we're really seeing that pain very, very widespread.
And given we are in the midst of earnings season, is there anything that you're getting out of earnings that maybe is not getting picked up by the markets, considering the markets are so captivated by what's happening in these macro indicators?
So I think people are really misunderstanding what's going on with inflation moderating and what that does to companies. One of the things that we've seen when we compare our numbers versus the street consensus, and we actually, we use the Bloomberg data to monitor the street consensus, and it does a really good job of articulating how margin expansion is baked into a number of different sectors next year. Well, in my modeling, we actually don't have margin expansion. We kind of have margins going back to 2022 type levels. And one of the reasons why is that we don't give margins a big benefit from sliding inflation. We simply haven't seen a justification to do that in our back test. And when you go through all the transcripts, what we're really noticing is that companies are picking up on this. So the pricing discussion has simply gotten much, much squishier, and companies are saying it's going to be a softer pricing environment. Of course, there are a couple that are out there saying they're going to raise prices to infinity and beyond. That's not really the norm here. And what we're really seeing is that companies are acknowledging that they're not going to have an excuse to push these prices through as the cost environment moderates. And so we're not, going to necessarily see this big boom to margin expansion simply from costs coming down and prices staying high. And I think that's really what's embedded in a lot of street assumptions for next year.
Lori, I'd like to build on what Gina was referring to about sectors, and specifically sector dispersion amongst large cap names, right? I mean, it's usually at its highest during periods of distress. I'm thinking 2000, 2008, yet sector dispersion has been very high since the pandemic started. I mean, I wonder what you take from that. I mean, certainly we look at some of the interest rate sensitive sectors and how they've underperformed. I mean, is that going to continue? I mean, what's it going to take to kind of get these correlations to right way?
So I'll tell you, Damian, what I feel like I've noticed in the sector data over the last couple months, and this is looking at the S&P 500 specifically, but it feels like anytime there's a part of the market that gets a little bit of leadership, it can't sustain it for that long. And I've described it as, sort of this sniper that goes out, and anything good we have just gets taken away. And we saw, utilities, for example, was having a really nice moment late in the summer, and then all of a sudden just the bottom fell out. Yeah. We've also seen energy just really kind of lose that luster. And I think the problem is that the market is losing confidence in any one narrative. We really can't get a rotation going because on the one hand, tech stocks look expensive, they look crowded, their earnings dominance is starting to fade, and hey, interest rates are not usually a good thing for those stocks, so that's starting to take a toll. But anything the market wants to rotate into just can't seem to maintain its footing for all that long from a fundamental perspective either. So it's just been a real struggle, I think, both to find something to generate incremental excitement in the market and to really allow that rotation to play out.
Well, Lori, I'm so happy you mentioned utilities because it's been utilities and consumer staples, those traditionally low beta defensive sectors that have underperformed. I'm wondering, how do you position defensively in today's market?
So I think it's very tough. I've actually got an underweight on consumer staples. I'm neutral on utilities. I'm overweight healthcare. That one's had a tough time getting going as well. But to me, it's got the nicest combination of decent valuations. At least until recently, it's had strong earnings revision trends. We've seen the med tech space sort of take a little bit of a hit, and there's been a concern about the weight loss drugs that emerged. I've been trying to tell people that happened at a time when the med tech stocks looked like they were kind of over their skis from an earnings revision perspective anyway. But if you look in other areas like pharma biotech, if you look at the providers and services space, you have a really nice kind of ramp up in earnings revision trends that feels like it has more room to run. It's not a perfect story by any stretch, but other than the weight loss drugs, it does feel like it has less macro hair than, say, utilities and staples. With staples, I will tell you my analyst is starting to feel a little bit better there, just based on the fact that we did have this big sell-off from the weight loss drugs. And valuations, I will admit to you, are pretty compelling, but I do continue to worry about that sector from just a pricing perspective. I think it's right at the sort of center of the storm I mentioned in terms of not being able to pass through higher prices for much longer. We're seeing those companies actually really talk about how consumers are pushing back.
Lori, what does it tell you that you can have the right idea in terms of the solidness of a corporate balance sheet, that you can have the right idea about historical valuation, and that investors just won't bite, that it doesn't actually work in trading practice?
I think it tells you that, whether it's the Middle East, whether it's interest rates, we're in a sentiment-driven market at this point in time, and confidence is just very, very fragile. One of the things we've talked about, Lisa, a lot this year is how 2022, 2023 has felt a lot like 2010, 2011, and 2002, 2003, which were kind of messy, extended post-crisis normalization periods. I lived through both of those as a strategist, and what we saw was that confidence was just very fragile. There was a constant fear of the next skeleton coming out of the closet and blowing things up. constant fear of tipping into another economic downturn. And I think that's the environment we've been in recently. And so anytime we have issues that come up, there's just not a lot of confidence that either companies or management teams or the market as a whole or the economy is going to be able to weather the storm. And that kind of felt like it was easing over the summer, but I feel like we're getting sucked right back into that messy normalization period again where confidence is low.
Lori Calvasino of RBC Capital Markets, thank you so much for being with us. Would you agree with that, Gina, that basically that seems to be the sort of sentiment messiness that's actually a recovery, not the opposite?
Yeah, I do think that that's pretty consequential or pretty consistent with what we see right after recession experiences, with the one exception that inflation conditions have been so profound in this cycle, where we didn't really have to worry about a reacceleration in inflation. We didn't have to worry about inflation's impact on earnings in either of the post-recession recoveries of the last two cycles. That's been characteristically pretty important, and that's what, in my opinion, is driving that sector dispersion that Damien mentioned, is just this inflation story is creating really different sector-level outcomes, which is creating different outcomes for the market at large.
Well, Gina, I think it's the leverage factor, and you've written to this previously, right? The reason those defensive sectors are performing so badly is because they have high leverage.
Yeah, it makes a huge difference with rates moving as they are, and I think rates are moving because of inflation.
It's complicated. Maybe we just say that. It's a complicated brew. Coming up at 7 a.m. to parse through the complications, Barry Bannister of Stifel, as we drive forward on a crucial week for markets.
When you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
Earnings season is here.
Tons going on, lots of earnings.
Beat wherever you look.
Bloomberg breaks the numbers first.
It's a tale of two earnings. Results from Goldman Sachs, Bank of America, and Morgan Stanley.
Netflix is out, guys.
With exclusive expert analysis.
Recovery is underway.
They crushed it. It was one of their best quarters ever.
This is a story all about pricing power.
We're going to make more money. We're going to make more money. And we're going to make more money.
We're going to make them bank. And I think that is what we can take away.
Bloomberg Television and Radio. Context changes everything.
Israeli Defense Forces speak to their plan, and war, of course, is highly unpredictable, so it's difficult to predict how it will play out. We will continue to talk to our Israeli counterparts. We'll continue to ask hard questions about how they are thinking this through, how they are proceeding, but ultimately, these are their decisions. If American troops are attacked by Iran and its proxies, we will respond. We did respond. If attacks continue, we will respond.
That was Jake Sullivan, U.S. National Security Advisor, speaking on ABC, flooding the networks over the weekend. We got a number of different insights. And honestly, I am just as confused as I was before. It's very unclear what's going on in the Middle East. Let's get straight to it. Bloomberg's Ali Crook took a plane back to Tel Aviv to help us out to understand what's happening on the ground. Ali, can you just start there? We do know that the ground operation has been extended. It isn't necessarily considered the same kind of scale that people had expected. What do we know about what's going on?
Yeah, that's right, Lisa. So now we're in the fourth week of this war, and really a new chapter or a new stage, as Benjamin Netanyahu called it over the weekend. And what is this new stage defined by? Really by a growing ground presence of Israeli troops within Gaza. So we saw the greatest sort of, effort on their part so far. There had been sort of puncture wounds in and outs that had been happening, but really this weekend with tanks in there and that offensive expanding. And we've heard from the IDF. They said over the last few hours there have been more and more troops that have entered. They're going about this very gradually, as they had been sort of trying to destroy the idea that it would be a full land invasion, which this is not quite yet. And then the question is, why are they going about it this way? Of course, there's the more than 200 hostages that are still being held by Hamas, but then there's the very real escalation risk. There has been some condemnation from some of the Arab nations about this step up. There is some more fighting on the border with Lebanon, but nothing really outside of what we've seen previously, and some strikes within Syria as well. What we will be keeping an eye on, however, in terms of looking at the risks of escalation, is some more and more clashes in the West Bank. This is going to be key. And also, we understand from Lebanese television that we will be hearing from the leader of Hezbollah on Friday. He will speak on TV publicly for the first time since the war began.
Ali, we'll catch up with you next hour, and we'll go more in depth about that as well as the politics in Israel. Thank you so much for being with us. Bloomberg's Oliver Crook. I want to pick up on the point that Ali was talking about with respect to Hezbollah, why they haven't gotten more involved, when they might get more involved. Joining us is Norman Rule, former U.S. senior intelligence official and senior advisor at the CSIS Transnational Threats Project. And I want to start there, Norm. I mean, how much are you sort of, I don't want to say surprised, but is it unexpected that Hezbollah has not gotten more aggressive when it seems like Israel is sort of tiptoeing into the ground invasion they've been talking about?
Good morning. I don't think it's a surprise that Lebanese Hezbollah has not responded more aggressively. We need to keep in mind that for Lebanese Hezbollah, they're still fighting a conflict in Syria. They've lost many of their best personnel in Syria. Lebanon is in a political shambles, and the economy of Lebanon has been halved in recent years. So it's a quite poor economic and political situation. For them to enter the conflict, they would need some sort of gravity pull of events or actions to cause them to risk so much, especially since Israel is alert, looking in their direction, and has augmented military forces in that area. So for Hezbollah, this would be a very daunting and risky operation for unclear strategic goals.
Norman, Israel's relationship with the Middle East, with the broader Middle East, as we know, is in complete disarray. But Brazil, Turkey, Colombia, other major players, Israel's relationship with them is deteriorating as well. The United Nations, for example. Is Israel losing the foreign policy battle here?
Well, Israel's certainly losing the public diplomacy aspect of this conflict, and that's not unsurprising given the international sympathy for the plight of the Palestinians. But I would be careful in saying that this would be a long-term impact on its trade and diplomatic relations outside of the region, at least at this point in the war.
Prior to the attack by Hamas, Israeli politics had been very divisive, obviously. What are your thoughts on Bibi's ability to remain in power, given the ground invasion and all that's happening now?
It's very challenging. In 1973, the conflict ultimately helped propel Prime Minister Golda Meir out of office. And the investigative commission at that time, the Agramat Commission, didn't really do much to help her stay in power. The investigation after this will be even worse. He's only been popular because he has stated that he would be the security prime minister, would prevent an attack. And for this reason, I think many Israelis put up with the divisiveness and the turbulence. That's now that idea has now been erased. So I think his political survival is very, very much in doubt.
Could we talk a moment about the U.S. response, and in particular the new sanctions put in place on Friday? Where do you see this headed, and how are these sanctions potentially impactful?
Well, I think the U.S. response has been measured. There's a deep sense in Washington that we don't want to be pulled into this conflict, to include having our reputation and our equities in the broader region pulled into the anger that is felt in the Arab street against Israel. It's a very delicate time. I would be careful about looking at sanctions as having too much of an impact on the various adversaries at this time, you really have to ask yourself when you look at a specific sanction, does this touch the decision maker at the top of the pyramid of an adversary? And the sanctions that have been put in place against Hamas recently are important, but don't really meet that measure.
There's a real question, Norman, about how much Qatar, how much Saudi Arabia are playing, how much they're playing roles behind the scenes that we don't know about. We know that Saudi Arabia's defense minister is coming to the United States to meet with the White House this week. That has been reported by Axios. What do you make of that?
Saudi Arabia and the United Arab Emirates and Qatar have each played large roles in recent weeks. Saudi Arabia and the Emirates have done what they can to tamp down anger in the region. The United Arab Emirates has actually made some statements in sympathy of Israel for the terrific attacks on October 7th. The Saudi defense minister's visit is probably related to several things. He's going to ask for a sense of where Washington sees the conflict going. How does Washington plan for the day after, the diplomacy for a two-state solution, and defensive issues to allow Saudi Arabia to augment its capacity to push back on Houthi missile activity, and perhaps Houthi border incursions against Saudi Arabia.
Based on what you've seen over the weekend, and it seems like there have been a lot of events, are you more optimistic or less optimistic about the potential for a neater resolution in the near term than you were last week when we talked about the same issue?
I see no changes. The resolution both to this conflict and the Arab-Israeli rapprochement are both unclear, and it's going to take a fair amount of time to play out. I will say that the Gulf states have communicated quietly that they remain highly interested in rapprochement with Israel, but obviously the timeline is thrown aside at this point, and no one really talks about when that diplomacy can be restored, given the state of the conflict.
Norman Rule, thank you so much for being with us. We look forward to speaking with you again soon. Norman Rule of the CSIS Transnational Threats Project. And Gina, honestly, I think that your question about the U.S. response is a really important one, especially because Biden's gotten a lot of pushback, even with his own party.
Right. And also there's so much question as to what the U.S. commitment is globally to sort of resolving geopolitical crisis in general right now, considering our budget deficit situation, which also ties right back to financial markets, the budget deficit being pretty important consideration. Will we be able to commit to defense spending to support the world and peace throughout the world? Or are we going to have to sort of become more insular? And that seems to be the continuous trend over time as we have this larger deficit.
I'm curious what the majority of views for U.S. Republicans and Democrats are on the war. If you're an average Republican in the United States, what's your position on a two-state solution? Same for a Democrat. I just don't think there's a lot of clarity there. And I think our political leaders don't really know how to support their constituency on it. So I think there's a lot of ambiguity there.
That was doing a lot of heavy lifting, how to support their constituency in terms of just how divisive this issue has become.
Exactly.
And what we saw from the new House Speaker, Mike Johnson, over the weekend when he went on Fox News was actually something of a neocon position. It was actually more traditional. We need to back Israel. We need to do support. But, oh, yeah, we also need to do budget cuts, to your point.
Right.
And we got to take it out from somewhere.
And on top of Ukraine, Russia, which is also a highly controversial topic in Congress right now.
Ian Bremmer keeps putting out on X, the platform formerly known as Twitter, no one's asked me about Ukraine. 3 weeks.
Yeah. Oh,
yeah.
Nobody. And that, I think,
is
very
telling. Suspicious.
Well, I mean, it sort of speaks to the mood. Coming up, we're going to talk about the latest in the economy on a key economic week. Francis Donald of Manulife Investment Management. That's next.
almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
A little lift after we saw last week corrections in both the NASDAQ and the S&P. We can see a bit of a bid to the tape. Welcome back. This is Bloomberg Surveillance. John and Tom are both still on their cruise. They are enjoying drinks on the deck. No, they are not, but they will be back later this week. I am so glad to say Gina Martin-Adams and Damian Sassower alongside me, which is a wonderful thing on a massive week. The euro getting a bit of a bid and yields, Damian. Honestly, to me, this is sort of the big mystery of every day. We come in, what adventure are we going to get today? What you see on the screen is no indication of what's going to happen in 3 hours.
That's right. And look, we always laugh about fundamentals in this environment. U.S. fundamentals obviously have been strengthening. In Europe, you're seeing it go the other way. What's interesting, we're going to get some data tonight from China, right? Which has been historically a weak spot here. So I'm curious to see what the PMI data tells us. Obviously, people think it's going to be weak. If you just look at, they had a holiday earlier in the month, so it's probably going to weigh on things. But, China's a real problem spot. Nobody's talking about that either.
No one's talking about that. No one's talking about Ukraine. No one's talking about all sorts of things because we all have a fatigue with everything that's going on. Where do you look next? Let's get straight to it, and I'd love your thoughts on just that sort of overhang and how it just creates a fog that's difficult to get out from under. Under surveillance this morning, Israel expanding its ground offensive into Gaza in what leaders are calling the second phase of its war against Hamas. President Biden speaking to Israeli Prime Minister Benjamin Netanyahu over the weekend, telling him to prioritize the protection of civilians. Concerns are growing over the scale of the humanitarian crisis in Gaza. The UN saying 33 trucks carrying aid crossed into the territory on Sunday, the most since the conflict began. And honestly, it is so hard, Gina, to get a handle on where to look next and how far this is dividing people and how much this is going to affect not only the budget, but also the political landscape at a time where we're not sure what party is which.
Yeah, it is incredibly confusing, and it's one of many, many factors impacting the markets. I think this is the other trouble is it's easy to get captivated and sucked in by this particular issue, considering the human consequences, the potential international consequences of this war. At the same time, though, it's pretty clear to me that equities are the only market that's still paying attention, right? Dollars stopped rising in early October. Long-term Treasury bonds stopped rising in mid-October. Equities are still melting down. So that tells you a lot about risk tolerance. It really is about now an adjustment of risk premiums as equities are certainly paying attention to the global markets, despite the fact that earnings are beating expectations. So even though the U.S. economy is still somewhat stable, recession risks are somewhat limited relative to expectations, these global considerations are elevating risk premiums.
Well, Gene, I'll do you one up. It's not just equities, it's credit spreads also, right? But it's not investment-grade credit spreads. It's high-yield spreads, which are finally gapping wider here. And emerging market, obviously, sovereign credit spreads have been doing that for some time. So, if you want to look for some sense of where investor sentiment is, look no further than equities and spreads.
Well, this is sort of a question of, and it raises this sort of existential angst underpinning the bond market, which we'll get into in a minute, which is, our Treasury is still a haven. Yeah. We'll get to that in a second, but the United Auto Workers ramping up its strike against General Motors, even as trying to get some sort of potential resolution elsewhere. Nearly 4,000 workers in an assembly plant in Tennessee walking off the job on Saturday evening, just hours after Stellantis reached a tentative deal with the union and 3 days after Ford did. GM has reportedly agreed to a 25% wage increase for hourly workers, along with cost of living allowances. To me, this is sort of also the boogeyman in the room, kind of. Whether this is the beginning or the end of all the wage pressure and sort of the inflationary moment we're in, Damien.
And this I can't make up or down for. I mean, I'm serious. I thought everything was fine on Friday, right? I thought GM, Stellantis, Ford, everyone agreed to a deal. Everything was going to be fine. And then I walk in this morning and there's another walkout for GM. And it's just GM, right? It's not Stellantis. It's not, I mean,
They're
again,
fine.
I don't know who's running the boat at the UAW, but, you know, it'd be interesting to know where we are today on a Monday morning.
I think it's by design partly, right? I mean, isn't it sort of the playbook? But can any of this, if they resolve it, give you more excitement around the auto manufacturers? I know you can't really give any kinds of commentary, so just take this. No one's really listening. Just go ahead.
Yeah. No, look, I think that this is a GM-specific issue. We had certainly a UAW-specific issue. But when you look at this in the grand scheme of things, UAW is a very small portion of the overall labor force in auto manufacturing anymore. And now that we do have electric vehicle production as a big component of auto manufacturing, that competitive landscape is probably more important than anything else for GM, Ford, and some of the UAW-dependent retailer or auto manufacturers. Excuse me. Okay, so I'm still not awake, and it's nearly 7. Nonetheless, we're still working on this.
You're doing great. Meanwhile, it is a busy week of earnings and eco data. The Bank of Japan rate decision due tomorrow. There's relentless downward pressure on 10-year Japanese bond yields, partly because they've been buying stuff. There's a real question about whether they can continue that. The Fed decision coming on Wednesday, along with the U.S. Treasury's quarterly funding announcement. Thursday, we'll hear from the Bank of England. And we'll get Apple earnings round out the week on Friday with the October U.S. jobs report. My favorite thing is if I go to Damien, he's going to say, but don't forget rate decisions around the world in the developing market. I'll get to that in 1 second.
She has you pegged.
Okay, go ahead.
I will stay with my favorite non-emerging market, Japan, because I think of all the major developed market central banks, the one that has some sort of potential to surprise, it's definitely the BOJ, right? I mean, I don't think they're going to tweak YCC. I mean, I may be wrong there, but what's interesting is we had a lot of hot CPI prints out of Japan, and they're definitely going to be raising their inflation forecast on a forward basis. I wonder if that alone has the potential to move the 10-year closer to that 1% mark. I don't know.
Yeah, Japan is also the one market in Asia that's really come alive over the course of the last year or so. Japan's been a very big haven and source of trading in the equity markets all of a sudden, and all of us has kind of forgotten about Japan, frankly, until this last year. So what's happening with rates is feeding through to equity markets. Part of it is the tech story as well, but certainly Japan is a big portion of the equity market that we're now paying attention to, and it had been largely dormant for 20 years.
Can I add one thing to that? What's really interesting, and it's at a record level, the amount of retail trading in FX that's coming out of Japan. Japanese household, everyone is trading FX in Japan because yields are so low. Of course you would try to push your money abroad, and I think it's in, like, I don't know what the number is, but it's at an all-time record. It's a fantastic number. So.
Which is maybe the reason why they're struggling to keep it sort of elevated above or below, I should say, 150 per dollar. Joining us now really to dig into this question of what to make of this sort of, I don't know, anomaly of Treasuries not responding the way that you would expect at a time of great uncertainty, the way that bonds are outside of Treasuries and where you're seeing in stocks. Francis Donald, Global Chief Economist at Manulife Investment Management. How much is that sort of giving you agita at night?
A lot, among other things, Lisa. It calls into question some bigger issues that are at play here, which is, as noted, we have a ton of central banks this week. We've got emerging markets, developed markets, Norway, Japan, England, Fed, Brazil, the list goes on and on. And the thing that keeps me up at night most of all is not, are our economic models broken? We know they need to change. And not even how is government spending changing the game, but is the decision-making function of central banks adjusting in an era where we know inflation is becoming less interest rate sensitive, the bond market is being moved by factors that it traditionally hasn't been, that is to say, more debt issuance. How do central bankers respond to data? And is it the same as what we've seen from the last 10 years? Because we've seen several Fed officials come out and tell us, hey, guess what? Those strong economic data points, they're not consistent with what we're seeing on the ground. And those single sentences that say the Fed is actually taking data with a grain of salt, that's what keeps me up at night, because I can run a model that tells me what the data is going to do, but then I have to develop some sort of model that's going to tell me how people with biases and their own backgrounds are going to interpret it. And that's when the game gets tricky.
So interesting. Can you talk a little bit then about your interpretation of the ECB last week? Is there anything in the ECB or anything that you heard from the ECB that would indicate that central bank decision-making is shifting? Can we look to the ECB for guidance on what to expect from the other central banks this week?
Well, Lagarde plays it close to the chest, but I thought she doth protest too much, methinks. A lot of pushback on, we're not going to talk about cutting rates. And then I thought, I remember in June of 2020 when we weren't even thinking about raising rates. That's what Powell told us at the time. Of course, central banks are going to push back against the idea of rate cut expectations. But look at the projections that come into things like the Fed's summary of economic projections. They already tell us that even with inflation above 2%, they have the expectation to be cutting rates. That is a little bit strange. That's not what we would have thought from the traditional central banks. So we have to evaluate that relationship between interest rates and inflation. And if you're a long-term investor, which most people are, retail investors and institutional investors have a longer time frame the next week or the next decision, we have to start having some very deep conversations about whether the inflation and the interest rate relationship will be stable over time. My sense is it's going to disconnect somewhat, and that matters to a lot of capital market assumptions and where we're going to be 5 years from now.
Francis, bankruptcies are rising, housing activities in decline, credit card delinquencies are above pre-pandemic levels, and yet the risk of a recession has declined. I'm curious what your thoughts are on whether or not the Fed can achieve a soft landing.
My thoughts that the risk of recession have actually increased in this type of environment. Look, if you woke up today and you've been in a coma for the last year, I described all those statistics. I added on that the government had spent basically the entire amount of what they could in good times with GDP at 4.9%, massive amounts of geopolitical risk we have not seen in ages. And central banks have said, even if we're going to cut less than we have historically. Would you be bullish? That would be really hard to do. So even if you have these priors of having called for a recession too early, which I did, if you look at the economic data today, it is so significantly consistent with a downturn. Now, I will push back a little bit. We do have a recession in our model, but there's this emphasis on recession or no recession. It's so binary. That is not how markets work. If you just look at the balance of risk ahead for growth, we have just seen peak growth in the United States. And markets, more than being recession or no recession animals, are really focused on second derivatives, the change in. The growth impulse going forward is going to be much lower and more challenging. Is that 2 quarters of negative growth or 1 quarter and then flatline? I don't think that matters as much. But yes, if I woke up today and looked at the economic data, I would be really hard-pressed to say, that's a soft landing. Everything's looking great. That's not the case at all.
But haven't we already priced that in? Based on small caps, based on outside of big tech?
Yeah, so it depends who you are. If you're a small cap investor right now, you don't need any convincing that there is weak economic activity ahead. But if you're an asset allocator and you're looking top down, I'm not sure you're as convinced. Now, we have seen moving into correction territory, but you're still in an environment where equities have outperformed bonds, and the traditional asset allocation has not been consistent with recession ahead. So it depends who you are. I certainly have some portfolio managers I work with who are in the banks or small cap space. They don't need to be explained how bad the data is. But if you're sitting at the top level and you're looking down, I'm not sure it's clear how challenging this is. But Lisa, I'll leave you with this comment. Macro is an imprecise investment tool. It takes into consideration the state of play. It doesn't necessarily take into condition sentiment, positioning, underlying valuation things. Macro is one part of your toolkit. And yes, as a macro investor, that pains me to say it, but we have to say it out loud. I think that's critical to the story.
So I have to ask a really unfair question. If you could get advanced information from any of the events that we've laid out this week, which would it be?
Oh, I might go a little bit niche with this one and say employment cost index. What is happening to U.S. wages? I think that will be really critical. And I'll give an honorable mention to the Bank of Japan because, again, I'm looking at how is what we've used for the past 10, 15 years changing. And the Bank of Japan really relaxing yield curve control. I'm not sure it'll be as massive and sustained of a market event, but that's another example of how central banks may be shifting their thinking, and we got to adjust some models.
Francis Donald of Manulife Investment Management, thank you so much. As always, wonderful to see you lay everything out for us as you do with such clarity. Gina, to me, that's one of the big questions with some of the equity returns that we've seen in some of the reports, just how much they can pass along those costs to consumers because employment costs are definitely still going up.
Yeah, they are still going up, but the bulk of the inflation distress that U.S. corporates had experienced is because input costs were going up, not necessarily because wage costs were going up. Wage costs were accelerating, but input costs were accelerating so incredibly rapidly in 2022. So the downdraft in input costs, or at least the relief in input cost pressure, has provided a lot of relief for U.S. corporates. And the spread between CPI and PPI is still quite positive. So that input cost deceleration is most important. They are still able to pass a degree of increase onto the consumer. And frankly, as long as the consumer has those wages, those input costs are going to continue to be the more important factor.
If Tom were here, he would put up a banner that said CPI, PPI, PCE, and it would be sort of this soup. But basically, it's the costs that you've got to pay versus how much cheaper things are that are coming in.
Well, I personally just think Frances is absolutely brilliant, not least of all because she agrees with me on Japan. I think the BOJ meeting is going to be the meeting this week that you have to keep eyes on.
Coming up, thanks, Damien, for that. Now, coming up, we've got Leland Miller of China Beige Book, so you can talk a little bit about China, which I think is actually really important, especially the geopolitical sphere, but also when it comes to the economics of the moment. In markets, a bit of a reprieve, the buy the dip continuing into at least another day.
What did you learn in the last 40 years about leadership in politics?
Well, I've learned a lot about leadership for a very long time, observing it in others, recognizing what is needed to get the job done. And I always define it in this way. Know your why. You have to know why you're doing this because you will be under attack, this for sure. Know your why, know what you're talking about, know how to get it done, think in a strategic way, and then that's all up here. And then also connect directly with people. If you can show them how important what you're advocating is and what you know you're talking about so they trust your judgment and you have a plan, you will have followers. You will be a leader.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg.
The commercial real estate market in China has had a huge policy correction. And I think we are at the bottom of the market. But it will take quite a while for that market to recover and regain momentum. So I'm not expecting a massive reversal in that sector in the next 12 months or so, but I do expect it to be a gradual improvement from where we are.
Noel Quinn, HSBC CEO, talking about the mystery behind the real estate market in China. We aren't really talking about that much. Welcome back. This is Bloomberg Surveillance. Maybe we should be, though. Damien, you were talking about how important it is to really highlight the China picture, both economically and geopolitically.
Well, there's just been a payout on default risk. I mean, CDS and Kogard, there's actually been a payout. Whenever CDS pays out because there's a default, that's never a good thing, right? And now we've got Evergrande, a little bit more can-kicking exercise over the weekend. They got an adjournment. There was supposed to be potentially a wind-up and an actual liquidation, but that didn't seem to be the case. So, we're kind of extending and pretending again in China.
Extending and pretending on the economy standpoint. Gina, you've been talking about the geopolitics. Leland Miller has been on the ground, at least with data points, trying to understand what exactly is the state of play. Co-founder and CEO of China Beige Book, one of my favorite people to talk to. And, I want to just start with, is China taking advantage of this moment geopolitically and involved in back-channel negotiations, whether it's with Russia, Iran, whether it's with the U.S., or are they taking this opportunity to shore up their economy in a more meaningful way?
Well, look, they haven't taken advantage of anything geopolitically just yet. But the worry is that as the United States gets more bogged down in one theater, Ukraine, another theater, the Middle East, that this will make a appetizing opening for China to do something on Taiwan. Is that likely? Surely not. But this is the type of evolving situation that we have to see, play out. We don't know how any of these theaters are going to develop over time. We also don't know how much worse the Chinese economy is going to get over time. Certainly, Xi Jinping has his hands full with the problems, back home. So there's a lot of things we don't know here, and this is why it's such a different situation than what we've seen in the last 5 years.
You've been out front, Leland, saying that people were underestimating the economic momentum in China, and not necessarily long term, but at least short term, and people are coming around to that idea. How have you adjusted your view based on some of the recent stimulus that we've seen coming out of the region?
Well, there's no reason to reevaluate it yet because the stimulus hasn't hit. So I think what's important to understand is you see these gigantic stimulus headlines and everyone's really excited and they assume, wow, we read a stimulus headline, which means it must be, immediately hitting the economy. What's happening right now is that local governments are issuing a lot of bonds and we may see a bunch of activity later in the year. But we're also seeing is corporate borrowing at some of the lowest levels we've ever seen in the history of the survey. Corporates are looking at the economic environment right now. They do not like it. They're not hiring. They're not investing. They're not borrowing. Things are better than last year. It's not a collapse, but it's a really disappointing economic situation. So the idea that stimulus is going to be announced and then put into play and it's going to all hit and things are going to get better, that's never been realistic, and it's not as what's happening right now.
Leland, I was at the Emerging Market Traders Association forum just last week, and the talk was extreme pessimism surrounding China, and the word uninvestable came up over and over and over again. I'm curious to hear your thoughts. As a U.S. investor, how should I be approaching China in today's environment?
What we try to stress is not that China is uninvestable per se. It's that you can't invest in China like you did, 10 years ago, even 5 years ago, because the risks are so much more dramatic. The risks are geopolitical, they're trade, they're sanction related, they're related to what's happening in the domestic economy in China. It's just a totally different scenario. And then if you're talking about A shares, of course, the market over there is not a real market, and it's not correlated to the real economy. I think what a lot of large asset managers in particular were used to for many years is they invested in their big tech companies. They love their Alibabas and their Tencents, and they were just used to just collecting dividends on a regular basis and watching the stuff go up. That era is completely over. So China is still, it's not completely uninvestable, but it takes a level of sophistication far beyond what people were used to in the past.
Leland, we see that PMI data out of China this evening. I know you have a much better read of what is actually going on the ground in China. What are your thoughts heading into tonight?
Well, look, October got weaker in our data from September, and September was weaker from August. So, it's funny that we're being called such big bulls right now in Wall Street. We're simply bulls because we don't think China's collapsing, not because it's doing particularly well. It's a sign of the times, I guess. But look, the economy is not doing very well right now. You're seeing stimulus headlines, but you're not seeing anything on the fiscal activity side yet. Our fiscal activity index for October was one of the lowest levels we've seen in many, 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 many months. So nothing is really happening there. Everything is better than last year, but property's bad. Consumer spending is tapering off. There aren't really that many bright spots in the economy right now.
Can we talk a little bit about expectations? Because we have seen China's correlations, at least in the global equity markets, Chinese correlations relative to the rest of the emerging markets have been extremely low over the course of the last year, given expectations coming into 2023 were so high for China, and then China generally disappointed. Are we at a stage right now where expectations are so low that your probability of improvement in China going forward is actually pretty high?
I think we were there a few months ago, actually. I mean, we were some of the only people all summer long saying China's not collapsing. You're too pessimistic. But keep in mind this, people are and have been too bearish cyclically. But I think they're still too bullish structurally. So yes, we will see an improvement in economic growth in terms of China being better this year than last year. They're probably going to hit their GDP target for this year. That doesn't mean the stock market's going to go up. The stock market is completely uncorrelated to the real economy. So it depends on what you're talking about. If you think things are collapsing, then yes, you're too bearish. If you think things are bottoming out and going to get really good into next year, or even sort of good into next year, you're probably too optimistic. So it's all about relative expectations right now.
Can you talk a little bit about what you see in the Chinese tech sector specifically? I think when you look globally, tech stocks have participated pretty much to a T. Every tech stock globally has participated in the rally in 2023. Certainly, a lot of that optimism has been removed from markets in recent months, but this was a global trade with Korea participating, Taiwan participating, Japan participating, US and even European tech stocks participating, but China was kind of left behind. What's happening in China tech?
Well, look, when the regulatory crackdowns that we first heard about in 2021 were said to be easing, people got excited earlier this year. The tech sector was coming back in China. The caution was always this: corporate governance in China is not improving; it's getting worse. And when you look at the tech companies, you look at the largest companies in China, you have the party getting more and more involved at the board level, in the strategic level. So you could talk all you want about how the tech sector is not being, oppressed in the same way than it was a couple of years ago under one of Xi Jinping's campaigns. But right now, these companies are being led in large part for strategic national purposes, not for innovation. They're not being run for their shareholders. Do you really want to invest in a company that has that mission?
Leland, China's finance minister said the possibility of a Biden-Xi meeting before year-end is far from a done deal. My question to you is, why do we even care? I mean, what is the significance of that meeting, and does it have any potential whatsoever to impact asset valuations in China?
Well, we shouldn't care, except that the relationship has been so bad over the last several years that it's never a bad thing to get leaders in the room talking, open lines of communication, particularly with what's going on around the world. But in terms of there being a breakthrough moment, there being something related to policy, something changing directory of the U.S.-China relationship, that's not going to happen. And in fact, we're going into a very difficult year next year with the Taiwan presidential elections at the beginning, the U.S. presidential elections at the end. So I think that this is being done simply to make sure the bottom doesn't fall out in the relationship.
That's the kind of bar that we're at. Leland Miller of China Beige Book, thank you. And I'm just restraining myself, Gina, the sort of, rather catastrophic side of me keeps saying, what's going to happen? All these people, and they have no clue. But the risks just mounting.
Yeah. Well, and I do think it's interesting, this recent campaign between Biden and Yellen and everybody in Washington kind of talking about China all of a sudden. This is no coincidence to me that we're suddenly focusing a little bit on China, given what's happened with Israel, given what's happened with Russia. That is the next area of geopolitical risk that we should be worried about breaking out. And so improving that relationship probably really key to preventing that next level of risk emerging.
But Damien, you asked the right question, which is, okay, everyone's talking about this big summit between Xi Jinping and President Biden. Why do we care?
Right. Why do we care? Well, I'll tell you one thing we should be mindful of, right? I mean, they announced they're going to issue a lot of bonds, right? And they have to fund those bonds, which means they're probably going to have to cut the RRR rate in the not too distant future in order to fund that. I'm talking by mid-November. I think that's what our economists here at BI are calling for, another 25 bip cut in the RRR rate over the next few weeks alone. What does that mean for the yuan and for rate differentials with the U.S.? That's key.
How much are you watching whether they liquidate their Treasury portfolio to try to stimulate their economy?
Well, they already are. I don't know if they can liquidate it entirely because they obviously trade a lot with the U.S. and they have a lot of dollar exposure. So I don't think they're killing their entire position, but they have shaved it pretty meaningfully.
And this is part of sort of the backdrop of technical concern for the Treasury market. The reason why people are wondering, will supply dictate everything this week when we get that refinancing agreement, the year funding agreement from the Treasury Department on Wednesday? Coming up, Barry Bannister of Stifel as we parse through a complicated and key week to understand both economics, geopolitics, as well as corporate earnings.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Now, women on average have about a 30% lower, amount of money saved up for retirement compared to men.
Yes.
So what are you doing about that?
Yeah, so we launched a campaign called Retire Inequality.
And we do know that women retire with 30% less. Women make 83 cents on the dollar. And so there's a couple of things that we're doing. One, it's having this conversation and making sure that we all are aware that there is a gap. By the way, women live longer than men, so longevity risk is a real factor. Secondly, it's about making sure that we are talking to women about what can you do differently. And so whether that's negotiating pay and what are some tools that are out there, making sure that you take the time to negotiate, because we know women do not negotiate as much as men, which puts you at a disadvantage to start. But then also along the way, making sure that women are securing their own retirement, and that as part of their retirement plan, we're having much more conversation around guaranteed income as well. And so ensuring that we understand what are the nuances for women. If you think about COVID, 2 million women exited the workforce. They did not continue to contribute to their 401k or 403b plan. And so how do we make sure, as a matter of policy, as a matter of engagement, that women can have an opportunity to catch up, that women can understand that if you exited the workforce and now you're back, that that's 2 years of compounding that you were not able to take advantage of? And how do we continue to make sure that we're educating them and giving them the tools that they need to get back on track?
The top names at the Fed are on Bloomberg.
The economy is handling much higher rates, at least for now, without difficulty. So notionally, that might tell you that the neutral rate has risen, or it may just tell you that we haven't had rates high enough for long enough.
The bond market has tightened quite considerably. If financial conditions are sufficiently tight, our work is not necessary because we don't need to boost them more.
Nobody covers the Fed like Bloomberg. Context changes everything. Season is here.
Tons going on, lots of earnings.
Beat wherever you look.
Bloomberg breaks the numbers first.
It's a tale of two earnings. Results from Goldman Sachs, Bank of America, and Morgan Stanley.
Netflix is out, guys.
With exclusive expert analysis.
Recovery is underway.
They crushed it. It was one of their best quarters ever.
This is a story all about pricing power.
We're going to make more money. We're going to make more money. And we're going to make more money.
We're making bank. And I think that is what we can take away.
Bloomberg Television and Radio. Context changes everything.
Is our sense that something fundamental is going on.
We think it is a buying opportunity for the market.
People are making more money. They're feeling very depressed about inflation, but they're still spending.
There's a lot of issues right now that are somewhat inflationary.
Volatility is going to persist until we have a clear inflection in the direction of the real economy.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It's Monday, and that's about all I can say with certainty. Welcome back. This is Bloomberg Surveillance with Jonathan Farrow, Tom Keene, and Lisa Abramowitz. Tom and John have extended their cruise to the Norwegian fjords. They thought that the thought of Alaska was just so great that they're going to go check them out and room together. Alongside with us, I have bribed them to stay with me for longer, which is a good and beautiful thing and wonderful for all of us. Damian Sassower and Gina Martin-Adams on a day ahead of an incredibly busy week. And Gina, honestly, all I can think about is we don't even know how the market's going to respond to data points that we don't really know, and we don't really have a sense of what exactly is going to happen that's going to drive the narrative by the end of today.
Yeah, I mean, I think overwhelmingly the market is so nervous about what's going on in the bond market that all of these central bank occurrences, shall we call them, this week will be certainly paramount in terms of importance. But underneath that surface, you've still got an earnings season coming. You've still got Apple's earnings announcement coming. Apple, being one of the biggest stocks in the world, not just the United States, is still very important to consider. Earnings growing at about 2%, much better than anticipated decline. You know, we've got a lot of other things happening that could certainly take hold and drive some degree of optimism, which after what has been a really rough, frankly, 3 months for stocks.
Yeah, you know, Gina, we've been talking a lot today about fundamentals, about technical supply, quarterly refunding announcements, and all that fun stuff. One thing we haven't been talking about is seasonals. And if you notice, we have come out of the seasonally weak, September to October period. Now we're getting into a part of the year where people want to put risk back on. I mean, historically, it's proven to be the right trade. Is now the time to buy the dip? I'm not so sure.
Yeah. BTIG's Jonathan Krinsky came out with this statistic to sort of prove that point. if the SPX closes below 42.88 on Tuesday, it'll be the third consecutive monthly decline. The last time there were 4 consecutive monthly declines in the S&P 500 was 2011, but it hasn't been down 4 straight months ending in November since 1946. You nailed it. So it's exactly that. Yeah. And does that apply this year? Because it feels like this year is somewhat different.
Well, every year feels like it's different. Frankly, every year there's a new challenge. I mean, I remember 2018 quite well. Remember 2018, we had this massive tech meltdown. Into October, we had a nice little bounce, and then all of a sudden we had the Christmas surprise. It was central banks that came back again to really bite us, and we saw this huge dip at the end of that correction. So seasonals can help, but only so much in an environment where the outlook is so uncertain, where macro is so uncertain, and central banks are playing such a critical role.
Yeah, no, exactly. And I mean, look, positioning is everything, right, in this market. And, you know, I think positioning's still heavy in a lot of places, a lot of risk asset classes. So, you know, I think investors need to be mindful of that. You don't want to walk into a freight train, as it were, at least.
Yeah, it seems to be kind of a feeling ahead of a week that's going to be kind of tremendous. Let's get right to it. In terms of what we're expecting, the Bank of Japan rate decision is tomorrow. The Fed comes on Wednesday. The Bank of England on Thursday. Damien will remind us of where other central banks?
Malaysia, Colombia, Brazil, Czech.
Norges Bank.
Norges
Thank you.
Bank.
Yes, exactly. And that's going to be important. All eyes on the Bank of Japan.
Yeah, Noki, Stokey. You know, I like Noki better than Stokey, but you know, Noki and Stokey. Good friends of mine.
Thank you. I appreciate that. U.S. Employment Cost Index coming out on Tuesday. U.S. job openings on Wednesday. U.S. initial jobless claims and productivity Thursday. You're cracking me up, Damien. And U.S. employment report on Friday. Gina, how much are people going to really understand what to do with employment cost index that's going up? To Francis Donald's point, is that going to be kind of one of the key points?
You know, I think that this narrative of wages accelerating has been in the market for quite some time. You'd have to have a big shock on that number to make it really move the market. In my opinion, considering everything else that's going on, perhaps that's the key indicator, as Francis suggested, for the broader economy. But is it really that important to the equity market? I think the equity market is going to be paying much greater attention to just jobs in general. Some sign of continued stability, some sign that we're not falling into a recession. While the employment costs are important, they're not the overwhelming concern for the equity market at this point.
And maybe they'll all just be watching the balance sheet of Apple. Wednesday, we get the Treasury refunding announcement. That's the balance sheet of the U.S. And then on Thursday, we get the balance sheet of the rest of the U.S., which is Apple, when they report earnings. And I guess that, you know, I want to go to you, Damien, with respect to the refunding announcement. What the sort of how low the bar is for a pretty significant surprise if the U.S. announces that it's going to really increase the size of each of their coupon offerings, the 10-year, the 30-year, the 5-year, at a time where we're not sure where the bid's going to come from.
Well, for me, I mean, it comes back to what we're seeing in the Middle East, right? I mean, we've just got a $106 billion proposal from the president to kind of fund the wars in Ukraine and Israel, et cetera. And for me, it's can this economy afford that, given the CHIPS bill and the Inflation Reduction Act? And, you know, Wednesday's a very, very important day. And again, it's not because of the Fed. I believe that the pause is all but priced in. That QRA is going to be something special, I believe.
And what will it do with yields? I mean, honestly, I think that one of the things the equity market might start to take solace in is the idea that the dollar stopped rising, that yields at least may have peaked in the middle of this month. If those peaks prove to be sort of the longer term peaks, that could add a lot of support to the equity market that we haven't had for 3 months long. So I do think what happens with long end yields is pretty important this week.
That's going to be something that I posed to Barry Bannister, a great place to start, Chief Equity Strategist at Stifel. Is it all about yields this week?
Well, I do think that the yields and the re-rating of yields has led to the de-rating of equities, and that's been a big issue for the market to deal with. If you look at the price of oil, where it is on a 3-month futures, it lines up very closely with what we call break-even inflation, 10-year minus the tips real yield. So that's about 2.5, and if you look at what the Fed's done on the rate futures, they've driven the 10-year tips yield up to about 2.5. So 2.5 plus 2.5 is why we have a 5% handle or close to it on the 10-year yield.
Basically, one of the questions is everything pretty much priced into stocks, right? I mean, if we sort of are volatile within a band that goes from 5% to 4.85%, and this sounds super technical, but basically we don't break too far out of that 5% level on a 10-year yield. Can you get enthusiastic about buying stocks, particularly those that have been most beaten up like small caps?
Small caps, international, and value relative to growth are all what we call one big trade. They tend to do well in a more reflationary and stronger economic growth environment. What we have been emphasizing is what's called cyclical value. These are things like capital goods, financials, transportation, basic materials, energy. And on the short side or the opposite side, your media, your entertainment, your internet, semiconductors, your tech hardware like Apple, autos, Tesla, 85% of autos is Tesla. These would be the shorts. Yeah, I agree with your earlier when you were talking about the seasonality. November 1st to April 30th, the cyclical value tends to beat the cyclical growth, and we're on that trade. But for the overall index level, no, not much more than 4,400.
When you talk about that trade cyclical value, Barry, what do you think is the catalyst to get that moving? Beyond seasonality, what are you looking for? Is it an earnings catalyst, a yields catalyst? What is going to drive capital into those riskier trades?
When you look at all the economic data that's available to us, and then you settle on the ones that statistically are the most useful, that we find the ISM PMI manufacturing index is just incredibly useful. Our target there by April of 2024 is 53. Over 50 is growing. And it's bottomed recently at 46, and it's headed towards 50. If that happens, then that's associated a 53 ISM PMI manufacturing with stabilizing wages. The Atlanta Fed wage tracker, the ECI wages and salaries.
goes to this question. If we start to see a real acceleration, what that does. We're going to talk about that with Barbara Reinhardt of Voya Investment Management. She's coming up at 8 a.m. She has been correct on stocks and bullish. Let's see if she's changed her mood at this time.
In global leadership are on Bloomberg.
The conflict between the U.S. and China has escalated so much. This is one of my greatest fears, that the small nation is forced to choose sides.
Bloomberg. Context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
From New York City,
in London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Earnings season is here.
Tons going on, lots of earnings.
Beat wherever you look.
Bloomberg breaks the numbers first.
It's a tale of two earnings. Results from Goldman Sachs, Bank of America, and Morgan Stanley.
Netflix is out, guys.
With exclusive expert analysis.
Recovery is underway.
They crushed it. It was one of their best quarters ever.
This is a story all about pricing power.
We're going to make more money. We're going to make more money. And we're going to make more money.
They're making bank. And I think that is what we can take away.
Bloomberg Television and Radio. Context changes everything.
We're going to move a standalone Israel funding bill this week in the House. I know our colleagues, our Republican colleagues in the Senate have a similar measure. We believe that that is a pressing and urgent need. There are lots of things going on around the world that we have to address, and we will. But right now, what's happening in Israel takes the immediate attention, and I think we've got to separate that and get it through.
Hearing from the very new House Speaker Mike Johnson speaking over the weekend on Fox, talking about a standalone bill rather than uniting the Israel-Ukraine conflicts together the way that President Biden has proposed. This has been a perennial question. How is this House going to pass anything at a time of such incredible division? The division is both in the U.S., it's also around the world, including in Israel. And joining us for team coverage right now, Bloomberg's Oliver Crook in Tel Aviv and Anne-Marie Herdern in Washington, D.C. Ali, I want to start there. Benjamin Netanyahu, the Prime Minister of Israel, an incredibly polarizing figure before the war broke out, came under a lot of criticism for some of the intelligence failures, did not accept responsibility, put the blame on some of his intelligence officials. How much is he losing the room? Is he losing the ability to lead at a really fraught time?
I mean, listen, the huge amount of pressure is building on the Prime Minister, Benjamin Netanyahu. And again, as you mentioned, the context in which this is all happening since this war broke out 3 weeks ago, before that, it was all about the rift within the society, which has not been healed, right? It was put to one side because of the war effort. Many of the people, the hundreds of thousands who went to the streets to protest against Netanyahu, rallied behind the war effort. And so for him to go out publicly on social media to basically divert the blame of the attacks and saying that basically it was a failure on his intelligence defense and the defense side of it rather than his own responsibility was taken extremely poorly, particularly when it was given after a joint press conference by the War Cabinet, which is composed in part from an opposition leader, right? That is supposed to be a symbol for this sort of unity. For him to go out and do that, he then deleted it. He then apologized. But again, it speaks to the heart of this issue within Israeli society and the mounting pressure on Benjamin Netanyahu. And then again, probably too early for this conversation, but the longer term, what will be the government that comes after the War Cabinet? Because this will be fundamental in shaping the future of Israel, but also its relationship with Palestinians.
And the division is not just isolated to Israel. Anne-Marie, over the weekend, a series of articles about how President Biden is losing some of his constituents, including in certain swing states like Michigan. Axios coming out talking about how some of the officials advising Biden think that it has never been worse politically for him. How does this sort of play out longer term and shorter term in your view?
Well, domestically, the president is still dealing with weak poll numbers when it comes to the economy. Things like inflation continue to top as a part of America's biggest concerns. And now he has another foreign policy crisis, this time in the Middle East. And one of the biggest concerns for this White House is to contain it. It's one of the reasons why it's going to be so interesting when Khalid bin Salman, the Saudi defense minister, comes to Washington, D.C. today. It is clear this administration wants to contain what is going on in the Middle East. But what you're seeing in a state like Michigan, which is a key swing state. And remember, Hillary Clinton lost Michigan by just over 10,000 votes. If the third-party candidate wasn't there, she probably would have won Michigan. This is critical for the Democratic Party. Biden has two issues in Michigan. One is the fact that there is a large population of the Palestinian diaspora, Muslim Americans. There's been a lot of reporting. NBC had a brilliant story out talking to people who said that we're just going to stay home. We're not going to go out and vote for Joe Biden. We feel like he let us down. There's also the UAW workers and those households. And our poll, when it looked at these swing states, showed that the former President Donald Trump is actually making headway into some of these UAW households, which is why Michigan is really an interesting state.
Talk to us a little bit, Anne-Marie, about flash forward 1 year. I know it feels like a long time from now, but we are just a year out from the 2024 election. How critical is this issue specifically in the election landscape relative to everything else that's going on?
I think there's too many questions still that remain to try to understand how important this will be on Americans' minds when they go out and vote in just over a year's time. But of course, the fact is, if this does become a wider regional conflict, this can have a tremendous impact on the election. Not just right now, we're talking about the Palestinian diaspora within the United States that potentially voted for Biden in the last election, but maybe will stay home in this one. But what does this mean if oil prices are higher? What does this mean if more Americans are killed in the line of combat? We did see that there's been an increase, an uptick of missiles that are hitting U.S. bases in Syria and Iraq. What if that continues, and what if this metastasizes? And if that is the case, then this could be incredibly difficult for this current White House and then the Joe Biden campaign to really go out and make their case to continue the presidency next November.
Anne-Marie, it's a loaded question. I know, but I'm going to ask it of you anyway. Where do you think the majority of Republicans and Democrats sit with Israel and Palestine? Do they support a ground war in Gaza? Do they support a two-state solution? I'm just curious to hear your thoughts. The average Republican, the average Democrat, what are their thoughts on Israel? What are their thoughts on Palestine?
There's a lot of bipartisan support to make sure that Israel has the funds they need to defend themselves. And that's what we heard from the new speaker, Mike Johnson, over the weekend. He says this week he wants to pass that aid to Israel, and he says he can have bipartisan support in the House. The issue, of course, that he has is he's coming up against more traditional Republicans who want to see the big package. You saw what Mitch McConnell said just the previous weekend, that there are bigger power struggles when you look at China and Russia, and the U.S. needs to be funding all of these national security concerns around the world. So bipartisan-wise, there is a lot of support on the Republican and Democratic side with Israel. You've seen a number of senators and congressmen and women actually fly to Israel since the October 7th massacre to make sure they are standing shoulder to shoulder. At the same time, you will hear politicians talk about the fact what President Biden has been talking about. They want to make sure that if Israel, and they already are going in on this ground invasion, that they are doing so by making sure they're protecting civilians, and also pushing for more humanitarian aid to get into Gaza, which this weekend was incredibly difficult.
From your perspective, Ali, on the ground in Israel, how much unity is there still as the war grinds on? I mean, we talk about keeping the room in the U.S., but how about in Israel?
I think that overall, you know, fundamentally, a lot of the Israelis see this as a sort of existential threat and not just sort of a rhetorically so. So I think there's, to a large degree, still support. There is some discussion and there is some disagreement about the amount of emphasis that's being put on the hostages. Of course, there are many people here who have family and people that they know that are still being held by Hamas. There is some concern around the idea that the military objectives might take precedence. And again, we have more than, the number keeps shifting, but 239 some odd hostages that are being held in Gaza by Hamas. So this is a sort of one of the main issues. But in terms of, again, it'll be interesting to see how it develops with Benjamin Netanyahu, and if he continues to distance people with the kind of pronouncements that he made over the weekend. Again, what is the alternative? The idea is that this war government will be in place until they reach their objectives. The question is how long is that going to be?
Oliver Crook and Marie Hordern, both of you, thank you so much for giving clarity to a highly opaque time. And I am continually struck, Damien, by just how sort of not clear some of the social media has been. And people who get their views from social media have gotten very distorted views. And it sort of seems like a different front for wartime information.
Myself included, by way of example, there was a protest in Grand Central Terminal just this weekend, right? I think, and if you look at the shirts, it says, you know, Jews in support of a ceasefire. So that's why I'm asking these questions. Do Jews on average in the U.S. want a ceasefire? Do they want war? I mean, what do people really want and stand for? The ambiguity is just so thick, it's hard for me to cut through it.
Yeah, and let's not forget that social media is specifically targeted to you based upon what you have historically consumed. So you're not necessarily getting the full unbiased picture. You're getting a very targeted view. And how true is this view, right? It's largely opinion-based in a lot of ways. It's targeted to you. So how much credence can you give it?
And
but yet, this is where people get their news.
I think it's a great point, too. It's targeted for people, which might be one reason why you're seeing the polls on either side get more extreme and less willing, maybe, to talk. Unfortunately, that seems to be somewhat the case. Coming up next, Andrew Sheets of Morgan Stanley is going to be joining us as we try to parse through some of the geopolitics and understand how much the nuts and bolts still matter.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one. Okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
There was a famous basketball player. In fact, he's in the Basketball Hall of Fame. Did you have any of his basketball genes?
You know, in my family, David, you didn't do very well at the family barbecues if you couldn't play hoops.
To start a big week up ahead. Welcome back to Bloomberg Surveillance. Tom Keene, Jonathan Farrell, Lisa Abramowitz, Tom and John still on the cruise. They will come back later this week. We are looking at a bit of a bounce. S&P futures up about 0.6%. What I find fascinating, though, is that the S&P has been down 10% since the end of July. The NASDAQ has been down 12%, and the Russell 2000 has been down more than 17%. Alongside me, I'm so glad to say, Damian Sassower, Gina Martin-Adams, as we parse through a tumultuous time, and that sort of question of whether we can buy the dip really feeds into what's the compass of the moment.
Yeah, and frankly, when small caps are breaking down to new lows, it is a very big sign of just how much risk tolerance in general is breaking down, which is intriguing because risk tolerance is breaking down at a time when earnings are actually showing a degree of resilience, and much better than expected results have certainly emerged out of the course of the third quarter earnings season. Nonetheless, the markets are telling you that nobody has any tolerance for risk, and it's really difficult to see where the catalyst for resumed risk tolerance comes from.
Again, you talk equities, I'll talk credit. 4-to-1, that's the ratio of downgrades to upgrades in credit this year, in U.S. credit. I mean, so it just speaks volumes in terms of what the fundamental outlook is on a forward basis. And I think going forward to next year, if you look at emerging markets, 7 of the major 14 sectors that I cover in EM credit are expected to have a negative outlook next year. So things are not getting better, they're getting worse.
We're going to get to that conversation with a fantastic guest, Andrew Sheets of Morgan Stanley, in just a minute. Under surveillance this morning, Israel expanding ground operations in Gaza over the weekend. The Israel Defense Forces saying over 600 militant targets in Gaza have been targeted, including a few retaliatory strikes in Syria. Internally, Israel's Prime Minister Benjamin Netanyahu is under increasing pressure to resign after a now-deleted social media post blamed the country's security officials for the October 7th attacks. Netanyahu has since apologized. It hasn't really quelled some of the ire in the population that already had soured on him. One thing you said, Gina, in the break that I thought was so profound is that you spend a significant part of your time trying to strip out the noise.
Yeah.
How much can you really look at this conflict and understand the way that oil prices do, what's noise and what's real?
Yeah, so the signal for the equity market is what's happening with oil prices, what's happening with yields, right? And if oil prices aren't moving related to the Middle East, that's a signal for what to expect for stocks. It's a signal for general sector strategy in particular, and especially for the energy sector and the likely performance of energy. It's very difficult. Where you run into a lot of problems is trying to assess the risk premium and trying to assess the impact on sentiment, because clearly risk premiums are widening in an environment where geopolitical concerns are so paramount. But when you look at the real data, if you can guide yourself based upon what the real data is doing, you can actually find opportunities in and out of the equity market.
Yeah, and I'll just build on that. The largest EM high-yield corporate issuer out there right now is Petróleos Mexicanos, Pemex. And in 2025, Pemex will be paying more in interest and in debt than it will be producing, and that will never change for the rest of its life. And that tells you everything you need to know. And it's the largest issuer in EM high-yield debt. So, yeah.
I imagine that you're not positive then on that name. Is that what I'm hearing for you?
Only if AMLO and Mexico come in and bail it out.
Bail it out.
Yeah, we're in a good place.
Let's talk about oil. Oil is sliding in reaction to Israel's new offensive in Gaza. Markets responding to the lack of a significant response from Iran or proxy groups, easing fears that crude supplies will be interrupted. Over the weekend, the U.S. and Iran traded warnings, including National Security Advisor Jake Sullivan, who said there was still an elevated risk of a spillover. I look at oil prices every 10 minutes to say, okay, now aren't they sort of perking up? And Damien, from your perspective, do you feel like the headlines that you read correlate to the price of oil? I mean, basically, does it make sense to you that prices would be coming down?
You know, no, it doesn't, because what's really different this time around is commodity currency correlations, right? I'm thinking, like you mentioned, like Noki, right? Norges Bank this week, Colombia. You know, a lot of the oil producers, their currencies in years past have really correlated well with commodity prices and with oil, and we're just not seeing that this time around. So I don't necessarily believe you're seeing a real fundamental link between the price of oil and valuations in the market.
Well, and you have to wonder how much of it is the demand side then. Is oil actually behaving because the expectation is that this acceleration in yields will actually tip the world into some sort of deeper recession? I mean, we've sort of pushed off the recession risk conversation again, and that concerns me, because maybe what oil is telling you is, yes, supply is constrained based upon what's happening in the Middle East, but if oil is not going up, it might be because demand expectations are actually deteriorating.
Really interesting. So otherwise you would see a pop, but just there isn't necessarily that kind of economic activity. Giving us some guidance about what they're seeing. It is a major week for global central banks and the less major ones that Dan will tell us about. But rate decisions we're getting this week from the Bank of Japan tomorrow, the Bank of England and Federal Reserve are also all due. Investors also looking to the Treasury's quarterly refunding announcement on Wednesday. That's going to set the stage for just how much the U.S. has to borrow and just whether we can absolutely absorb it. And then we'll get the U.S. labor market report with a jobs report on Friday, including a slew of other labor market data throughout the week. Andrew Sheets, global head of credit research at Morgan Stanley, is going to be on tenterhooks parsing through all of this. What's most important for you this week?
Thanks. So I think several things are important. I think that confirming that the Fed is pausing, and we do think that the Fed will not raise rates, and that can kind of further reinforce the idea that they are done raising rates for this rate cycle, which, you know, we think is important for generating and stabilizing bonds. And I think the earnings season remains very important. I mean, again, you had this kind of interesting dynamic where so far the underlying reported earnings are pretty decent, but the guidance has been disappointing. The market's reaction to that has generally been to punish misses pretty severely. And we've seen quite a bit of idiosyncratic risk coming out of earnings, single stock risk, which also matters. So those are two things that are at the top of our list.
You also mentioned at the top of your list that fiscal policy is key. Across the U.S., across Europe, across China, fiscal policy is playing an elevated role in market dynamics this year. Tell us about your views on fiscal policy.
So I do think the fiscal story is a really interesting one that affects, you know, the U.S., it affects Europe, it affects China. And so, you know, we focus on it in a couple of ways. I mean, my colleague Chetanaya, who's our head of Asia economics, you know, it's just some great charts that show just how much fiscal policy in China and the U.S. have diverged, where China's been tightening fiscal policy while the U.S. has been loosening it. We do think that in order to get more bullish on China, we do need to see a larger response, a larger fiscal response than what we've seen so far. In the U.S., I think the real key is how much can the states pick up the slack on the fiscal response side. I think there's a lot of focus, a lot of right focus on, you know, we have these large deficits, these unusually large deficits in the U.S. relative to the strength of the economy. But if you go below the surface, the state and municipality spending actually holds up pretty well on our forecast over the next 12 months. And that keeps, we think, the U.S. economy out of recession and stable even as federal spending pulls back a bit. But I think that's also really important, and really important of how you can get a soft landing even with so much fiscal support from the federal government in the rearview mirror.
And then how does this fiscal landscape actually impact your corporate credit strategy? I mean, obviously, as an equity investor, we're sort of engaged in this conversation somewhat, and there is a concern in the equity universe that some crowding out may occur as a result of these extraordinary deficits and high yields. Are you seeing any evidence of that? Is the fiscal landscape impacting your corporate strategy at this point?
So I think so far, ironically, you know, what's been happening on the fiscal side is I think it's been helping credit. And I think that's an absolute and a relative case. And in absolute terms, the fiscal support at both the federal and state level, I think, is reducing the odds of a recession, has supported the economy, and that's kind of obviously helpful for credit. But I think also on a relative basis, I think something that's been weighing on Treasury markets has been, you know, the income, the carry is low because the curve's inverted. You get paid more to hold T-bills than extending out the curve. And then supply has been very heavy, or expectations of supply are high. And then if you look at the corporate credit market, it's kind of the other way around. The carry on corporate credit is positive. The credit curve is positively sloped. And issuance has been really undershooting expectations as companies, which I think have more flexibility than the federal government to issue or not, are looking at these yields and we think are saying this is expensive borrowing. We're going to try not to do it to the extent we can. So you've seen less supply on the corporate market, especially the investment grade market, which we think is a relatively positive technical supporting that market.
Andrew, if you go back to, call it late June, early July, I think you'd be hard-pressed to find one fixed income asset class that was down on the year, but now we look at it and it's a completely opposite story here. The one asset class that stands out to me that is still up on the year is U.S. high yield. I'm curious to hear your thoughts on that, what's keeping it up, and whether or not it can sustain its current performance.
So that's a great point. I mean, I think U.S. high yield has been pretty remarkable in terms of how well it's held up on a relative and absolute basis. And I think with hindsight, it's been helped by the fact that yields have been rising, and generally investors, look to high yield as actually a better performing historical sector in rising yields at somewhat shorter duration. And then you've seen relatively little supply out of that market, especially because it's been so expensive for these more levered issuers. And so that's also helped technicals. But, going forward, and I think this has been a really key part you mentioned earlier on the show, you look at what's happening at breadth in the equity market. You look at the underperformance of small caps relative to large caps. And I think that's still actually a relatively troubling signal for the future performance of high yield. I think if the equity market is saying, look, we're getting incrementally more cautious on smaller, more levered, more cyclical stocks, as long as that's happening, I think it's hard to see the catalyst to drive further compression or more compression on spreads. So we think spreads decompress from here. We think that there's already a lot in the price of high yield's relative performance, even if we avoid a recession in the U.S., which remains our base case.
Just quickly, Andrew, how concerned are you that Japanese buyers in particular, big corporate debt buyers in the U.S. are going to pull back, especially with some of the adjustments we're expecting from the Bank of Japan?
So we think that risk so far is moderate, but we do have to watch it. Again, the return on a hedged basis for a Japanese investor into U.S. corporate credit is not good. So we do need to watch that. We do need to see still if the flows on an unhedged basis continue. Our base case is that they do, but I think that's something subject to what we might see this week.
Andrew Sheets of Morgan Stanley, thank you. I mean, to me, Damian, that's one of the questions underpinning spreads, because one of the biggest buyers, particularly investment grade, has come from Japan. How much are we seeing a shifting landscape? If full faith in credit isn't getting a bid, why is high yield?
Right, Lisa, no, I love it when you start talking about crowding out. That crowding out effect is real, and it's going to be meaningful here. And I think, you talk about the scarcity value, not enough paper in credit. Well, that's all fine and good, but eventually you're going to realize that, my goodness, forget about the crowding out impact. You're going to have to, it's just going to overwhelm a lot of investors, a lot of fixed income investors. I think we're starting to see that here.
Well, and if it's all about supply, aren't the people that actually want the loans, aren't the people that are actually looking to the market going to be the high yield borrowers?
Exactly.
So if it's about supply and it's really about just the issuance trends that are driving corporate credit markets at this point in time, then you've got to think longer term, what's the real viability of this debt? How sustainable is this? Because these are the weak players in the market.
Which is why everyone's talking about a maturity wall. Everybody's talking about what are these companies currently doing to extend that profile. And I keep hearing about all of the deals being done in private markets to extend current
it's all
deals.
About private credit.
It's all about private credit and all of that. But then all of that is kind of predicated on the idea that benchmark yields are going to go back down in the next 3 to 4 years. So that's something that we need. I'm curious about how that's going to
evolve. Still a lot of dry powder in private credit.
That's what everyone keeps saying. Right now in the markets, you are seeing people put dry powder to work, maybe in a buy the dip moment. 0.7% gain on the S&P. You could see even more when it comes to what we're seeing in the NASDAQ. Really, I am curious, though, when you talk about these dispersion, you talk about small caps and what's happened there versus credit. Is it correlated still, right? I mean, to me, who's right? Everyone talks about junk bond traders being the sort of smart guys in the room in terms of analyzing it. Would you beg to differ?
Well, sometimes it's not apples to apples, right? If you look at the small cap index and you look at the constituents in small cap equity, it's a lot of healthcare and a lot of financials. That's not necessarily the same story that you have in high yield, which historically the weakest players in high yield have always been the energies and the telecoms of the world, where you expect the default rates to go higher. And we're in a very bizarre universe where energy stocks have not borrowed too much money, or energy companies have not borrowed too much money. So I think that's part of what explains what's going on in high yield. versus what's happening in equities, it really is about healthcare. And nobody talks about this because everybody thinks healthcare is this defensive sector, but our view is healthcare developed a bubble in the pandemic, and we're seeing that bubble deflate very, very rapidly. And that is part of the reason why small caps have underperformed so materially, is it's just this, oh, wait, the pandemic seems to have gone away. We seem to have resolved our crisis. We overbuilt this idea that healthcare would be this huge portion of growth, and it isn't.
But Ozempic, isn't Ozempic going to save it all?
The weight loss drugs are not replacing the pandemic story.
Okay,
sadly.
Well, I don't know, maybe, depending on who you talk to. Everyone's going to take Ozempic. It's going to lighten the load in airplanes. It's going to make people stop eating fast food. It's going to do your laundry. Coming up, we've got Elliot Ackerman, a Marine Corps veteran and former White House fellow, as we try to parse through the machinations over in the Middle East.
I think this will probably go down in history as one of, if not the largest financial crime ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything. In a multi-trillion-dollar industry, there's a lot of ground to cover.
A record year of growth, hand over fist all year.
We're just getting started.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Today on Bloomberg.
I think the U.S. response has been measured. There's a deep sense in Washington that we don't want to be pulled into this conflict. I would be careful about looking at sanctions as having too much of an impact on the various adversaries at this time. You really have to ask yourself when you look at a specific sanction, does this touch the decision maker at the top of the pyramid of an adversary? And the sanctions that have been put in place against Hamas recently are important, but don't really meet that measure.
Norman Rule speaking, former U.S. senior intelligence official and senior advisor at the CSIS Transnational Threats Project, talking earlier about how the U.S. gets more involved from a financial perspective. Tom and John both off today. They will be back later this week. I am so glad to say Damian Sassower and Gina Martin-Adams alongside me today as we parse through how to understand what is noise, what is real, what has legs, what's an escalation, and really try to get our handle around the meaning behind the conflict that has been so divisive, so emotional, and so horrific based on the personal tragedies. S&P futures up 0.7%. You can see crude down 1.25%, partly because there hasn't necessarily been the hardline escalation that some people were expecting with the ground invasion. Joining us to understand all of this is Elliot Ackerman, someone with on-the-ground, boots-on-the-ground experience in Fallujah, U.S. Marine Corps veteran, former White House fellow, and co-author of the 2034, a novel of the next World War. I hope we are not entering into another World War. Elliot Ackerman, I want to get your sense of what you make around the fact that we have not seen a greater escalation and what the chances are for that at this point based on the measures taken.
Well, I think what we've seen is very deliberate military movements on the part of the Israelis. I mean, pretty soon we're going to be a month since the October 7th attacks, and we haven't seen them rush headlong into Gaza. And then we've also seen the United States take measures by moving two carrier battle groups and other forces into the Mediterranean to dissuade the Iranians or Hezbollah from coming in from Lebanon into the north of Israel. So this counter offensive is playing out in a really deliberative manner, and I think that so far we're seeing that is stopping this war from turning into a regional contagion.
Yet it does seem that most of the rhetoric or statements coming out of the region, Elliot, are about the war really continuing, or at least getting started, the ground troops really getting busy now, which would suggest that there's not a lot of end game in sight. It seems that we're getting going, and the assumption is that this is going to take some time to play out. Is there any resolution in your mind in the near term, or is this another war that we're going to contend with for an extended period of time in a very similar fashion to what's going on in the Ukraine?
I think there's a tendency when we look at wars is we focus a lot on the movements of ground troops and the real specifics, and that's important, of course. But it's also important to hold in your mind at the same time, the idea that war is politics. It's politics by other means. So what are the politics of this situation? And this attack on October 7th was, by all accounts, launched as a counter to the Saudis and the Israelis signing a peace deal that would disempower Hamas and put Iran in a very difficult position in the region. And so by basically forcing an atrocity on the Israelis, Hamas forces an Israeli response that causes that peace deal to collapse. So that's what we're seeing right now. So this kind of poses an obvious question, which is, who is the party that actually has the leverage at this point? Israel doesn't have a ton of leverage because they have to respond. Hamas is waiting for that response. I would say the people who have the most leverage right now are the Saudis. If the Saudis were to turn around and start renegotiating this peace deal at any point, it takes away all of the leverage that Hamas and Iran have created. And I think we have to, as much as there's a lot of discussion about the fatigue that the world is going to have when we start seeing the Israeli military operating in Gaza and the civilian death toll, I think there's also some fatigue that the Arab world probably has with the Palestinian question, particularly in the context in which Hamas is inflaming tensions. And could we see possibly a peace resumed out of the Arab world on this question?
Elliot, you're a former Marine, 5 tours of duty in Iraq and Afghanistan. The one question I have for you is, these tunnels underneath Gaza, how do you infiltrate these tunnels? I mean, what does that look like? I mean, I'm just curious, is there any precedent for that?
Well, I mean, there is historical precedence for that, but I can't emphasize enough just how challenging that operating environment is. A major urban center is the worst place that you want to be fighting. The closest analogy I can come up with based off of my experiences in Fallujah is it's like being in a knife fight in the phone booth. Everything happens at very close quarters and very, very quickly, and many of the high-tech weapon systems that armies like ours and like the Israeli army are invested in, they become much less effective because of the close quarters natures of the fighting. And these tunnels make it extremely complicated for the Israelis because they have to go in, they have to map out these tunnels, figure out where they are, and you also have hostages that are being held in these tunnels. So at the tactical level, you couldn't have posed a more challenging problem to the Israeli military. I don't believe it's insurmountable, but it's going to make it very, very slow going, and it forces them to act extremely deliberatively, which I think we've seen so far.
Well, you said that it's not insurmountable, and I want to really develop that point a little bit, because there were a lot of people saying, what does it mean to beat Hamas? Can Israel win this war? What does winning look like? From your vantage point, what does winning look like?
Again, I think winning, at least as the Israelis have defined it, is the destruction of Hamas and then some normalization or stasis in security in the region. So Israelis can continue to live in all parts of Israel, and southern Israel in particular. Now, when it comes to destroying Hamas, that is, it's going to take some work, but that is tactically viable. I think the question that is now, what do you do in Gaza? And do you face a protracted insurgency in Gaza? And I think when it comes to this idea of normalizing relations in the region, that's when we start to get into questions of diplomacy. Can Israel and can Arab partners negotiate with whatever the inheritors are of Hamas, whatever that Palestinian Authority is, to create stability in the region? We haven't gotten there yet. But again, what I'm seeing is we shouldn't underestimate the fatigue that also exists in the Arab world with this conflict, because it seems that this war was predicated on Hamas blowing up the best chance for peace that had ever existed.
You talked about how Saudi Arabia arguably has the most leverage in all of this. We do have a Saudi official coming to Washington, I believe, this week. Axios was reporting. I'm wondering what the goal is among some of the Arab nations that have the leverage, have the power. I'm thinking, yes, Saudi Arabia, but also maybe to a lesser extent, Qatar and also the United Arab Emirates. What do they want?
I think they want to live in a region that isn't plagued by this systemic war in Israel between the Israelis and the Palestinians, to allow peace to finally break out in the Middle East, and to live in a region in the world that isn't, when it's spoken, the Middle East, we don't immediately think conflict, war, in a place where, security isn't assured, that maybe the Middle East can start to look a little bit more like Western Europe. I think that is probably what they want. I think that's what everybody wants. And again, I think we shouldn't underestimate the fatigue that exists on all sides of this conflict.
Just 20 seconds. Do you think that their goal is for Israel to survive or not to survive?
I think their goal is for Israel to survive.
Elliot,
I do. I think it's difficult for them to say that, but yes, I do.
Elliot Ackerman, thank you so much for taking the time and giving us a sense. And Damien, you were talking about the experience, the boots on the ground of seeing what it's like and just how challenging this ground operation is going to be.
Yeah.
For everybody involved.
Yeah, and the American war machine is back up and running. I mean, defense spending here in the U.S. is up 4.9% in the year through September, right? So, I mean, it's not as if, people aren't throwing money at the issue and trying to figure a way through this. But I mean, I can't even imagine, what Elliot's talking about, the close quarter, fighting that's going to take place, and the deaths and the casualties is just going to be unlike anything I think we've ever experienced.
Yeah, this visual of a knife fight in a phone booth really will stick with me for a long time. And I do think that he makes an excellent point about just the nature of the operations in the underground tunnels, as you brought up. How are we going to respond to this? How ultimately does it resolve itself when our sort of wartime operations are mostly or air-centric now, or at least above-ground-centric? This is a new battleground effectively underneath.
Which raises the question about the budget that President Biden just put out there, right? That's where you're going to go.
It's all interlinked. What I was going to say is the decision tree. You think about these tunnels, right? It takes electricity to ventilate them, right? And Israel's cut off all the electricity to Gaza, right? For the obvious reasons. And it's just, it's just amazing. At what point does the rubber meet the road? At what point do you determine that you need to give aid, you need to give electricity to those who need it most, or are you helping Hamas?
And at the same time, the civilians caught in the middle who are experiencing a humanitarian disaster, and we see the pictures, and it's traumatic. Anybody who has, humanity wants the war to stop. The question is, how do you get there? And that's what people are arguing over. Coming up next, Barbara Reinhardt, Avoya Investment Management from New York. This is Bloomberg.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffmann arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the The CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
I think that we're going to see the peak in 10-year yields over the course of the next 2 or 3 weeks.
The soft landing is the most likely outcome.
My forecast is for slower growth. I think these higher interest rates have actually increased the chance of a recession.
We are probably within 50 basis points of a peak in rates.
There are winners and losers emerging in this new world we've moved into.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Heading into the last 2 months of the year, bonds and stocks sending slightly different messages. Welcome back. Good morning. This is Bloomberg Surveillance. Tom Keene, Jonathan Ferro, Lisa Abramowitz, Tom and John off today. I am so lucky that I am greeted with Damian Sassower and Gina Martin-Adams, who are still with us, even despite the fact that I had to up the bribe. I really appreciate you guys being there. It seems like a tumultuous week. And I started by saying, our bonds and stocks sending a slightly different message because we've been talking about this. It seems like bonds are saying strength and resilience. Stocks actually not so much.
Yeah, or stocks are just reacting to bond market yields. I mean, it's very difficult to say because it doesn't look like there's been a massive shift in the earnings outlook or the economic outlook to stimulate the decline that we've seen, yet sentiment was a little bit irrational in the middle of the year. And we've seen a major pullback as yields have accelerated quickly. So it could just be that this new correlation that exists now between equities and bonds is really playing out in a negative fashion for equities.
Yeah, no, and I mean, sentiment's just being one part of the equation. We get a lot of data this week. We get a U.S. data dump, we get ECI, we have payrolls, we have the Fed, we have the QRA. It's just going to be interesting for me to see how sentiment can hold up as well as it has in lieu of all this.
Let's parse through some of the acronyms. So we're talking about employment data with its employment cost index. We're talking about the potential for how much debt the U.S. is going to have to add to the current debt pile without the Fed necessarily buying. But we're also talking about just the nuts and bolts, the fundamentals of the economy and how central banks view that. What's most important? And we keep talking about this, and everyone says it's all of it, right? And then at the end of the week, everyone says it was the ECI that did everything. It was the University of Michigan Sentiment Survey. What is that one key thing that could really change the dial?
Look, I don't know that there is one, but one thing you didn't talk about is Apple earnings, and I'm going to keep coming back to the fact that ultimately stocks are the value of future earnings stream, right? So ultimately, you're getting an ownership in a company. What the companies do with their earnings will matter to equities. So Apple, being one of the biggest stocks in the world, is very important and consequential. We need to continue to see relative stability out of the earnings stream to really see stocks hold up.
But it points out that Apple and stocks are not the economy, because the stock market is basically Apple, Microsoft, Google, Amazon, et cetera. They're doing fantastically. Everyone else is struggling. How are you expecting to see that really play out in the other areas? And that, I think, is one of the key questions.
Yeah, no, I agree. I mean, it's interesting, though. It's not just about tech. It's about UPS, right? UPS is a good barometer of economic sentiment. And, UPS didn't even come in so healthy. So, I guess there's a lot to take away from earnings. But you're right. I mean, tech, I think that's the leader here. And to see what's going to happen this Thursday with Apple is definitely going to be a market driver.
And let me just reiterate something you said, Lisa, because this is something I think investors completely forget half the time, is the economy and the market are not the same thing. Earnings are not necessarily directly one-to-one related to what's happening in the economic data. You've got to really parse through the economic data for what's meaningful. Going back to another conversation we recently had, if you get caught up in the 250 different economic indicators that you're expected to follow on a monthly basis, you're going to miss a lot of opportunities in the equity market. What's really meaningful is really important conversation point.
Well, what's meaningful right now is markets are up, despite all of the uncertainties that we're talking about. And I guess that really goes to exactly the point, Gina, that you're making. Right now, it's the S&P futures up 0.7%, 41.65. Euro just gaining slightly, a bit of a bounce back after some of the losses versus the dollar last week, 105.85. 10-year yield is climbing. And this, to me, is going to be really interesting, especially throughout the day. We do get some initial guidance from the Treasury Department that refinancing is going to be key. Get some today. Wednesday is the full thing. 4.89%, crude off just a touch, with this feeling that at least we're not getting the same kind of escalation that people had expected with what's going over in the Middle East. But I keep coming back to, when are bonds going to act as havens again? When we start talking about all the headwinds, and stock markets are not the economy, but the economy is seeing headwinds. And that, I think, is what people are focused on, especially with the Middle East and the conflict there. Joining us now, Barbara Reinhardt, head of asset allocation at Voya Investment Management. Are Treasuries still haven?
We think that they are. We think that bonds are showing probably their best value in the better part of the past 15 years. Right now, on inflation index securities, you can get a 2.5% real yield after inflation if you hold the bonds to maturity. And we think that because real yields are now positive, they're back up towards levels where we would see they're acting like a ballast against your equity market portfolios. We think that correlation of returns between stocks and bonds starts to return back to some level of normalcy. This is the first time, really, since the global financial crisis that we can say bonds are material value for all types of investors.
So how do you really make that determination if it's not just about the fundamentals, but it's also about how much debt the U.S. sells? It's also about just where the buyers are going to come from. If the Bank Japan it really abandons yield curve control. How do you know? How do you parse out the dynamics of that, the technicals versus the fundamentals?
Look, it's very difficult to call the top in any type of market. Ask the most astute of investors, and it's an extremely difficult proposition. But we take a look at long-term fundamentals, and we also have a lot of good models that tell us about the trend of underlying economic growth and where that should be relative to bonds. And we do think that inflation is likely to continue to fall over the course of the next few quarters. We think that the Fed is getting very close to being finished at this point. Even if they were to raise interest rates one more time, you are likely in the part of the cycle where the Fed is finished raising rates. And we have studied this many times, almost all times, when the Fed has finished raising interest rates, within 12 months, you have had a significant rally in bonds. Lastly, you're also at a very good point on the duration curve. Right now, if you were to own a 30-year Treasury, and if yields were to go up by 50 basis points, you would only lose about 3%. If yields were to decline by 50 basis points, you have a gain of 13%. So there's this real magic to duration at this point, and it is very much in investors' favor.
Okay, so in an environment where bonds potentially rally, you're also in an environment where yields are positively correlated with stock prices. Can you make a case that bonds rally as stocks rally as well in 2024?
Oh, easily. I mean, look, you saw that type of sensitivity just over the course of September as well. Bond yields were starting to come down, and stocks were just rallying very hard at that point. I would say we're probably at the point of the cycle where stocks are in a bit more of a wait-and-see mode. Right now, you have sentiment that isn't necessarily in your favor to own stocks. The other issue, as well as breadth and technicals in the U.S. S&P 500 are not looking all that great at this point. You've got a number of stocks that are below their 200-day moving average, and you kind of need to see some of those things go back in a little bit of better favor to get that relationship where yields come down and stocks can indeed go up.
So, Barbara, bonds are back, and they once again can provide a ballast for diversified investors on the equity and fixed income side. My question is, the fixed income market is a $57 trillion market. So if bonds are back, where do I want to park my assets?
Well, so the way that we're thinking about it is we're buying longer duration treasuries at this point. That's where we think that the most value is. But there's an easy case to be made also that there are some very good yields to be had in, the high yield market right now is yielding over 9%. That's a significant, potential for total return and also, just interest rates and carry for investors. But what we're doing in our portfolios, and again, remember, we're managing for retirement, so we have a 40-year horizon. We're adding longer duration treasuries to our portfolios because we think that the yields to be had after
China this considering so much happening geopolitically around the world, and yet China-Taiwan is lingering in the background. Tell us your views on what's happening with China. Is there meaning behind the meetings this week that we should be reading into?
Well, Gina, as you know very well, every time the markets hear anything good from a U.S.-China perspective, and the current one is the prospect that Biden and President Xi Jinping might meet on the sidelines of the APEC meeting next month, the markets think this is a good thing. But in reality, China's been very blunt about is really through the national security law, through kicking a lot of Western accountants out, now through providing through a conference this week more evidence of state control in a variety of areas in financial services, is a world that as you all talked about in the last hour or so, where China looks increasingly uninvestable. And so I think the cat's out of the bag on China, and even markets are starting to figure out that there's not going to be any kind of long-term rapprochement between the U.S. and China. The best we're going to get is a situation where the competitors and the clashers understand each other well enough not to take the next step into a rising yet again geopolitical risk.
Terry, former Vice President Pence pulled out of the 2024 election this past weekend. Trump leads the polling in some of these early states. I mean, it's still early days, obviously, but I mean, I'm curious, do you believe we're past peak Trump? Is there anyone else in the GOP who can even make a run at him?
Well, I'll stick to my earlier views that I think we're a little past peak Trump. What you've got in the early primary states, Damian, is a situation where, the polls right now are basically 50% are in favor of Trump, which means 50% are against him. You probe into the Trump support a little bit more, and you've got another quarter to a half who can be convinced otherwise. And as you point out, it is very early days. We've got, basically 2.5 months before the first, almost a quarter of a year before the first primary season. So, my advice to markets is really twofold. One, stay cool on this till after the first of the year when you have some idea of what's going on, number one. Number two, I think what you do see is a continued winnowing down of the competitors. We're already basically down to three. We're down to Haley DeSantis and Tim Scott as the leading challengers. Pence understood he wasn't part of that, so he's very honorably bowing out early. But what you're going to get, I think, is a consolidation that happens earlier and provides a much more unexpected, from markets perspective, challenge to Trump than is now thought.
Terry, Mike Johnson is Speaker of the House, but is he the leading voice for House Republicans? And you know where I'm going with this, right? I mean, you've got Scalise, Emmer, Jordan. I mean, what happens to these gentlemen after their unsuccessful runs for Speaker of the House? People
tend to view new people in positions based on the people that were already there. So markets are very used to that, this strong speaker model, this kind of super majority leader position, whether it be Nancy Pelosi or McCarthy or John Boehner or somebody else. In reality, what you've got with Johnson is a situation where the party regulars, Scalise, Emmer, Jordan, are more empowered now than they were before, and they're really going to be leading the party much more than Johnson. That said, one of the things Johnson also said on the Sunday shows, which bears underscoring, is that they're looking much more seriously at extending government funding beyond November 17th than they would have been, say, a month ago. So, I have accordingly put my own odds back down to about 40%, but I think the political situation's volatile, and I'll be ready to put him back up again, if and when the Republicans fall apart.
Just quickly here, we're talking about the Republican side and the nominees for the election. Why was Gavin Newsom in China?
Ostensibly to talk about economic ties and all the rest. Really, what he's doing is trying to do what he can to burnish his foreign policy chops. There's a lot of sharks in the water now, and that wouldn't surprise me if Biden's feeling like a remora a little bit, and should they falter. And you saw evidence of that even with Vice President Harris's 60 Minutes interview last night. But Newsom wants to put him out there as the alternative, himself out there as the alternative. Republicans would love that because Newsom wouldn't get a vote outside the solidly blue states.
Terry Haynes of Pangea Policy. Thank you so much. Those video images were quite something when we saw, Damien, the idea of Gavin Newsom playing basketball with some kids in China. That didn't go over too well.
Well, I mean, look, he's no R.J. Barrett, he's no Jalen Brunson on the New York Knicks. But I mean, look, you know what I really wanted to ask Terry, I never got an opportunity to do that, is, with all this geopolitical risk that's going out there, all this mishigas, what is the pain trade today, the real pain trade for investors? Is it, something blows up in the Middle East? Is it, China-U.S. ties souring that much further? I'm just curious, what is the pain trade for investors today?
I think the pain trade is something positive. Notice that your pain trade was all of these potential conflagrations, more negativity. I think the pain trade is all of a sudden we get some resolution. That is certainly not in any consensus view.
I will take that pain trade any day of the week, so that's all.
I'm an internal optimist, Lisa, in case you didn't notice. There's a reason I work in the equity market.
That's right, and there's a reason why I focused on bonds, and I think
There's a reason I'm focused on emerging markets.
Can relate. He goes even further down. Coming up, Tiffany Wilding.
What did you learn in the last 40 years about leadership in politics?
Well, I've been learning a lot about leadership for a very long time, observing it in others, recognizing what is needed to get the job done. And I always define it in this way: know your why. You have to know why you're doing this, because you will be under attack, this for sure. Know your why, know what you're talking about, know how to get it done, think in a strategic way, and then that's all up here. And then also connect directly with people. If you can show them how important what you're advocating is and what you know you're talking about, so they trust your judgment, and you have a plan, you will have followers. You will be a leader.
The top names at the Fed are on Bloomberg.
The economy is handling much higher rates, at least for now, without difficulty. So notionally, that might tell you that the neutral rate has risen, or it may just tell you that we haven't had rates high enough for long enough.
The bond market has tightened quite considerably. If financial conditions are sufficiently tight, our work is not necessary because we don't need to boost them more.
Nobody covers the Fed like Bloomberg. Context changes everything.
60 Minutes minutes until the opening bell, and we can see a bit of a buy the dip continue today, led by the NASDAQ, although off some of the earlier highs. The S&P futures up 0.6%, basically just hovering around these levels all morning. We're looking at a bit of a sell-off, though, that is extending in the 10-year yield, which is interesting to me, 4.9%. It had been 4.86 earlier this morning, so the longer we wait, the more yields are going up. And crude off just a touch, given the fact that maybe there wasn't as much of an escalation and that Israel didn't have as aggressive of a land operation in Gaza. Tom and John both off today. Very pleased to say Damian Sassower, Gina Martin-Adams alongside me as we parse through what's going on this week. A real slow week, not much going on. Michael McKee, Bloomberg Economics editor here.
I don't know why I got up this morning.
Yeah. Why do we ever get up? No, this is a huge week. It's really pivotal to understand the inflection point for the economy, whether it has to do with jobs or whether it has to do with central bankers. What is the biggest surprise that you think is likely based on what you're hearing from whisper numbers and your economist sources?
I think most of the economic data will probably come in about as people anticipate. I think the big question this week is bond yields. Where do they go? Because there's so many things that can influence them. One thing people are forgetting a lot about is that the Bank of Japan is meeting tomorrow. And there is, according to folks like Kit Jukes and SocGen, about a 50% chance that they widened the band for yield curve control. And as the 10-year note yield continues to rise in Japan, that attracts money maybe away from the U.S. at a time when the U.S. Treasury is going to come out and talk about how much it needs to borrow. And so we could see yields rising even further, and then that has the follow-on effect in the economy that everybody is talking about from the Fed. They can stand pat because interest rates are doing the job for them.
We've clearly got the Fed meeting this week as well. So again, no shortage, along with a bunch of central bank meetings. How much is this yield rise that you're referring to going to be part of the discussion? How much is the bond market doing the work of the central banks already, I guess is the question. Yeah,
I think the Fed has pretty much told us that that's the way they are thinking about it. Now, they may have decided that they have done enough anyway because there is the lags effects that we're starting to see impact more of the economy. But with rates, market rates rising, that's doing some of the Fed's work for it. So their question is going to be, how high do the market rates go? But we know the Fed is probably not going to do anything. There's less than a 2% chance that they change rates at all. So then it's going to be what Jay Powell says. Does he suggest that they're done and they're going to just let the markets do their thing? Or does he suggest that they're going to keep their options open and leave us all more confused for a few more months?
So, Mike, I mean, I know you're focused obviously on the U.S. economy and developed market central bank activity exclusively, but there's a lot of emerging market central banks as well, right? I mean, we have Brazil who's expected to cut. We have Colombia who may cut as well, Czech, Malaysia. Do you care about any of that? I mean, and from an extension of that, let's talk about the Norges Bank, right? I mean, Norway has actually proven that as a developed market central bank, they are targeting currencies and currency levels as opposed to maybe inflation and growth. Talk to me about that.
Well, there are a few, Norges and maybe Denmark targeting currency levels, but the rest of the banks don't do that because it's too hard to do. I mean, you can't guarantee that what you want is what you're going to get from your moves. The rest of the world, I would put it this way: it doesn't matter to the Fed other than whatever feedback effects there are, but the Fed matters to the rest of the world. All these banks are reacting to what the Fed is doing because U.S. interest rates are setting the pace for the rest of the world. One interesting thing will be next Tuesday, a week from tomorrow, when the Reserve Bank of Australia meets, because they are expected to possibly raise rates. And they may be the only one of these non-big banks that are doing that. So that's something to keep an eye on.
I'm sitting here smiling because Damian, we're talking about all these other things, and he just is going to double down. What about those other central banks?
He will shoehorn those emerging market central banks into any conversation. It's amazing.
Yeah. Well, hold on. We talk about Norges Bank. We'll talk about Norway.
All right, go ahead.
No, you're right.
Look, Norway has proven that, look, and I mean, admittedly, it's in their calculus. They are targeting currencies. And Mike, with all due respect, a lot of central banks, whether they admit it or not, are targeting currency valuations and levels relative to the dollar. They can write it off as if they're targeting inflation. They can write it off as if they're targeting growth. But at the end of the day, they have no financial system if their currency falls out of it.
And there's a real question about how you target that at a time where it's unclear whether it's rate differentials or whether it's economic growth that's really driving some of those.
This is not a fun time to be a central bank.
No. So it's nice to be in the peanut gallery. Michael McKee, thank you so much for being with us, joining us now. Someone else who can join us in the peanut gallery to try to understand exactly how central banks are going to deal with this. Tiffany Wilding, economist and managing director at PIMCO. So glad to have you on the show. We were talking earlier, and Gina made this great point about how she thinks the pain trade is actually to the upside in equity markets. Things go better than expected. Earnings come in stronger than expected. Is it the same with economic projections, that the economy, if it reaccelerates, that's almost the pain trade right now, given where people are situated?
Yeah, I mean, I think some of that has been, quote, priced into the economics community's forecasts. I mean, you saw many economists that were penciling in a recession earlier in the year. And obviously, if you look at the consensus numbers, those have come up. I mean, certainly that can continue. And it's definitely been a risk that we've been highlighting as well. And in particular, the consumer, it's certainly possible the consumer remains strong. The consumer did basically reaccelerate their consumption and their purchases into the back half of this year. And it's a question of how interest rate sensitive the consumer is, and it's proving to be not that interest rate sensitive right now.
Which raises a question also, Tiffany, what's the connection between growth and inflation? Is there a sense that if growth accelerates, you can still see the disinflation continue that we've seen so far this year?
Yeah, I mean, so this has been a point that we've been trying to really hammer home, which is that it really, there'll be some continued disinflation as a result of, the fact that you're still getting, the product market side of the economy. So the side of the economy that was impacted by some of these supply chain snags, you're still getting some normalization there. But labor markets are incredibly tight. And you are still seeing a pretty decent amount of nominal income growth as a result of that labor market improvement. And so, we think you probably still need some labor market softening in order to just get inflation, kind of more truly back down to target. Yeah, so if you have an economy that's reaccelerating and a labor market that's strong, you should, these services, ex-shelter kinds of metrics that the Fed is looking at, those probably will start to reaccelerate.
Tiffany, what is the most important economic indicator you're watching this week?
Obviously the jobs number, is going to be incredibly important. Now there's going to be some noise around that because there was some strike activity. But I think, everybody's trying to figure out what the underlying trend in the labor market is. And as I mentioned, if growth, so the Federal Reserve needs to target growth that's under potential. So that, call it like around 1% is what the Fed is hoping to target in order to cool the labor market off. Growth right now looks like it's running at 2.5, 3. So it is well above that, which suggests the labor market's going to remain strong. So obviously we'll be looking at that. The wage number within the labor market report is obviously going to be very important as well. But overall, we've said if the data flow continues to be as strong as it was in September, certainly the Fed is probably going to want to keep its options open to hike more. But we think the SEP could maybe even take out cuts for 2024, just to try to keep those financial conditions tight.
And where do you think what is the impact on financial prices then? So you've got the Fed likely to pause. You've got data still coming in reasonably strong. What are financial markets to do with this kind of data?
Well, I think it, obviously kind of good news should be bad news in some sense, right? Because the Federal Reserve is trying to cool off the economy. And ultimately the way they do that is through tighter financial conditions. And whether that's, higher interest rates or, a decline in equities, maybe wider credit spreads, all of those things, that's how you cool off the economy. And so if the economy remains strong, then that's what we need, more pricing like that in order to cool things off.
Tiffany, there's been a lot of focus on the quarterly refinancing announcement. My question for you is a simple one. Is the supply story in U.S. Treasuries already reflected in the price?
Yeah, I mean, I think this is a key question. No, I think it's actually broader than the refunding. I mean, clearly Treasury has had a big refunding need. They've been trying to increase coupons, as a result of the fact that, they have this bigger need and they were really ramping up bills. Now they're moving into coupons. I think the bigger issue here is that good growth, better growth expectations is actually increasing people's expectations for supply. And that's counterintuitive relative to usual experience, because usually you have higher tax revenues and that reduces financing need. But right now, you have central banks that can just continue to reduce their balance sheet for longer, or the Bank of Japan, which really pulls away from buying JGBs, that results in more expectations for supply globally, and that's increasing term premiums.
Yeah.
So I think that is going to continue with the refunding.
I mean, Tiffany, you're right in the wheelhouse here, talking about the crowding out effect from Japan to the U.S. I mean, foreign buying of treasuries, where does the demand come from? The Fed's no longer backstopping things. Talk to us about demand for U.S. treasuries on a forward basis. Who is that marginal buyer? Who's that marginal risk taker?
Yeah, I mean, that's what everybody's trying to figure out, right? And the problem, I think, one of the issues is that, you kind of go back to 2014, 2015, 2016, where you had a good amount of bond yields that were negative, and really the U.S. was the only game in town. Well, now with interest rates just across the world much higher, it's possible to get positive yielding assets outside of the United States right now. Some diversification of portfolios as a result of that is probably reasonable. So I think it is the question of who's the marginal buyer, but not only who's the marginal buyer, but what price are they willing to pay, and what yield do they need to get in order to come back into the bond market.
Tiffany Wilding of PIMCO, thank you so much for being with us. And Damien, to your point, I think it's a great question, which is what's priced in, where are the buyers going to come from, do we understand the technicals? We really don't know, and we really haven't seen bonds performing in the way that they usually do.
And for me, it comes down to the fact that you look at a 10-year real yield at 2.42%, just how high can that go? I heard no way we're ever going to see 2% in 10-year real yields, and here we are, 2.4%. I mean, it's just mind-numbing, 100 basis point move since mid-July.
So I'm going to ask you, Gina, how many people who do you talk to, stock investors, saying, should I buy bonds?
A lot. A lot. I mean, honestly, it's at 4%, they were saying, well, we've got to start nibbling in. And then it was, 5%, my God, maybe 6% we can even get bonds at. So it's a big part of the conversation. And this is what I call Tara instead of Tina, just to, speak my own book for a moment. The old moniker, there is no alternative to stocks, is completely gone. It's now there are reasonable alternatives to stocks. And it comes up a lot. The allocation story comes up a lot. It's a big reason why investors are all concentrated in the biggest stocks in the world is what's happening in bond yields has changed the game.
Yeah. Right now, in bond yields, we do see a bit of a lift to the yield as we get older in the session. If you are just joining the program now, 4.9% on the 10-year yield. S&P futures up 0.6%, 41.62. But this is something that people are looking at, Damien.
Yeah, no, I mean, the earnings yield on equities relative to the nominal yield for treasuries. I mean, that is the big, everyone is looking at, and they're saying, wow, you can get a higher yield on treasuries than you can relative to just dividend yielding stocks and equities. It's just interesting to hear that the people you're speaking to, Gina, are actually focused on that.
It is, and it's also interesting, though, that companies have not recognized that they could easily deploy their capital in the form of a dividend to increase that dividend yield to improve their relative appeal. This is something I find fascinating in the U.S. equity market. We're still sitting at a dividend yield of 2% on U.S. stocks. It's just so not appealing, not attractive, not interesting at all. And to the degree you can get yield, it's usually in more distressed entities or rate-sensitive entities, those that are bigger borrowers. And so investors who are interested in playing a yield story are forced into the bond market. There is not really a yield opportunity in equities unless you go to repurchase yield, shareholder yield, where they have found some degree of yield opportunity. And again, that points you back to big cap tech. So it's a bit frustrating that corporates haven't migrated relatively quickly because there's a lot of cash that could be deployed sitting on S&P 500 balance sheets. It's just sitting there.
Yeah. It feels like the whole market's been holding their breath, saying, all right, when can we just say this story is over? Yeah. We can write the book on this chapter and go back to a normal that we know. And suddenly, over the past couple of months, that's changed. And suddenly people are saying, wait a second, what if this is it?
Yep.
What if this is the new normal? And that starts to become dividends, and that starts to become extending maturities. And that's where you start to have real discussions of what does this world look like in terms of investing and in terms of corporate finance. Coming up, we talk about how oil plays into this space, especially given the Middle East. Amrita Sen joining us of Energy Aspects.
used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one. Okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
Season is here.
Tons going on, lots of earnings.
Beat wherever you look.
Bloomberg breaks the numbers first.
It's a tale of two earnings. Results from Goldman Sachs, Bank of America, and Morgan Stanley.
Netflix is out, guys.
With exclusive expert analysis.
Recovery is underway.
They crushed it. It was one of their best quarters ever.
This is a story all about pricing power.
We're going to make more money. We're going to make more money. And we're going to make more money.
We're going to make them bank. And I think that is what we can take away.
Bloomberg Television and Radio. Context changes everything.
Slice through the noise.
Forget the noise. Ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
The industry is still recovering from the impact of the pandemic and the lower levels of capital that have been going in across the industry to offset the depletion that's been happening. And so supplies are fairly tight. With respect to the Middle East, what I'd say, it is still an important region in the world. And while to date, the tragic events are not manifesting themselves in an impact, that's something we're keeping a very close eye on.
That was Darren Woods, Exxon CEO, speaking with our own Alex Steele and Guy Johnson last week after coming out with earnings. A real question mark around some of the consolidation that we've seen in that space, and we will get into that in just a minute. Tom and John are both off today. They will be back, though, later in the week. Damian Sassower and Gina Martin Adams both were the unfortunate people who had to join me this morning, and we are the lucky ones that get to enjoy their insights. I do want to just go through a couple names that stood out to me as we went through the morning. Meta today is popping just a touch after reporting that they are planning on offering people in the EU as well as Switzerland the opportunity to pay for a monthly subscription using Facebook and Instagram without any ads. Since it's faded, it was up about 2%. Now it's down about, it's up about 0.8%. But this all goes to monetizing and this idea that people hate ads. So how do you get around that? So do they maybe profit on that? SoFi is interesting because they said that their online lender increased its revenue forecast for 2023 and more than tripled the number of deposits. What do you make of this? The shares are up more than 10%. Gina, the fact that you are seeing some competitive edge for platforms that actually pay interest in a way that the banks aren't.
Yeah, no, I think it's very interesting, especially because this is a smaller entity and no one has wanted to take any risk in smaller banking enterprises in the S&P 500, God forbid, the small cap index. So it could be a sign that maybe things aren't quite as bad as consensus had anticipated. You still are getting the deposit growth. There still is this lingering concern in the market about what that means ultimately for the balance sheet and how much unrealized losses those deposits ultimately create over time. But it could be a sign that maybe we've gotten to a point where we were just irrationally far too pessimistic about what's going on in finance.
Meanwhile, over at McDonald's, and I'm going to go to you on this, Damian, this to me is really interesting. They came out, they beat sales and profits on both numbers, and it's because sales are increasing as they raise their prices. This has been the story pretty much across the board. We've seen this with Coca-Cola too. Those shares up 2.6%. How long can we keep seeing that kind of pricing power?
Well, I wonder if that's indicative more of the fact that people are stepping down in terms of they're not going to restaurants as much anymore. They're stepping down to McDonald's or Burger King or some sort of lesser restaurant venue in order to eat, right? In order to consume. But to your point, the margin story is not going away. I mean, just listen to Gina Martin Adams. Every other word out of Gina's mouth is margins. No, I'm kidding. But
it's very true, actually. I own this. I own it, Damien.
The margin queen. No, I mean, look. I mean, again, I think margins are important in this environment. I think it's going to be really interesting, though, to see how some of these other consumer-oriented, consumer-focused companies report on earnings.
And right now, definitely, the input costs are a real question, how they're going to meet those. One of those input costs, very much energy at a time where there's sort of dueling points. And I'll take your point, Gina, about are we seeing a lack of a response to some of the geopolitics because the demand just isn't there. Amrita Sen joining us now, founder and director of research at Energy Aspects. And I want to take her question because it is such a good one. Are we seeing a muted response in crude to the geopolitics at the moment simply because the demand is also falling in tandem?
Yeah, I think it's a great question, and I think the right way to frame it is that. But also, there are no direct risks to supplies, and that's probably what's made it very hard for oil to rally. Yes, the region, again, home to the largest reserves and production of oil. But if there are no direct threats, how do you price this in? This is precisely why we've seen a lot more activity in the options market than in flat price. People can't short this market, but the macro picture has deteriorated quite significantly since, I would say, the last couple of weeks. And we have been kind of seeing some of this coming, not necessarily, sometimes a lot of these kind of factors all come together. The European and US demand numbers definitely are weaker. So I think all of that together just means that, crude's probably going to remain range bound for now. Not much of geopolitical premium in the price.
Can you talk to us a little bit about some of the other energy products? For instance, natural gas is heading into pretty seasonably favorable time of year. The fundamentals, according to our Bloomberg intelligence analysts for natural gas, are improving fairly materially. Where are you seeing natural gas prices headed going forward?
Depends on the region, of course, but if you think about European natural gas prices, they have gone up quite a bit, and weirdly, the Middle Eastern conflict has actually led to some supply losses through Israel and Egypt, of course, lower supplies of LNG effectively. But the market remains well supplied, and unless and until we get a really cold winter, we aren't expecting a huge increase. Prices are already trading significantly higher than the 10-year average, of course, much, much lower than last year's levels, but that is to be expected given that storage is much higher. But also, remember, industrial demand in Europe has not just been temporarily removed because of high gas prices from last year, but dare I say probably permanently reduced. Combination of very high energy prices, lower economic growth, but also the Inflation Reduction Act in the US that has taken industry away from Europe to the US. Again, even in the US, natural gas prices, yes, slowly ticking up given the just seasonally, like you said as well, but industrial activity isn't really all guns blazing right now just because of the economic backdrop.
Amrita, I want you to put your options hat back on for me. I mean, if you look at implied vols across FX, rates, equities, it's actually been pretty well behaved, I would say, over the better part of the last few months. Talk to me about what you're seeing in Brent crude volatility. I know Pemex had its hedging program that may have skewed things a bit, but what are you seeing in terms of vol risk premia, the term structure of volatility in the crude market?
We have seen that pick up. To your point, it had been well behaved, but just over the last couple of weeks, we've had both bond and oil vol pick up. And, we're coming to year end for a lot of trading companies. It's between October and December. And if you've had a good year, why would you necessarily put on a lot of positions, regardless of your views, bullish or bearish, and risk losing some of that when you have to close your books? And I think that's one of the big challenges we are seeing with volatility, and that's exactly why we are seeing more options pricing, because of course people want to have the exposure of what if something happens, but not necessarily trade in futures. If you look at liquidity in the futures market, that has really shrunk in the last couple of weeks.
Amrita, before we let you go, tomorrow is Halloween. You talked about $100 barrel oil by Halloween. We're looking at $89 Brent. We're looking at $84 WTI. Do you still think we could get there? Or, I mean, why haven't we gotten there, despite some of the expectations people had?
Yeah, I mean, look, we were almost there, right? We were 97, 98 Brent. I think what has happened with the Middle Eastern crisis in particular is it's actually taken quite a bit of risk out of the market. The demand picture, again, it's been deteriorating. I don't think that's necessarily been a significant change. But if you take away liquidity from the market, of course, ultimately you need buyers to push these prices up. I still think there's a very solid floor for crude around 90, but we do need to get both liquidity coming back and a bit more, because I think one of the big concerns now we are seeing on the demand side is both Europe and US demand starting to come off more aggressively than we have seen in the first half of the year. Perhaps just because people's savings are running out, or just because we are seeing some of those seasonal factors come through as well. But that's one of the things we are monitoring.
Amrita Sen of Energy Aspects, thank you so much. Exactly to the point, Gina, that you were making, that maybe this is a demand story more than anything else.
Yeah, you just have to wonder. And we have seen, for sure, we've seen PMIs in Europe decelerating pretty rapidly. Most of the developed world is having PMIs crash at this point in time. Emerging markets are still a little bit mixed, but U.S. was already down there. So U.S., we're maybe even climbing out of our lows, but the rest of the world seems to be capitulating to some weakness.
I mean, I agree with Gina on the demand side of the story there, but one thing I just want to, a point I want to make, JP Morgan, upstream oil and gas spending is on track to reach $545 billion this year, up from $497 billion in the whole of last year. So as much as demand is a part of the story, there may be a supply component to it as well.
Yeah, very interesting, especially at a time where there is consolidation. Coming up on the Open next hour, George Concalves of MUFG, Sanal Desai of Franklin Templeton, and Dan Skelly of Morgan Stanley. And don't miss this, Balance of Power today at 5:45 p.m. Eastern. Lael Brainerd, Director of the U.S. National Economic Council. A really important conversation for that. And I just want to thank both of you. I know that it's always a long week, this week especially, and you both took the time, and it's great. I'm sure you really enjoy kicking off your week this way with incredible energy.
The best way to start a Monday.
Oh, yeah, something like that.
6 cups of coffee, great.
Yeah, exactly. No, I mean, I think that it's going to be interesting, and we should reconvene after this week and say what was the most important thing. It's going to be some small indicator.
It won't be anything we discussed today, sadly, but we'll find it.
It's going to be a meeting that someone had that hadn't been scheduled, and they're going to come out, and it's going to change the whole paradigm yet again with a new narrative. Right now in markets, you are seeing a bit of a buy-the-dip moment again, although kind of range-bound here, fading a little bit as the session grows older, up 0.5% at 10-year yield, 4.9%.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Expecting there to be not necessarily a wholesale adoption across the world, but we have many governments that are looking what the EU is doing and are in the process of introducing similar regulations or variants thereof. Then I think it'll be very interesting to see how these global companies will adjust their business practices. Will they implement the obligations of those regulations only with respect to Europe, or whether they do it globally? And sometimes it may be very difficult in today's conversation environment about which is more hostile or more skeptical of the big tech companies. If Facebook, for instance, cannot use targeted advertising, or Instagram cannot use targeted advertising on minors in Europe, can they then justify that they continue that very same practice in the United States and elsewhere? Because there will be many who say, well, you have ceased those activities in Europe. Don't you care about protecting our minors as well? And it is harder for reputational reasons for Facebook, for instance, then to confine its conduct and the changes it will have to make to Europe alone. So I think we will see some ramifications of those regulations outside of Europe as well.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
From New York City for our viewers worldwide, I'm Lisa Abramowitz in for Jonathan Farrow. Lift the market after a down week. Correction for the S&P and NASDAQ. Can we recover? The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
Coming up, futures rebounding after falling into correction. Israel slowly widening its ground invasion of Gaza with Fed Chair Powell and the payrolls report on deck. We begin with the big issue, bracing for a big week ahead.
Markets have a lot to digest in terms of central banks, in terms of events, in terms of macro data.
The Treasury refunding announcement.
We're only less than halfway through earnings season.
We have those key central banks, the Bank of Japan, the Bank of England.
The Federal Reserve will have a more hawkish hold from the Fed, beating that drum of higher for longer.
They are also not talking about rate cuts, and we are not expecting rate cuts to come.
It's this give and take that the Fed has to manage.
The continued strength of the economy actually handcuffs the Fed.
The economic data in the U.S. has been quite resilient.
The resilience of businesses, the resilience of the consumer.
The labor market that is just, very strong.
Still extremely tight.
It all comes back to jobs.
The labor market is the key right now.
Joining us now to discuss is Morgan Stanley's Dan Skelly and George Goncalves of MUFG. I'm old enough to remember when it was all the Fed every single time. This time, unclear. Dan, what do you think is going to be the most important aspect of a very busy week?
Sure. I think the Fed, Lisa, for sure. And I think continued readouts on earnings, which, so far we're about halfway through earnings season. The numbers themselves have actually been pretty solid. Comments have been solid, but guidance and revisions haven't really held up. And so while you haven't seen certainly a collapse in earnings, and that's consistent with the economy that's been resilient, you just aren't seeing enough upward movement on revisions to justify valuations. And this is a theme, Lisa, Morgan Stanley's been talking about for 3 to 4 months.
And we're going to get back to that in just a minute. George, I know that you actually disagree, and you think it's really going to come down to the refunding agreement by the Treasury Department, the announcement that they put out. Why is that going to be arguably one of the most definitive moments?
Hi, Lisa. Yeah, look, I think one of the reasons why, and we heard it from Chair Powell a few weeks ago when he was at the New York Economics Club, the Fed basically has outsourced monetary policy to the Treasury. I mean, we have the bond market, doing a lot of the heavy lifting. Term premium has risen, and its back up in long-term rates is one of the reasons why the Fed probably will skip hiking this meeting.
Right now, we are talking about the potential for some sort of earnings revisions downward, which is exactly, Dan, what you were talking about. Michael Wilson coming out over the weekend, reiterating his bearish view on equities, as he has been talking, saying chances of a fourth quarter rally have fallen considerably, narrowing breadth, cautious factor leadership, falling earnings revisions, and fading consumer and business confidence tell a different story than the consensus, which sees a rally into year end. Dan, some people are saying there already has been a really dramatic sell-off in specific sectors, albeit not at the headline level. Why do you think there's still more to go, even with some of the carnage that we've seen in small caps, in banks, particularly the smaller ones, and consumer discretionary?
Well, Lisa, I would also add to that, the generals have finally been sold off as well. When you look at mega cap tech over the last week or so, you are starting to see a pretty pronounced impact from that sector as well. So listen, we're not in the camp that we're going to see a dramatic sell-off from here, but we think we could certainly see more mixed results. And this remains, as Mike has talked about, more of an idiosyncratic bottom-up opportunity in stocks than it is for the index level, right? And so when you think about the idiosyncratic opportunities, Morgan Stanley's been talking about the data era leadership, the move to industrial application of technology for years, long before AI became the euphoric headline this year. I was catching up with Katie Huberty recently, who runs our research department, previously our Apple analyst. And this theme of this tech diffusion across different sectors continues to be a high conviction idea. So once again, Lisa, it's more an idiosyncratic opportunity from here.
Which raises a question about the overall index getting challenged and how much that really does stem from yields. George, from your vantage point, how much do bond yields up, priced down, really reflect the risk aversion that we're seeing under the hood in those select areas?
Look, I think long duration plays, which a lot of these longer duration tech companies have been closely aligned with rates, really. But over the course of the middle part of this year, there was a decoupling between some stocks, these high flyer stocks, and the Treasury market. Now I think we're recoupling. Having said that, we've had a hard time breaking above 5%. We've kind of broached it a few times on the 10-year, and until we actually clearly break above 5%, I think it's going to be hard to say that we've seen the top in yields yet.
So, George, is that what you're looking for, a technical level, or is it something specific, whether it's the Bank of Japan and understanding the reaction function, or understanding what yields do in response to the potential for the U.S. to sell more debt?
Look, we've been on this view of the higher supply, driving term premium, driving bear steepeners, really since July. And I think the thing is, a lot of it's priced in. We finally got positive term premium. The curve is at least disinverted to a certain extent. And we do get the quarterly refunding on Wednesday before the Fed. I mean, a lot of news probably is priced in. Unless we get a lot more supply, perhaps we get some relief here, and we'll just start trading in a range. However, if we do get a bigger supply announcement than what the markets are expecting, and markets are really fearful of who's going to take down all this paper into year end, when balance sheets are getting very precious.
Which raises a question, Dan, how much lower yields are good for equities that have been a bit beaten up by higher yields, and how much they're bad based on potentially negative economic news. From your vantage point, could you see a scenario where yields go down and that actually gives a boost to equities?
You know, it could, certainly for that kind of Big 10, Big 7 mega cap cohort that has very much traded in line with yields over many years. So that's number one. Number two, however, I think the story around labor resilience and tightness in labor, tightness in the housing market, and housing prices holding up, I think these stories are going to start to fade away as we go into year end. Frankly, when you look at 5% plus real growth in the third quarter, vis-a-vis higher energy prices, finally the lag effect of higher rates impacting consumer financing, the exhausted savings. And when you look at the fact that rents, market rents in the shelter environment are going to have to catch up at some point, and we'll see that slowing as well, the reality is that the market's going to care more about growth going forward, right? So I think this whole idea about inflation staying higher for longer is going to start to fade, and we'll start to see stocks and sectors correlate more towards growth.
Meanwhile, investors gearing up for a busy week ahead, as we were mentioning earlier. Key central bank decisions, a Chair Powell news conference, and the latest payroll report all in the pipeline. Joining us now to parse through this incredibly dull week with nothing going on is Michael McKee. As always, Mike, it's incredibly important to understand not only the events, but the reaction to them. What do you have your eye on?
Well, the reaction is going to be the issue, because these events are widely anticipated, and you only put up a few of them compared to what's actually going to be on the calendar. Don't worry, I'm not going to put up more. I'm going to talk about the ones that are really going to matter and could get the biggest reactions in the markets. Now, the Bank of Japan is going to be interesting because they're not expected to change their interest rates, but they may tweak yield curve control. And we'll talk about a little bit more about why that's important in just a second. But the Fed and the Bank of England, also meeting this week, aren't expected to do anything. Those are probably fairly well priced. Treasury refunding, this is obviously the story everybody is following. And you've seen a lot of notes from people saying that this is going to be the big one of the week. Depends on what the Treasury decides to do. Do they go out on the curve? Do they sell more bills? And how much do they have to sell in each of those tenors? The Powell news conference, like I said, the Fed hasn't decided to do anything, but does that mean they're done? That's what everybody's going to be looking for Jay Powell for, some sort of guidance when he has his news conference. And then the October jobs report, just because it won't have as big an effect on monetary policy because the Fed will have met 2 days before that. But it will be another piece of evidence that tells the market whether the Fed is going to have to come back or not. So we'll watch that. Now, yield curve control. This is important because the Bank of Japan's had it in place, capping the yields on 10-year notes since 2016. But look what's happened. We've broken out of that range. The bank has slowly let the band for trading widen because the markets are putting pressure on them. And as that yield goes up, that attracts more money out of other countries like the U.S. into Japan as the U.S. is trying to sell more stuff. And then here's the issuance total. As you can see, the interesting thing here, Lisa, is all the way over on the right-hand side, how volatile that has gotten as the U.S. deficits have risen. And we just got a revised deficit figure of over $2 trillion for the year not too long ago. So there's going to be a lot of sales of debt, and the market has to absorb it all. And with all these other things going on, as they said before I came on, who's going to buy all that?
Michael McKee.
And at what price, of course,
exactly.
is the issue.
Michael McKee, wonderful as always. Thank you so much. If your head is spinning, you're not alone. Dan Skelly and George Goncalves are still with us, and I want to go to you. This idea that we've been playing narrative roulette. Dan, you put very well this idea that growth will take the lead in terms of the driving narrative going forward, and I want to dive into that. But George, do you agree? Do you think ultimately it's going to come down to growth and not necessarily supply and not necessarily central bank shifts in policy overseas?
I think over the medium term, I agree with Dan. I think that we are going to be pivoting towards growth concerns. I mean, we've been slowly entertaining that idea for the last couple of months, but we get these episodic moves up in inflation and energy-driven sort of spikes. But once we get past that, I do think that the growth story is going to matter more. There's the real risk that the consumers have been outspending their savings, outspending their actual wage growth, and they're really going to be left with a pretty big bill in early 2024 to cut back on spending. And that plus corporates facing with really high interest costs and having to roll over debt, they're going to have to start preparing for that in 24 and 25. So the longer the Fed stays on hold, the more likely these long and variable lags are going to really hit home.
Dan, one thing I was talking about with our own Gina Martin Adams was that the biggest pain trade right now is the opposite, that growth reaccelerates on some level and that you start to see earnings really do better. How much is that a potential scenario that you've gamed out?
It's a scenario. We would argue it's fairly limited in nature. Once again, 5% plus from the summer quarter with all of the music concerts, all of the movie excitement, much lower energy prices at that point, much lower rates and looser financial conditions. This is a tough cocktail. And so, look, market, to your point, markets certainly can be surprised. When we look at the rally from October of 22 to July of this year, that was all about disproving the recession consensus. The correction from, call it, July to today, that's been all about disproving this notion that interest rates, higher rates didn't matter for valuation and in rising uncertainty around the Fed being done or not. But we would say, look, it comes back to this idea that it's going to be tough to sustain those growth rates. And again, we're still in the soft landing camp. To be clear, Ellen Zentner, as you know, our economist, made that call back in January of 22. She's been in the soft landing camp for a long, long time. And now she's penciling in barely 1% growth in the fourth quarter. So again, in our view, we have to be a little bit mindful here of taking just too much risk.
Dan Skelly, George Goncalves, both of you are sticking with us. Let's take a look at some of the stocks moving ahead of the opening bell, plus some breaking news that we just got. Here's Abigail Doolittle.
Yes, Lisa, we do have breaking news, and that is our own breaking news, that GM has tentatively reached an agreement with the UAW to settle the labor discussion. They are, of course, to end the strike. They, of course, were their last holdout, and it was thought to be around retirement benefits. I'm still looking for details in terms of what the exact deal was, but, of course, Ford and Stellantis reached a 25% pay agreement. So we will see what exactly it was that perhaps created this tentative deal. But you can see the shares of GM truly popping higher. And in sympathy, Ford is gaining as well, up 1.2%. And again, as we have more details, we will be reporting those. As for some other movers on the morning, we are taking a look at McDonald's popping on a very strong quarter. They beat comp sales in a big way by more than 1% or about 1%, 8.8% better than the estimate, having to do with pricier burgers, Lisa. We have Meta popping higher on the news that they're offering ad-free Facebook and Instagram in Europe for a fee of $9.99 to €12.99. So it seems as though some of these social media companies are really moving toward a subscription model. And then finally, WDC, the computer and storage company, is splitting to two publicly traded companies based on business lines. They also beat numbers. Sales by 8% earnings by 8%, sales by 2%, the stock up more than 20%. And again, just to recap the breaking news, GM is said to have reached a tentative agreement with UAW to end their strike, similar to Ford and Stellantis. Those stocks are popping higher this morning.
Abigail, thank you so much. Coming up, Israel entering a new stage of the war with Gaza.
We are seeing elevated threats against our forces throughout the region and an elevated risk of this conflict spreading to other parts of the region.
From Israel and Washington, D.C., our team coverage continues next.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power.
This is Bloomberg.
The United States will follow through on what we say we're going to do. We said that if our troops were attacked, we would respond. We responded. If they're attacked again, we will respond again. And we are vigilant because we are seeing elevated threats against our forces throughout the region and an elevated risk of this conflict spreading to other parts of the region. We are doing everything in our power to deter and prevent that.
The Biden administration saying the risk of spillover from the Israel-Hamas war remains elevated. This as Israel begins its so-called second and longer phase of war against the terrorist group, expanding its ground offensive into Gaza. The U.S. and other allies pressing Israel to be more specific about its aims as millions of displaced Gazans wait for humanitarian aid. Meanwhile, Speaker Mike Johnson expecting the House to pass an Israel aid bill this week.
We are going to move a standalone Israel funding bill this week in the House. I know our colleagues, our Republican colleagues in the Senate have a similar measure. We believe that that is a pressing and urgent need. There are lots of things going on around the world that we have to address, and we will. But right now, what's happening in Israel takes the immediate attention, and I think we've got to separate that and get it through.
Let's get to our team coverage. Bloomberg's Oliver Crook in Tel Aviv, Anne-Marie Hordern in Washington, D.C. Anne-Marie, I want to start with you. How realistic is it that what Mike Johnson is talking about could pass?
Well, it's realistic that this will pass the House. There's going to be bipartisan support largely for standing with Israel and sending over funding. This funding, though, he also in another interview alluded to this would be more than $14 billion, actually exceeding what the White House requested. The issue that's going to happen in Congress, of course, is that this does not only put Speaker Johnson head-to-head with the White House because he is trying to separate Israeli aid as well alongside what the White House wanted was aid for Ukraine, Taiwan, and other national security interests around the globe, but also with Senate Minority Leader Mitch McConnell, who also wanted to see a bigger package. So there's no doubt in my mind that Congress is going to be able to pass aid to Israel in a bipartisan fashion, but potentially this becomes a problem because he is trying to really decouple it from that broader package.
In the meantime, meantime, we've seen troops build up around Israel from the U.S. There's another war tanker that's coming over to the Mediterranean. Ali, from your vantage point, how much is Israel relying on some of the deterrence from U.S. troops? How important are some of those personnel that are coming to the region?
I mean, I think it's absolutely critical, and it's been absolutely critical since day one. And the U.S. support for Israel and the Israelis is very present in their minds. And, you know, it was a big symbolic gesture for when President Biden came here. A number of senators have come also as well. But again, and their whole stance, their whole policy has been a one-word policy of deterrence. It's don't, but it's backed up by, you say, 2 carrier groups in the Mediterranean, just behind us, in the waters behind us. And that is just right off of the coast. And those troops on high alert. And also relying on that military aid, but also the replenishing of Iron Dome, which Israel is deeply dependent on to take some of these rockets and missiles out of the sky that are falling regularly on its territory.
Oliver Crook and Marie, both of you, thank you so much, as always, for wonderful reporting. Still with us, Dan Skelly and George Goncalves. And I want to dig into the ramifications from this. A lot of people are talking about the oil ramifications. George, I want to get your sense from the spending, the defense spending, the military kind of heft that the U.S. is looking to ramp up. How much does that affect how you're kind of gaming out the next 6 to 12 months?
Look, I mean, military spending, of course, is one of the largest components of our budget and the deficit, and it's been a big driver of it, as well as interest costs, which I think is also critical to focus on that. But I don't think it's big enough that it's going to necessarily deter or reduce sort of spending. But of course, it just means more Treasury supply.
Which is a reason why a lot of people are focusing on that angle. Dan, is that kind of the angle that you're taking with it? How are you watching this conflict to try to parse the noise from the signal, at least when it comes to a market's point of view, putting aside, and it's always hard to do this, but putting aside the human tragedy, which is very real and unfolding in very much real time?
Yeah, absolutely. I mean, the tragedy is just completely awful. To your point, I think looking at the market and the economic impacts beyond that, I think, George made a good point earlier in terms of that 5% level on the 10-year not really holding. And I think you are starting to see people come in, too, in terms of this risk-off uncertainty as well, come into the bond market. So, that's the way we're looking at it. When you think about it, hopefully here, obviously not broadening out into a broader scale issue, which for the time being is the market's interpretation. Oil is up only modestly since the attack happened in Israel. When you look at, the equity market, you've seen some loosening in valuation. You've seen some credit widening, but not a ton. And so for the moment, the market is saying this won't broaden out. Iran has something like 3 million barrels of oil production a day post the sanctions loosening up. So that is certainly the key variable to watch for.
George, have you gotten that sense, too, that people are buying treasuries as a haven this time around?
Look, I mean, historically, as we've seen any sort of geopolitical tensions, treasuries have always typically benefited. But what's been interesting this time, you kind of have this weekend effect where treasuries rally into the Thursday, Friday, and then we kind of give back the gains and rates rise on Monday like we're seeing today. So I'm not really sensing a big flight to quality yet. And as Dan pointed out, and hopefully this does not escalate and it does not broaden out. Hopefully that doesn't take place. And so long as it doesn't, then I think that treasuries won't really benefit from this. But it goes back to the growth angle and what the Fed does next. And I think that this is why you kind of juxtapose where we are in the cycle. We're probably seeing the best of it. That Q3 growth probably was the most growth we're going to see for quite some time. And so the 2-year. Probably if there is a flight to quality, it's going to really be the front end of the Treasury curve that's going to benefit more so than 10s.
When we talk about the growth story, and just to sort of wrap it up and bring it full circle, Dan, from your vantage point, what are you seeing that gives you confidence that growth really will be the story and it will be slowing?
Yeah, I think it has to do with just stock reactions, right? When you look at companies that are talking up their growth revisions, they're talking up their opportunity set, you're seeing some positive reactions. For the majority of companies that are not talking about the future in that regard, you're seeing a pretty dramatic sell-off. And oh, by the way, that was the story in terms of last quarter as well. And so I continue to think there's fairly efficient pricing going on within the equity market. Last thing I'll say, Lisa, is in a world where you have growth slowing, geopolitical tension, I think the premium, the necessity for companies to provide unique data-driven or technology-driven upside is key. So productivity is really the key underlying theme we continue to look for, both within the U.S. and globally, right? The Big Seven get all the headlines, all the acronyms, but they are the enablers of productivity. we're also looking at sectors like healthcare and industrials and manufacturing that are utilizing AI and big data to become more productive as well.
On Thursday, non-farm productivity, to your point. Dan Skelly, Georgian Goncalves, both of you, thank you so much for being with us. Coming up, the morning calls, and later, looking ahead to the Fed, Franklin Templeton, Sunal Desai, expecting rates to stay higher for longer. That's next.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside? Time now for our morning calls. A look at some of the analyst recommendations this morning. First up, Raymond James downgrading Cisco to market perform, seeing risks to the company's full-year sales outlook. Next up, Truist downgrading Newell Brands to hold, expecting at least another year until the company returns to organic growth. And finally, Bank of America upgrading Chevron to buy, saying recent declines look overdone. Coming up, Franklin Templeton Sunal Desai joins us ahead of a busy week for central banks. That conversation coming up next.
Do you think there's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, or mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea. But technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Countdown to the open. I'm Lisa Abramowitz in for Jonathan Farrow, moments away from the start of trading, and you can see a bit of a reprieve after what we saw last week. A pop of 0.7% on the S&P. NASDAQ also up 0.7%, so kind of pulling back basis of where we were before. Outside of stocks, you can see in the bond market a bit of a sell-off. Basically yesterday, or last week I should say, we saw a bit of a bid into the bond market. This year, maybe this week, year, that's where we are right now. 10-year yields 4.89%. Crude off as people look toward a perhaps less hard escalation in Israel. And the euro just gaining slightly versus the dollar, breaking that 106 mark after losing some ground last week. One stock to watch at the open, McDonald's third quarter sales topping estimates thanks to higher prices. The CEO saying, quote, "The macroeconomic environment is unfolding in line with our expectations for the year. We remain confident in our future and the strategic direction of our business." Abigail Doolittle has more on expensive burgers. Abby.
Yeah, indeed. And it's interesting, Lisa, because they put up a very strong quarter. Adjusted earnings did beat by about 6.5%. Those came in at $3.19. Sales comps came in at 8.8%, a full percent better than what had been expected. What's interesting, though, is it did come on consumers accepting higher prices, that pricier burger. But there's headlines coming out of the earnings call right now, and there's sort of some mixed messages. So they're talking about expecting to see the tough macro to continue, inflationary pressures. But they're also talking about the idea that consumers are still accepting price increases, but they're saying that they are benefiting from a trade down from pricier options. So if I'm reading this correctly, it sounds as though some consumers are willing to pay up and that the ones that are not are trading down, and it is benefiting McDonald's. On the year, Lisa, this stock basically flat, but today it is getting a pop, up about 1% off of its highs, but nonetheless the best day in about 2 weeks on this solid quarter.
Abby, thank you so much. Sticking with earnings, SoFi increasing its revenue forecast after deposits more than tripled from a year earlier. The CEO saying, quote, "Our deposit funding also increases our flexibility to optimize returns, a critical advantage in light of notable macroeconomic uncertainty." Here to translate what that actually means is Bloomberg's Katie Greifeld. Katie.
Hey, Lisa. Yeah, SoFi surging this morning on the heels of that report. Let's start with deposits because that's the big headline here. Deposits more than tripled from a year earlier to $15.7 billion in the third quarter. Now, analysts had been looking for $14.9 billion, so a big beat there. And not to mention, of course, more than 90% of those deposits are from direct deposit members, as the CEO called it, high-quality deposits. All told, SoFi added more than 700,000 new members in the quarter. That is a record. And, of course, the company also boosted its revenue forecast for 2023. So a lot to like there. And, of course, SoFi, it's been traditionally been known as its student loan refinancing business. Of course, it's since expanded beyond that into financial services. But on the topic of student loans, CEO Anthony Noto said that the resumption of student loan repayments should have a slightly bigger benefit in the fourth quarter. You add it all together, SoFi having its best day since July, and I double-checked this a few times. It's up about 66% so far this year.
Wow, Katie, thank you so much. Turning now to autos. Just breaking this hour, Bloomberg reporting that GM has reached a tentative agreement with the UAW to end the strike. Here with us to have the crack reporting on the autosphere is our very own Matt Miller. Matt, what's the latest?
Yeah, so GM is the last of the big three to make a deal with the union. Of course, all of this still needs to be ratified by union members, but GM was a holdout after Ford agreed with the union to resume work on Wednesday of last week. Stellantis over the weekend on Saturday, and that had put a lot more pressure on General Motors. GM had a lot more temporary workers than Ford. At any given time, 10% of the people working for General Motors in this country are temporary workers, and Ford and Stellantis had offered what amounts to 150% raises to those workers. That's one of the things that was a sticking point for General Motors. Also, it has the most employees that are due for retirement benefits, 300,000, so that was another one of the sticking points. But all three have agreed to give 25% raises to hourly workers, including cost, or not including, there's an additional cost of living allowance that's going to go in there, and that would amount to 33% increases in pay over the 4 years of this contract. So, as I said, it still needs to be ratified, but it looks like this strike is now over. Remember, it started on September 17th, so we're in the 7th week of this strike, and it's caused a lot of financial damage. Ford last week saying $1.3 billion in terms of damage to the bottom line.
And maybe it's now over and we can reassess just how much damage overall it has done and just how much the workers have gained. Turning to tech now, Apple is hosting an event highlighting its Macs and M3 chips today ahead of its earnings on Thursday. Ed Ludlow has more. Ed.
Week, and the market needs to decide what's more important to them, the Fed on Wednesday or Apple. That's the debate playing out on the Bloomberg terminal. We're up a full percentage point. In the event dubbed Scary Fast, we're expecting a big focus on Mac, a new iMac according to Bloomberg's reporting, and an updated version of a high-end MacBook Pro. We also expect Apple to debut its latest generation silicon, the M3 chip, its PC processor. Then move forward to Thursday when we get Apple earnings. The expectation is that overall we see a 4th consecutive quarter of sales decline for Apple. You have to go back more than 2 decades to see Apple having 4 straight quarters of sales declines. But within that, we hope to see some bright spots, particularly in expanding Mac sales, which is why tonight's event is so relevant. Bloomberg also reporting, citing third-party data, that in the first month of its sales since launch, the iPhone 15 is struggling in China compared to the previous generation iPhone 14. According to GfK data, iPhone 15 sales are down 6% when compared with the first month of sales of iPhone 14 ago. The expectation is that this is a kind of weaker but improving market. IDC estimates say that in the 3rd quarter just gone, Apple shipments were down 4% overall. It's a stock that the market's watching, not just because it's proportionate weighting on the index level, but because it gives us this kind of forward-looking or crystal ball lens into the health of the consumer in very key markets, Lisa. Big week.
Ed, thanks so much. And big week indeed. And you ask, what's more important, Apple earnings or the Fed? And I'm going to ask that question of Franklin Templeton's Sanal Desai, who's joining us now. So, Sanal, I want to start there. What's more important for this week? Is it going to be Apple earnings or is it going to be the Fed?
You know, something that's quite likely to be the Treasury. It's been a long time, but I think the market will be more focused on Apple. There's a limited amount the Fed can do right now, which would surprise the markets, except for doing something extremely unusual, which would be shocking if they either ruled out completely future rate hikes or actually raised rates, both of which are highly unlikely in my view.
So you say Treasury refinancing is going to be the most important. That's also coming Wednesday, and a lot of people have been mentioning maybe it's going to actually trump anything the Fed says. From your vantage point, you have been discussing your outlook for the volatile bond market, writing, quote, fixed income is delivering attractive yields again, playing its traditional role as a portfolio diversifier and income generator. How much can you double down on that without knowing the response of bond markets to a potential increase in the amount of debt that the U.S. is selling?
So, you know, the U.S. is selling a lot of debt, but I think the market is in the process of internalizing that. Can we see more of a long-end sell-off? I think actually you probably could. But on balance, there is an asymmetry here. The extent to which you could get a sell-off is unlikely to be as much as we have seen so far. To a large extent, the degree to which we've seen what we've seen and the speed at which we've seen it, I believe has a lot more to do with where we started, which was with bond markets which were massively overvalued and far too focused on the Fed essentially jumping in, bailing us out, and very quickly reverting for the last 15 years when Fed funds was very low and you had buyers of last resort all over the place.
So at this point, when you're looking at a different kind of paradigm, how do you view bonds as a portfolio diversifier? You're saying that they are attractive right now, given how much yields have gone up. But 60-40 hasn't worked. It's not worked again. No. And a lot of people are saying if bonds rally, actually, you could see stocks rally and vice versa. So at what point can we go back to that kind of concept of diversification?
So I think what has been really difficult is how volatile the bond market has been for so long as the market continues to play off this concern about what is the Fed going to do and perhaps a continued hope that the Fed is going to dive in at some stage and admit it's made a mistake and bail us all out. I think the moment the bond market actually realizes that's not the game or the playbook that the Fed is using this time, we might settle into, dare I say it, a more boring bond market where rates are higher and there isn't any anticipation of a sudden massive rally to make capital returns. I expect to get boring returns from bond markets next year, which would be positive but boring in the sense that, 5-6% yields in investment grade quality credit. This is attractive levels. As long as you're not dreaming about getting those high single digits, double digits from high quality bonds, which people have managed to get for many years, apart from last year and this year clearly, I think that it is a good time to start considering coming into bond markets and anticipating they play that role. And in terms of readjusting, I think bond markets have gone further perhaps than equity markets have. I'm not an equity market specialist, but I think bond markets have already moved a long way in the right direction.
Which bond markets, right? I mean, because we're talking about investment grade credit, we're talking about treasuries. We're not talking about high yield. We're not talking about riskier parts of credit that have actually eked out gains this year, despite all of the red, the sea of red everywhere else. So how do you justify the idea that risk is still attracting capital at a time where people are pricing in capital costs, interest expenses that really are unsustainable for a lot of these corporate models?
I think if you look at high yield bonds, which are yielding over 9%, it is attractive. You're looking at low dollar prices, and a lot of people have an appetite for that kind of risk. And indeed, a lot of our clients do. And if you're looking, if your horizon is 12 months to 18 months, this is perhaps not a bad area to venture into at these levels. But it is undeniable that high yield markets are not pricing a recession. Investment grade probably is. And our preference right now probably would be to remain higher in quality and move in the direction of high yield as we start seeing spreads widening out a bit more wholesale. In a sense, certainly there are attractive single opportunities. However, as an asset class, high yield would not be our number one call right now.
Chanel, a lot of people are looking at a lot of central bank decisions, and we haven't talked that much about the Bank of Japan. I do wonder about the buyers for a lot of credit that we see in the United States. And Japanese investors have traditionally been huge buyers of investment-grade credit, but also lower-rated debt. How much are you looking at the flows to understand the dynamics, and how confident you can be in some of these investments?
I think it's a big issue. But right over there, again, for a very long time, we've not looked at supply issues, i.e. the deficit. We've definitely not looked at demand issues. And if you look between the Fed, which still, after over a year of QT, the Fed still owns over 25% of the Treasury market. If I look at just the Treasury market, the Bank of Japan is the second highest holder of Treasuries, not China, as many people think. And China only comes in at number 3. And then, of course, you have the fact that you can't exactly measure how much some of these countries are holding. But for a variety of different reasons, the Fed, because it simply stopped buying, Japan, because chances are of the next few meetings, if not already this week, we're going to see the direction in which JGB yields are going to go. And I believe they're going to go up higher, which will take away an element of support for the Treasury and IG markets. And finally, if you look at China, certainly there are fewer surpluses to essentially channel into, recycle into US Treasuries. From a demand perspective, I think both the supply and the demand picture doesn't look very attractive in the near term for Treasuries. However, treasuries have started pricing in a lot of this. I do think there's still scope for yield curve steepening. But again, like I said, it's a bit more asymmetric now. We've come a long way, at close to 5%.
So does that mean that you're much more aggressively buying?
What we are doing is beginning to lengthen that duration. We've been short. You've watched us go through neutral, and now we are beginning to start the process of going long. We're not getting in completely long over our skis yet, because I think actually we could see treasuries go higher from here.
Sonal Desai, thank you so much. Sonal, wonderful to catch up with you at a time where we're seeing yields very much in focus. Coming up, GM following Ford and reaching a tentative agreement with the UAW.
This contract is more than just a contract. It's a call to action to workers everywhere to organize and fight for a better life. The auto workers at Ford just won a major battle in the fight for a better world.
The latest on auto labor negotiations. The strike appears to be over. That conversation coming up next.
And the markets are on the move.
The focus, of course, is on Ukraine.
The market is so hyped up about AI.
Unless we see dramatic changes, it's just going to keep getting hotter.
The Fed, the market analysis. We're going to go get straight to some breaking news.
We'll have a full roundup.
Going through some of the numbers and what investors should make of them.
We have so many important conversations. Let's check in what you need to know.
Paul Jacobson assured me that when he takes the new Hummer EV on long journeys, it's not just fun to drive, it's equipped to go the distance.
I hear so much about road trip anxiety that I wanted. Family likes to drive a lot, so I brought my daughter home from college in this, and it was great. I mean, the computer system is all intuitive. It tells you how to keep track of the battery. It tells you where the charging stations are. It tells you how much power you'll have when you get to the charging station. So it really puts a lot of your anxiety at ease. But as far as driving it, it's a treat.
So where are you on the charging stations? I know General Motors has made an investment in one company. How are we doing in this country generally in getting charging stations in?
So I think this is an area where obviously we can continue to improve as a country and a society. We're doing our best. We've committed almost $1 billion to EV charging. So we've taken that and looked at home charging solutions, local community solutions, and road trip charging solutions. With my daughter, what we would end up doing is probably stopping, grabbing a bite to eat, plugging it into a charger, usually a high-speed charger, to get as much charge as we can, and being there for 20 to 30 minutes. Get us a lot of range, and by the time we've used that range, we're tired, ready to stop again, etc. So it was a really good experience for me, and it's taught me, number one, what are the concerns of the consumer that are ultimately going to drive our vehicles, and then number two, where do we need to focus on addressing some of those anxious points for people?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This contract demonstrates the incredible power that workers have when they are not afraid to use it. This is why your national negotiators, the UAW Ford National Council, Vice President Browning, and myself wholeheartedly endorsed this record-breaking agreement. We went to Ford with the goal of not leaving a dime on the table, and we accomplished that. The UAW is saving the American dream, and we are doing it together.
That was UAW President Shawn Fain celebrating a pending deal with Ford and what he's calling a huge victory for the union, touting the contract's economic improvements, job protections, and $8 billion in plant investments. The union also moving forward with tentative agreements with Stellantis and GM. Let's get some coverage from Bloomberg's Kaylee Lyons in Washington, D.C. Kaylee, what do we know about just how tentative some of these arrangements and deals are?
Well, this is still a very new report, Lisa. According to people familiar with the matter who've spoken to Bloomberg, what we do know, though, is that the wage figure looks very similar to the agreement that the UAW, of course, first struck with Ford, that 25% increase in cost of living adjustments as well. What is unclear in GM's case specifically is what exactly the retirement benefits may look like, as that had been a sticking point why this of the big three automakers was one of the holdouts here. But what this likely will bring is an end to the strike. Of course, this still will need to be ratified fully by the union, but this has been a long-fought battle. We're 7 weeks into a strike here at this point, as it started just in mid-September. And of course, you have a focus here in Washington on it as well, as President Biden has been a pro-union president. He has called himself the most pro-union president in history. We did get a statement out from the White House over the weekend on the agreement that was reached with Stellantis, which of course was on very similar lines. He called it a groundbreaking contract that rewards auto workers. He went on to say it's a testament to the power of unions and collective bargaining. And we certainly are seeing once again, Lisa, that it seems the hard line Shawn Fain was driving actually got the automakers, all three of them, to where the union ultimately decided they wanted to be on the wage figure.
Do we understand, you mentioned the wage figure, that's exactly where I wanted to go, how much of the sticking point was the headline wage number and how much were the benefits and some of the other asks by the UAW?
Well, we know a lot of those asks, Lisa, are just more difficult for the automakers to swallow, considering the legacy that comes with them. A lot of the things that the union initially was asking for in terms of pensions and retirement benefits are some of the very same causes that led to the bankruptcy of two of these companies back in the post-financial crisis era. So some of that was more difficult. And again, that retirement part of the equation, we understand to this point, at least to this morning when we got news of a tentative deal being struck, was one of the real difficulties for GM. So we'll look for more details on that. The wage figure is really where we saw a lot of the headline movement over the course of these negotiations that have been, almost 2 full months now. The idea that the union came out and initially wanted 40%, slowly worked their way down. But our reporting here at Bloomberg had been 25% is what the union was looking for. As of just about a week and change ago, they had gotten the automakers up to 23%, and it seems they finally closed that bit of distance. But certainly on the headline, especially considering those are pretty big headline figures, but these are workers who have said that they have not had their wages keeping up with inflation for a long, long time now. Wages was something they were really pushing on.
You're covering this from the viewpoint of Washington, D.C., and I do wonder how much this is going to bear into the election. It is still a while away, and if it's already concluded, does this mean that the union goes back to being more Democratic, or does it sort of be more purple the way that it was during the election prior?
I think when we're looking at the UAW, Lisa, you almost have to look at union membership and union leadership, because we know union leadership, Shawn Fain, is no fan of former President Donald Trump, who, of course, looks like he may very well be the Republican nominee. And yet the endorsement has always hung in the balance that though Biden was invited to strike at the picket line earlier on in Detroit with these automakers, there were union members, at least theoretically, who may have been more supportive of Donald Trump. So certainly the idea of the labor movement is going to factor in this election, but also just in terms of thinking about the economic consequence. For President Biden, yes, he wants to be pro-union and have the support of unions going forward into 2024, but he also needs a strong economy, as he consistently has struggled in that department. And the longer the strike went on, the greater economic impact it could potentially have, as well as potentially disrupting the EV transition he has pushed so hard on.
Well, exactly that. President Biden coming out just moments ago and saying, I think it's great about union and car maker deals. So I think it's great about the union and car maker deal. And this sort of speaks to what you were mentioning before, Kaylee, that he is touting himself as the most pro-union president ever. Just finally, on that point of the electric vehicle transition, do we have any sense of what the thought is about what this does to that and to the wages on that front, in the EVs front, that weren't necessarily as involved in some of these negotiations?
Yeah, we'll have to look into the details of the contracts for that, Lisa. But really what it comes down to is not just the wages, but the idea of job security, that as these automakers are transitioning from the ICE era, the internal combustion engine era, to electric vehicles, in which some of the jobs just are likely seen as not being paid enough, that it's just going to be different. Job security going forward was a really big sticking point here. And that's actually one of the arguments you were hearing the likes of Mary Barra over at GM make, the idea that they have to retain profits so that they can continue to invest in that future, but keep union jobs in that future. And that has been one of the difficulties. And again, Lisa, we'll bring more details always as they come.
Kaylee, thank you so much. As always, coming up, the market-moving events that you need to be watching. That's next in our Trading Diary.
I think this will probably go down in history as one of, if not the largest financial crime ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Bloomberg's The Open. I'm Lisa Abramowitz in for Jonathan Ferro. 26 minutes into the trading session, you can see the gains building. 1.3% gain on the NASDAQ. S&P gaining by more than 1%. Yields still higher, but coming a bit lower on the day. As you can see, it was up earlier more than this. Time now for your trading diary. You need to be watching this week. President Biden speaking at 2:30 Eastern on his executive order for AI protections. Tuesday, we'll get U.S. consumer confidence, plus the BOJ's rate decision. Wednesday, an FOMC rate decision, followed by Chair Powell's news conference. Thursday, U.S. data includes jobless claims and durable goods, plus, of course, Apple reports earnings after the bell. And Friday, the October payrolls report, and we didn't even mention the refinancing agreement on Wednesday, which may end up being the most important event. This was Countdown to the Open. This is Bloomberg.
That's me, Max.
I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
Earnings season is here.
Tons going on, lots of earnings.
Beat wherever you look.
Bloomberg breaks the numbers first.
It's a tale of two earnings. Results from Goldman Sachs, Bank of America, and Morgan Stanley.
Netflix is out, guys.
With exclusive expert analysis.
Recovery is underway.
They crushed it. It was one of their best quarters ever.
This is a story all about pricing power.
We're going to make more money. We're going to make more money. And we're going to make more money.
We're making bank. And I think that is what we can take away.
Bloomberg Television and Radio. Context changes everything.
This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Monday, October 30th. Here are the top market stories that we're following for you at this hour. Just your typical Monday bounce. So U.S. equities tend to rise on Mondays. After the S&P hit correction territory Friday, we see if you should buy the dip. And golden profits for golden arches. McDonald's stock gives up most of its gains. The CEO says U.S. traffic declines slightly in the third quarter despite profit beating estimates. And Rhythm, well, finds its rhythm. We're going to speak to Chairman and CEO Michael Nierenberg on its deal to buy Sculpture. Finally, from New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, I miss you. I'm sorry that you're not here.
Yep.
I'm glad you made it safe. I gotta say, I come in today with a boost in the equity market, and I feel really, really skeptical.
You can ignore Mondays, can't you? Mondays don't tell us what the price action really is. Mondays don't tell us really anything at this point. People lighten up on a Friday. The news has been grim generally most weekends. You buy back in on a Monday. Is this just another example of that? There's so much, Alex, to trip the market up this week, though.
Yeah.
We're going into a continuation of this earnings narrative, the refinancing, the Fed, Apple, Bank of England, the list goes on and on.
But I feel like every article I read this weekend was just how bearish stuff was, whether this indicator is near panic, the hedge fund shorting a lot, positioning really thinned out. Like anything I read was how negative it was in terms of positioning and stuff. So it makes me think like, okay, well maybe you can actually have a sustained bounce.
Maybe. We've still got so much risk out there to manage. Have prices really got cheap enough that they are compensating you for A, higher yields, and B, the kind of volatility potentially a week like this is going to throw up? There is so much out there this week for potentially to trip these markets up. We don't know. We don't know what the geopolitics looks like. We don't know what the economics looks like. We don't know what the financing story looks like. We don't know what the corporate news is going to look like. So much out there that can have a massive impact. I think you park a Monday. Let's see what Tuesday brings.
Exactly.
Takes us to our question of the day, though. Are you buying the dip? There's two ways of looking at this question as well. Are you buying it? Are you actually out there spending some money? Or do you buy it? Are you a little skeptical? Maybe not. Bloomberg's Abigail Doolittle and Edward Harrison join us now to discuss. Abigail, the end of last week was all about the technical indicators. We blew through a whole load of them. What do you make of the Monday bounce?
I'm
pretty skeptical of it myself. And from a technical perspective, you're going to hear a lot of people talking about how the RSI on the S&P 500 and some other indicators on a daily chart is starting to round up. But if you look at longer-term charts, such as the weekly chart and the monthly chart, it suggests the sellers are still in wait. And I think that this week really breaks down to two factors in terms of whether you want to buy this dip or not. I mean, there could be some folks out there doing a near-term tactical, but we have Apple and we have the Fed. So the Fed, of course, is on Wednesday. It's unlikely that they're going to hike, but they could do what they've been doing, which is saying that they're going to hang out longer than expected, especially given the fact that the inflation data is kind of up there. And then relative to Apple, Alex, you made the point last week that it's below its 200-day moving average. True. And when you take a look at the monthly chart, it's really bearish. The RSI on a monthly chart is still rounding down, suggesting more selling pressure. We're looking at decelerating sales there. On the one possible positive for Apple, what we are looking at is 8.1% bottom line growth. Will they get that? We have to see the iPhone China demand, and then, of course, the Foxconn result.
Yeah.
So, I think there's a lot of uncertainty.
It's going to be really messy, for sure. Edward,
Yes.
I feel like this question was like so nicely made for you because you've been calling for weakness for a while, and I appreciate we're up today. Do you buy the dip?
It all depends on what happens in the bond market, honestly, because I think
well, you could buy the dip in the bond market too. It's a fair question.
The interesting bit is if you look at the bond market, like look at TIPS. Okay, TIPS were at they were trading around -1 all throughout the pandemic. And then we started to go up when the Fed started to hike. A real yield started to rise. Yep. And that's when we started to see the market sell off. But then we hit a plateau between 1 and, say, 150 on 10-year TIPS. And that we were able to, therefore, eke out some gains in 2023. It's exactly when we went above that level and on a sustained basis, now we're at about 250 on 10-year TIPS, that the market started to sell off. And that was in July. So my sense is that what you need to see is you need to see TIPS retreat somewhat from those levels.
Okay, we're all focusing on the US. We're trying to figure out exactly what's happening with the Fed, with the data, with the refinancing. But there is a story at the bottom of the screen right now that I wonder whether or not this is ultimately going to be the wild card, whether or not this is a trial balloon. BOJ to consider letting 10-year yields exceed 1%. This is a report that's coming from Nikkei. Edward, if we start to see signals from the BOJ that yield curve control is going to be loosened, maybe more significantly than we anticipate, walk me through the ripple effects on that and whether or not that ultimately affects the answer to the question we're posing.
Well, you know, the BOJ is meeting on Tuesday, and so that was the one.
Tonight.
Yeah, tonight.
I mean, this is like countdown, man.
So that was the one that we missed when we were doing the open, and now we see that matters. They're the anchor that holds us to the bottom in terms of yields. So to the degree that they're willing to go on long-term yields above 1%, then suddenly you have a completely different game, and it gives more impetus to the upside on yields going forward.
Abigail, what do you think?
Yeah, absolutely, because it means that you're no longer going to have potentially that yen carry trade, all of the cheap yen coming into other asset classes. So it could mean that bonds are going to sell off. You could even see stocks go down further to the degree that the yen carry trade has been carrying it. One thing I would say, though, is so the BOJ was pretty hardline this past summer, saying that they were going to consider it going to 1%. The minute that the 10-year JGB got to about 60 or 70%, they came in and crushed it. They brought the yield back down. So they have to walk the walk, not just talk the talk. The Nikkei, of course, has great reporting, but I would say that the BOJ has to have a hard line if they're going to have credibility.
Right, but or Guy, are we just basically seeing verbal intervention because of dollar yen, right? Like we were at 150, we didn't see anything at the end of last week. Is this just it? Just to see what happens?
The BOJ's never been afraid. It could be that, but the BOJ's never been afraid to shock. The Fed tries to manage the market. The BOJ's never really been in that game. And if the reporting from Nikkei has, as Abigail says, generally been pretty much on the money. It's their reporting, not ours. But if they're trying to soften the market up before we get tonight's announcement, that is significant. And this would be maybe one of the ways in which they would do that. I don't know. Let's watch. It's already certainly something the market is going to pay a great deal of attention to. But what it comes back to, I think, which is interesting, I'd be interested to get Edward's take on this. Edward, we're talking a lot about this week about the supply, the refinancing, the story that is coming from Treasury. My question is, and Tiffany Wilding was talking about this a little bit earlier, what about the demand? the biggest buyers are out of the market potentially. You could potentially see Japanese buyers withdrawing further from the Treasury market. Chinese buyers have already been there. You've got QT ongoing. That is a huge price agnostic buyer that is coming out of the market as well. We talk about supply, but Ed, isn't the story here about whether or not you want to buy the market, at what price? At what price do you think these buyers are going to be attracted to Treasuries? And is it lower than where we are now?
Yeah, you know, price agnostic, that was the key term in what you just asked, Guy, because ultimately all the price agnostic buyers are out of the market, and now as a result of that, we're going to get some term premium in there. That means that, you know, if I'm going to buy a 10-year bond, I'm going to be compensated for doing so versus buying a bill which matures in 6 months. And so that term premium, those real yields are all going to go higher in that case. So I think that, yes, when you have more, when you have people retreating, i.e. the Fed in terms of quantitative tightening, when you have the BOJ raising rates, and therefore you have the carry trade less of a thing, you therefore get more term premium, higher yields.
Right.
And I think that that's negative for stocks as well.
Wait, yeah, I was going to say, bring us right back to the question of the day, because if that's true and you get maybe higher term premium on the front end of the curve, which is where the refunding comes in on Wednesday, how do you buy stocks?
Yeah, I don't think that you
messaging systems.
Yes, this is very true. So, Sarah, I guess maybe a better question when it comes to tech is, I guess, what can you still sell? Maybe, like, is that a better question to be asking you?
Yeah, I'm looking at Meta right now, and I think that Meta is doing some interesting stuff. The Street loves this announcement this morning that they're going to start charging, in Europe for an ad-free tier. That's an option. They might love a little bit more than the potential revenue. The fact that it might mean that Meta can stop paying fines to the EU on a regular basis for GDPR violations. And I also am looking at Pinterest. I think that Pinterest is reporting this week, and I think it's reporting after the bell today. And it's an interesting time to think, hey, maybe these advertisers who are pulling back a little bit from current events, impacted platforms, like X, formerly Twitter, like Instagram, they might be putting more ad dollars into Pinterest. So I'm interested to see what their fourth quarter looks like.
Sarah, big picture though, do you think any of these stocks really stack up against 5% that I'm getting out of the bond market? That seems to be the new competition. There are alternatives now. Bonds are providing them, credit to a certain extent may be providing them as well. What do tech stocks in particular, what do tech stocks in particular need to do to compete with that? They've got a lot of cash right now, and I'm wondering one of the ways that they could maybe bolster their position from a market point of view would be to give it back to shareholders and generate a really strong dividend yield that competes maybe better with bonds.
People love dividend stocks, and I think now more than ever exactly because of those bond yields that people are getting. And so, can you convince some of these tech giants sitting on, mountains of cash that, hey, maybe give it back to the shareholders? I don't know. That's historically been a hard sell, but, I think that it's certainly something they're going to have to look at, because the reality is that selling the story of growth, that's what has, been sold from tech for the last few years, it's not really working anymore. AI certainly puts some wind in the sails, and that seems to be sort of winding down as well in the short term. And so, maybe everything becomes a dividend stock now.
Real quick then, Sarah, if the growth story has lost its juice, does a small cap growth look better?
I think that right now a lot of people are looking at small cap because it just feels like these large cap companies, they don't have a lot of upside. And no one thinks that the Apples of the world are going away anytime soon, but can you really get growth there? Or are they sort of going to be flat to slightly down versus some of these smaller names that, we don't want to go full meme stock. I'm happy to hear those are trading down today, but you do want to be careful that you're not trying to play the market too hard when you get into small cap. That being said, these mega caps just don't have a lot more upside right now.
Sarah, great to catch up. Really useful. I think Apple's going to be fascinating this whole week, kind of maybe pivoting around one or two of these key issues. I think Apple will be one of them. Sarah Kunz, Cleo Capital, thank you very much indeed. Still ahead, we're going to talk more about what is happening here. Apple preparing to unveil a new line of products a little later on today, this ahead of earnings. The company definitely contending with pressure from Huawei in China. We're going to talk about all of this next. This is Bloomberg.
Do you think there's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well? Or mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
All right, it's 22 past 7 on the West Coast. Want to get to the startup? Wow, that is a sunrise. We're going to cover the top tech stories from the Bay Area and beyond. And Silicon Valley starts this morning. Joining us now is Bloomberg Technology co-host Ed Ludlow. We were just talking about Apple product announcement today, spooky thing, whatever.
Yeah.
We have earnings on Thursday. What are we expecting? What is going to be the thing that Ed Ludlow's keen in on?
Well, it's kind of funny because they're setting up this week as what's more important to investors, the Fed or Apple? And what will we learn about the world we live in based on Apple this week? So Monday night, we have this big event being dubbed Scary Fast. It is Halloween, of course. And what we're expecting is a Mac focus, a new iMac and an updated version of the high-end MacBook Pro. And in the context of what's happened in the last week, one really key area as well is the M3, the next generation in-house silicon for processor from Apple, which we expect to be unveiled this evening as well.
Are they doing this because earnings aren't going to be quite so good later on in the week? Like, I'm just wondering, kind of the timing I find interesting.
The timing is interesting. And, you know, Bloomberg have crunched the data that from the Mac context, it looks like things kind of improved in the quarter gone. And especially overall shipments in the third quarter, the Mac could be an area of growth. What we are expecting tonight is a focus on some of their lower volume products. But fast forward to Thursday, Guy, you know, based on consensus estimates, we're on track for the 4th straight quarter of sales declines overall. And you have to go back more than 20 years to find a period of time where Apple had 4 straight quarters of sales decline.
Mm-hmm.
So there is no definitive on the timing, but it is curious.
I'm wondering, too, with Apple kind of sitting right below its 200-day moving average, like, is the bad news baked in? Is it not? Like, would the product launch support that? I feel like the technical picture of it's super interesting as well. Ed, also want to ask you your take on SoFi. So the stock is, like, surging right now. Super solid earnings. What happened here?
Yeah, so, I mean, the basic mechanics of it are that the deposit base kind of tripled from a year ago and came in way ahead of expectations. And I think the three of us will ask ourselves, why? What is going on here? Because in the higher rate environment, technology-focused consumer lenders who are competitors of SoFi have not done as well. Think about kind of names like Lending Club. But the idea that they explained on the call is that they have an attractive savings rate. And what they're able to do is take those new savings customers brought in by the savings rate and convert them very quickly to setting up direct deposit into an account that's SoFi based. They also have this idea that in the most recent quarter, they also offered kind of everyday people access to really attractive IPOs. They get very small allocations, but historically that's a part of their business under financial services that's been loss-making. And for the first time, it's making a net positive contribution to the bottom line. So it's a multifaceted business. You come in lured by the savings rate, and you stay for the other options that are available through SoFi.
Ed, just in 10 seconds, is this sustainable? Is this a one-off, or is this a sustainable story?
I think that our analysts would say, look at their loan book and the percentage premium on their loans, and then we can talk again next quarter.
Okay, I think I get the answer there. Ed, thank you very much indeed. Ed Ludlow joining us from a beautiful San Francisco. You can catch Ed and Caroline, Bloomberg Technology, coming up in around 90 minutes' time. They are, funnily enough, going to be talking to the SoFi CEO, Anthony Noto. We're going to talk McDonald's next, though. This is Bloomberg.
are some of the measures the government are working on in terms of addressing the artisanal challenges there?
Oh, a host of them. I mean, but fundamentally hinged on two policy pillars. One is reformation, which is reforming the sector, licensing regime, getting them equipment for the extraction of the gold from the ore without the use of mercury. As you know, we are parties to the Minamata Convention, and therefore we respect the dictates of the Minamata Convention. And then the enforcement regime, deploying law enforcement to make sure that people are arrested and so on and so on. So we're making that effort. But my point is that, my fundamental point is exploiting these mineral resources in a sustainable manner are not mutually exclusive.
Yep.
I think that they can peaceably coexist. You can exploit the resources, and several countries have done so. I don't want to mention, give examples, but I know of countries which have gone about their mining sector and their mining industry in a manner which is also protected the integrity of the environment and the climate. We can do all of that. My friend Josephine mentioned the day we'll use solar to mine and use gas and all of that. These are all very ambitious technological interventions we can rely on. And Ghana is doing just that.
We're about an hour into U.S. trading session. We got a pretty powerful rally underway. Sustainable? Well, that's a different question. Abigail's tracking the moves. Hey, Abigail.
Well, let's start out with the breaking news that we were talking about earlier, because this is really shaking the equity markets and some other risk markets here in the U.S. Not in a huge way, but this is the dollar-yen, and you can see it's down 0.25%. This on a Nikkei report that the BOJ may, in fact, let the yield, the 10-year JGB, float up toward 1%. They were talking about that earlier this summer, and then they didn't quite stick with it, so the dollar-yen has floated higher. What we do have, though, is, again, an effect on risk assets here in the U.S., perhaps the fear that they will do this. It could deflate to some degree the yen carry trade. So we have stocks off the highs. The S&P 500 up 0.5% earlier, had been up 1.1%. You can see that the NASDAQ 100 VIX, the VIXN, is higher on the day, 24 handle. And you can also see that we have the 10-year yield coming off of its lows, continuing to climb up 7 basis points, because, of course, those dollars, if they come out of the yen carry trade, it's not going to just come out of stocks. It's not going to just create a funding issue there. It could for bonds as well. And then oil down 2.6%. Now, if we take a look at the yen versus the S&P 500, this is a longer-term chart in the Bloomberg terminal. And what we're looking at in white is the dollar-yen. It looks like it may, in fact, drop down from these levels. This could be a topping pattern of some sort that could easily bring the dollar-yen down toward 130 over time even more. That could create a problem for the S&P 500 for sure, again, as repricing of risk occurs. As for a mover on the day relative to earnings, we do have McDonald's trading. I'm going to be curious to see what direction they're trading at this point, because at first in the pre-market they were up 3%, and then around the open up just slightly, but they of course put up a solid quarter on the day, or they put up a solid quarter for the third quarter. Adjusted earnings of $3.18. That was a beat. And then we also had comps coming up 8.8%. Guy, it's interesting because they're talking about folks being willing to pay for pricier burgers, and yet I think some of the commentary that came out of the call was that they're benefiting both from people paying up and then folks going from pricey items to some of the less pricey items. So, but they are talking about a rough macro in terms of inflationary pressures.
Where do you focus your attention? So what you've got here is US traffic coming down, but you've got prices going up. Which one of those two things do you focus on? I think the market's kind of caught in the headlights of that narrative at the moment, trying to figure out which way to go. Let's get some analysis. Let's figure out what's happening here. Abigail, thank you very much indeed. And wonder where we go next with McDonald's. We're joined now by Andrew Charles, TD Cowen, Senior Research Analyst for Consumer and Restaurants. 288, the price target on the stock, the rating is an outperform. Andrew, which one should I be looking at? We are seeing traffic down a little bit in the US, but prices are a little higher in the US. Which of those two things is more important right now?
Good morning. So the focus squarely from investors is on traffic growth, which makes sense because that shows you the underlying health of a business over price. But traffic, I would point out though, is certainly helped by what we view to be proprietary survey data. That's just superior value perceptions versus the rest of quick service, And so I think you're going to see that command the day that they will be gaining share, from quick service peers. They saw that in 3Q, and I think you're going to likely see that continue.
Also, they said that average price increases are declining with inflation. That was on the call. So that means that maybe the market that they saw, the price increases they were able to pass through will no longer be happening?
So what that means, if you go back to 2Q, they saw low double digits amount of price in the quarter. They didn't specifically say what pricing was in the third quarter, but it was below 2Q's 10% plus level. So in the future, they're going to expect more pricing to moderate as inflation has eased for them, both in the commodity and on the labor side. So easing inflation, easing pricing, that means as well, more of a focus on traffic here to really help get same-store sales higher, just given the fact that pricing is easing.
Andrew, chicken or beef? Chicken or beef? Which one's the more important here?
For me, it's chicken, if you're asking me more personal. But I would say that, McDonald's actually is selling more chicken than beef. And that's going to be a focus of them going forward for a couple of reasons. One, it does skew younger. Second, it also is higher margin as well. So you've got a nice combination there where they're really going to be focusing more so on chicken going forward. So some exciting news, hopefully, to come out of that. We did see last year's McCrispy launch their new upgraded chicken sandwich. Based on what we hear about it, was the best performing new menu item since Chicken McNuggets in 1983 or 40 years prior to that. So, obviously off to a commanding start and frankly, a new canvas that we hope will be used for future menu innovation as well.
Wow. But chicken prices have been on quite a tear, though, I have to say, over the last couple of years. I also just got a view of what Guy would be like if he was a waiter. I'm just putting that out there. And it was kind of awesome. Andrew, is any of this stuff going to be disrupted by weight loss drugs?
No, we published a report on this last week, and I think this narrative is certainly more bark than bite. And look, as it comes to the GLP drugs that you're referencing here, the catalyst path is pretty rich. That right now they are once a week injectable. A oral tablet is being worked on right now and is showing promising results in trial. We also have to talk about insurance at some point being more open-minded around covering this, because if you stop overweight and obesity in the United States, you probably stop a lot of problems further on down the line. Yep. So certainly the insurance narrative is going to pick up as well. But, it depends what number you approach in terms of what you think the TAM is for the U.S. consumer. We shook out to about 15 million consumers in 2030. The narrative out there from investors is somewhere between 25 and 30 million. So, it depends obviously where we shake out, but I would say that the annualized impact as we think about year over year of getting to a 15 million, of getting to a 25 million, it's just not severe enough that it's going to reduce enough calories in our view. Mm-hmm. When you think about an industry growing around 3 to 4%, we're talking about 10 to 30 basis points essentially per year. It's just not significant enough in our view to really, weigh on restaurant industry sales from a calorie reduction perspective. And for what it's worth as well, we collaborated with all of our Cowen consumer colleagues on this, including my packaged foods colleague, Rob Moskow. We believe the packaged food industry is more at risk than restaurants, just given that it skews to snacking more and also to single users, while we think occasions that more cater to groups like a delivery or dining out are going to be the more insulated, from a restaurant perspective.
All right, Andrew, thanks a lot. We really appreciate it. Andrew Charles of TD Cowen. Also, it's more like a flight attendant, I think, maybe for Guy, chicken or beef. There we go. Let's stay with food for a second. Another story we're looking at. Walking down the candy aisle is much more trick than treat these days, as the rising price of Halloween candy gives customers a scare. Check this out. The price of candy is up 7.5% from last year and 20% higher than it was in 2021. Here's the why: dry weather, expensive fertilizer, other culprits behind the rising cost of sugar and cocoa. The sour news is really hitting Americans in the sweet tooth. The Halloween U.S. consumers are expected to spend $3.6 billion on candy this year. $3.6
billion on candy. That is an unbelievable number. Is that just Halloween?
Yeah.
That's not in the year. That's just Halloween, right?
No, that's
an
just
amazing
Halloween.
Number.
I think I bought like
3.6 billion.
7 bags of candy yesterday, and I want to say I probably paid upwards of like $50, $60. I bought other stuff with it, so I can't 100%. But it was not nothing.
You guys take this seriously.
Well,
I have to say, you guys take it more seriously than we do, but it's a big thing for you guys.
Well, also
in Germany, sweets and chocolate bars are up 19%. They're 19% more expensive than the same month last year.
Wow.
That is an amazing number.
That is pretty amazing. So
and you come back to McDonald's, you come back to Ozempic, all of this stuff as well feeds back into the same narrative. But yeah, $3.6 billion.
I don't think the Halloween candy
this
counts.
Halloween
That's not a
on sugar.
That's not a thing. That's Halloween doesn't count for any sort of diet or anything. But here in the U.S., if you're in an apartment and you have a kid, what you do is you get like huge bowls, you dump all the candy in there, and then you leave. So you're not actually handing out candy. So kids just come over and like grab a bunch of candy and put it in their thing. So that's why you need like more than
just
less.
Like pour
Pretty
the
much.
bucket.
So you don't want to be those people
one
in the
bucket
building
into another bucket
that like don't have enough candy. Like you don't want to be that person. So hence the 6-7 bags of candy.
Yeah. As a parent, it all comes home and then it gets forgotten, and 2 days later it goes in the bin.
Are you kidding? My daughter's eating that for like months. Anyway, coming up, another story that we're watching here is auto strike. So GM reaching a tentative agreement with the UAW workers. Details on that next. This is Bloomberg.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
The top names at the Fed are on Bloomberg.
The economy is handling much higher rates, at least for now, without difficulty. So notionally, that might tell you that the neutral rate has risen, or it may just tell you that we haven't had rates high enough for long enough.
The bond market has tightened quite considerably. If financial conditions are sufficiently tight, our work is not necessary because we don't need to boost them more.
Nobody covers the Fed like Bloomberg. Context changes everything.
Your grandfather was a famous basketball player. In fact, he's in the Basketball Hall of Fame. Did you have any of his basketball genes?
You know, in my family, David, you didn't do very well at the family barbecues if you couldn't play hoops.
General Motors reportedly reaching a tentative agreement with the United Auto Workers that brings an end to a 6-week-old strike that had upended U.S. car production and cost the industry billions of dollars. Bloomberg's Detroit bureau chief David Welch has the latest. Are these 3 done deals? Is it good for the auto workers? What does it mean for the automakers?
Well, the contracts still have to be ratified by workers, but the contracts are pretty rich. The workers should like them a lot. And even though ratification votes are typically won by 50, 60%, I think this one will sail through with even a greater percentage of votes than that. So look, the costs are going up quite a bit. It's not a catastrophic amount, but they're paying quite a bit. You're talking about 25% raises over 4 years and 8 months on top with cost of living allowances on top of that protect from inflation. Retirees got a little bit more money. Temporary workers, which the companies had used to keep their costs lower, they're going to get a very big raise. So it's a more expensive deal.
David, what does this mean for non-unionized auto workers in the United States? Tesla, I'm looking at you here.
So typically, Toyota, Honda, the foreign-owned transplants have raised their wages, their benefits to keep the union out. They'll kind of keep it just under what the Detroit companies are paying so that they still have a bit of an advantage. But they've had to do that just to keep their workers from organizing. Tesla may have to do the same thing, although, Tesla workers get company stock options, which, that's been very lucrative for many of them over the years. And that's, their calculus is a little bit different. But I'd see wages go up, but probably not to the level that this union contract has won.
But does it hamper the auto workers' ability to make the transition to EVs, considering how unprofitable those cars are for them?
The companies are going to have to do it. The biggest thing that's hampering that transition right now is once you get past the technology geeks, the early adopters, and the luxury car buyers who've been snapping up all these expensive EVs, the mass market's been kind of balking at it because the cars are still fairly expensive, even with Tesla's 30% price cuts. The charging infrastructure out there is not great. People don't see chargers everywhere, so they're a little bit resistant to it. It'll come, it'll happen. It's just all of that stuff needs to be solved and solved pretty quickly to boost the number of people who want to buy these cars.
It's interesting that the US is moving maybe a little bit more slowly than Europe and certainly China. David, great stuff as ever. We've really appreciated your coverage of what has been happening here. Bloomberg's David Welsh joining us on the fact that we finally look like we have an auto deal. Coming up, we're going to turn to what's happening in the financial sector. Rhythm Capital finally gets a yes in its bid for Sculptor. Michael Nierenberg, the chairman and CEO of Rhythm, joining us next. My turn to mispronounce something. This is Bloomberg.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Time now for Wall Street Beat. We take a look at what's buzzing on Wall Street and the world of banking and finance. And today we're taking taking a look at Rhythm's newly accepted bid for Sculptor Capital. The deal value of Sculptor about $720 million, and Bloomberg Sonali Basak is now joined by Michael Nierenberg, the chairman and CEO of Rhythm. Sonali?
Thank you, Alex, and thank you, Michael, for joining us. If many of you haven't heard of Rhythm, it's because it's kind of a newly named company. Rhythm was formerly known as New Residential, externally managed by Fortress. You and your team only really left about a year ago. And when we fast forward to today, you're looking at about $1 billion worth of acquisitions in 6 months, including a unit of Goldman Sachs and this Sculptor deal. What is your ambition? What are you trying to accomplish here?
Well, the company was started back in 2013 as a spin-out. We were externally managed. I was a Fortress employee. Our whole team came from Fortress, and we built this vehicle, which started back in 2013 with $1 billion of capital to $7.2 billion of equity today. Really, our goal is to become a world-class global asset manager. I think the addition of Sculptor is really a very, very important piece as we look at where we're going on a forward basis.
Sculptor has really captured the imagination of Wall Street. This has been a messy deal. To be very clear, there have been lawsuits flying. There have been
market. So those forces at play are, trying to see what's going to be stronger. We've got a lot, like you said, a lot of risk haven this week. There's the war in the Middle East that's raging. It's always tricky. But if you look at this picture, is there a technical point of view to buy this market? Yes, there is.
I think there's a very careful line of, yeah, maybe. Ira, in terms of the bond market, do you buy the dip, or can you do that before 8:30 on Wednesday?
I don't think you can. I think if there is a dip after 8:30 on Wednesday, that could be an interesting time because Wednesday afternoon you'll probably get Jay Powell be a little bit less hawkish than he's been over the last couple of quarters. So I think we have this weird dynamic where it's not necessarily a terrible time to buy, but you'll probably see somewhat better levels and entry points in order to get in as we get this supply information, like you said, Alex, this afternoon and also on Wednesday morning.
Ira, is this market about supply or is it about demand? And that demand at what price, as you mentioned? We've got the news already. Looks like Nikkei's reporting that we could see some changes coming out of the BOJ. There's going to be a debate on yield curve control. As you say as well, we're going to hear from the Fed. I'm wondering what the message there is going to be in terms of managing the QT story as well. Does that just continue on rails as it has been? Which side of the fence do I need to be looking at here? Is it really the supply side or is it still the demand story?
Oh, it's primarily demand. I'm actually writing a note right now, which will be out hopefully tomorrow, where we'll look at what supply really means in the macro sense for the sovereign bond markets. And one of the things that you have to appreciate is that demand will always determine which direction yields are going. But one of the things that supply does is it shifts the level and maybe how fast the moves can be. So with supply as high as it is, good economic data, hawkish statements from Bank of Japan and others are going to shift yields maybe higher faster than they would if supply wasn't going to be as severe as it's likely to be over the next couple of years.
Right, which is also sort of like where on the curve do we see that, et cetera. So wrapping this all into account here, Michael, where do you think the opportunity is to buy in equities? And that's my way of asking, where we priced in enough damage. I look at NatWest, double downgrade from Jefferies, JP Morgan coming out negative on European banks. Where are we seeing enough pain?
It's another good question because it's tricky. The market has been responding to different things. You look at, for example, all those bond proxies, they've been suffering a lot. And there's a narrative coming up that if we get close to the peak bonds, peak rates, peak bond yield narrative, those are the sectors where you start to look into. Like I'm talking real estate, utilities.
Yep.
So in there, the damage has been quite decent, and people may want to try dip a little bit in there.
Just a little bit.
Yes.
Torsten Slot was out earlier, basically talking about the fact that he thinks now we're in a position where the cost of capital is likely to be permanently higher. If that is the case, have equity markets adjusted enough to that new scenario? And which takes us to the kind of the bigger picture question. Kind of where are we? Are we in a bond market? Are we in a bear market? All of these rallies and gyrations that we're getting, what are they telling us about the more medium-term picture? Tactically, yeah, you may want to buy the dip right now, but what's the bigger picture as well?
So the bigger picture is a bit more tricky, like you said. You have the cost of capital that's been rising. You have earnings that are starting to suffer. We've been seeing it during this earnings season. There's a lot of profit warnings in the consumer space. Some stocks are getting absolutely hammered when they miss because the bar to jump was quite low. And so it makes the market in a very tricky position. And longer term, if you look at how the markets evolve, it's when analysts are starting to give up and starting to cut their estimates and to be really bearish that the market is on the way up. And we are not yet at that point, so we might see that.
We're still in a bear market.
Yeah, kind of. Technically, we're still in a bull market in Europe.
Okay.
Because we haven't come down to a bear market yet. But I think the main point, maybe the real tipping point, is probably when we have the first rate cut. But that's in.
But that's,
6 to 9 months.
as we heard from some central bank governors today, that's going to be well far out now, sort of plateauing for longer for the ECB. Ira, before I let you go, and I'm sure we're going to talk to you tomorrow about this too, but I'm just wondering, if we get more issuance on the front end of the curve or in the bill market, what does that mean then for equities? I know you're the bond guy, but in theory, does that sort of lessen the pressure on long-end bond yields and that helps the equity market?
Well, I think there's a hope, and we certainly have this in our forecast, that the Treasury Department will kind of front load some of the issuance, not necessarily as much in bills, but more in 2, 3, and 5-year notes as opposed to 10s and 30s. I do think that maybe that helps risk assets a little bit if you wind up getting a little bit of a rally in the long end of the market where you get 10-year yields down to 4.75 or something. But you still have a big adjustment from a valuation perspective as to where 10-year yields are today, even at 4.75 if they were to get there, versus where they were just a month or two ago when you were talking about more 4% yields. So I still think that yields are permanently higher, at least until we get a more dovish Fed.
Yeah, totally. Which brings us back to the whole point, is you guys see the rate cuts. Guys, thanks a lot. Ira Jersey of Bloomberg Intelligence and Bloomberg's Michael Masika joining us there. And has you de-risked enough for that? So coming up, more on the question of the day. Are you buying the dip? Laura Cooper, BlackRock senior macro strategist for iShares EMEA, joins us next. This is Bloomberg.
Do you think there's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, or mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea. But technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
Our country's obviously running a very large deficit, so there's going to be a ton of issuance that will continue to be sold into the market as it relates to government securities. With capital rules kind of up against, with the banks up against capital rules a little bit, I do think we're going to stay at this period where we're going to be higher for longer.
Michael Nierenberg, the chairman and CEO of Rhythm Capital, speaking to Sonali Basak in the last hour. Fantastic interview. Go and look at it. I'm sure it's on the spotlight already on the terminal. Takes us back to our question of the day. Are you buying this dip? Are you buying it? Or are you actually buying it? Laura Cooper, BlackRock senior macro strategist for iShares EMEA. Mildly cautious is the language. Let's put that into the context of, do you buy the dip? If you're mildly cautious, are you buying the dip?
I think given the sell-off that we have seen in equities, it certainly has opened up opportunities to take on some tactical exposures. But looking at broad benchmarks, no, we're not yet buying this dip. Largely because if we think, yes, Q3 earnings downgrades have come through, we've seen quite punishing price action on the back of that. But we are starting to see even Q4 downgrades. That's likely to be a trend that's going to persist. But even the bigger picture, I think we've yet to see economic data deteriorate in the U.S. The Fed is going to continue to have this high for longer policy. If they don't actually signal that they're going to pivot when we start to see that deterioration, I think risk assets have further room to run.
Alex, this is Laura being mildly cautious, okay? I don't know what cautious would actually look like.
Yeah, no, maybe like gold and soup cans under the bed or something. Hey, but Laura, where might you be tactically wanting to buy this dip?
I mean, actually, if we kind of expand that over to the fixed income space, I think there are quite opportunistic opportunities there. Largely, we think about the front end of the U.S. curve does continue to be quite attractive given where coupon income is paying. And then I think, it's really a case of, do you now buy the dip in duration? Well, no, but we did close our tactical underweight on the U.S. 10-year. We think, though, we're probably going to be in this period of extended consolidation because of the clear macro event risk this week. And, of course, that refunding that is really garnering quite a bit of attention in the week ahead.
So I'm staying in cash right now, right?
Not necessarily. I think there are downsides to just staying in cash given this inflationary environment. There's certainly risk-reward profiles that are quite attractive. If we look at inflation-linked bonds, for example, in the belly of the curve, that is looking quite attractive because we don't think that inflation necessarily is fully priced in given this kind of new macro regime of elevated inflation. So there are opportunities in this environment besides cash.
So how much more de-risking do you think we have to see? Because there's like the one argument that we've seen a lot of de-risking, so if things aren't as bad, you'll see a melt up, especially into the end of the year. And the other is that no, there needs to be a lot more. How much more?
I don't think there's going to be significantly more downside in these equity markets because we have seen quite a material sell-off certainly since September. I think really the key question is what are the guideposts that investors are watching for to re-risk? And I think at this point, central bank policy will be crucial, but we likely need to see them really extend kind of beyond this high for longer narrative and really kind of capitulate to say that rate cuts are in the pipeline. We don't see that as necessarily being a Q4 story. But if we start to see risk assets come under greater pressure, as we are seeing signs of economic deterioration in the U.S., we clearly have already seen that through in Europe, we could see even more pockets of opportunity given valuations could present much more attractive entry points.
Do you think the cost of capital is now permanently higher? And if so, how far through the adjustment process, Torsten Slogger of Apollo has been writing about this today, how far through the adjustment process are we in pricing that higher cost of capital into the economy, into financial assets, into the labor market, all of these factors that we need to take into account?
And it's a very important question when we position portfolios on a strategic basis. If we think about where yields are now, this is probably the new norm where we've really seen this repricing to a higher plateau. So if we think about the cost of capital in the U.S., if we look at the 10-year tenor, for example, yes, the term premium has risen since early September. Around that, did breach that like 35, 40 basis point mark. We've seen some compression on the back of some dip buying, but ultimately over kind of a longer term horizon, we could see that term premium go anywhere up to 100 basis points or so because investors will demand that extra compensation in this environment of renewed rates risk and inflation volatility. So in terms of has that actually materially fed through to the U.S. picture? Not yet. We are seeing some signs of cracks. Looking at the consumer, we have seen credit card delinquencies rise quite sharply. We are seeing, this transitory impact of the labor market tightness. So we did see real consumer spending quite strong last quarter, but it's actually above real personal disposable incomes. How sustainable is that in this environment? Probably less so when consumers have really depleted their excess savings. So I think the consumer will come under increasing pressure, and that's really one consequence of this rates regime of higher for longer yields.
So I feel like usually around this time, like after Halloween, we talk about the Santa Claus rally guy and like redoing the books and the whole thing. This is like Laura's version of like, here's a lump of coal.
Laura has not invited
Santa's
Santa
not
for
coming.
Christmas.
Here's your coal. You're taking all your presents, and the Christmas tree is up the what's that called? Chimney.
Do you know what everybody's going to be asking for this Christmas? Cash. My children are already asking that question, and I think they're probably maybe being savvy investors. Like, what do you want for Christmas? Cash. Okay. Well,
or
you
like
and
a CD.
everybody else at the moment.
I want a CD. Remember when they used to give those out for Christmas or graduation presents? That hasn't happened forever.
Yep. But I think cash could be the way to go. Cash could be the way to go. It could be the answer to every single question. Santa's going to be deluged with what's on their Christmas list this year. Cash.
Yeah.
That's what I want.
I love my
And
9-year-old.
Maybe
here's your CD.
he's just going to be weighed down by that, so maybe he doesn't show up after all. Yeah. Laura thinks there are alternatives, though. So maybe some sort of inflation-linked bonds could be on the Christmas list as well. Laura, great to see you. Thank you very much indeed for stopping by to see us. Always a pleasure to see Laura Cooper of BlackRock. Right, what are we going to we need to talk about the other risks that we haven't actually spent that much time talking about, Alex. What is happening in Israel? What's happening in the Middle East?
Yeah, and sort of the headline narrative today was that things weren't as bad as maybe investors have been prepping for over the weekend. However, I mean, you have Benjamin Netanyahu warning of a long, hard slog. So we're going to kind of see what's happening on the ground and then pull that back for a broader market conversation. We'll be having that conversation coming up next. This is Bloomberg.
I think this will probably go down in history as one of, if not the largest financial crime ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community. When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Violence between Israel and Hamas continues over the weekend. Here in the U.S., the new U.S. Speaker of the House, Mike Johnson, says the House will vote this week on more than $14 billion of aid for Israel. Now, it comes as Israel stepping up that ground presence in Gaza. Bloomberg's Nick Wadhams joins us now with more from Washington. Is the $14 billion a done deal?
I think at this stage, it really is. The only question is going to be whether Democrats put up a fight because they want about $60 billion in Ukraine aid to be joined with that. And, there's going to be a question there where, if they don't approve the Israel aid, they're going to look bad. But they really do not want to separate that from the Ukraine aid. But it's a near certainty that either way, the Israel aid will go through.
Nick, does it come with strings attached? Does it come with policy strings attached? At the moment, the US is giving Israel a fairly free hand. Do you think that could change?
Well, I think behind the scenes, you are seeing the Biden administration try to exert some leverage. So there is the theory out there. We've had that confirmed with some reporting that basically what Biden did was give Bibi a big hug, a big embrace at the beginning, and that then created space for him to sort of quietly behind the scenes say, okay, listen, you've got to consider the human toll, the humanitarian situation in Gaza, the civilian casualties.
But certainly at this point, it's looking pretty unrestrained. The ground invasion has not that sort of as maximalist as we had feared, but in some ways certainly pretty intense.
So I'm just wondering how the aid then plays out, and if there'll be sort of strings attached because of that, either more trucks into Rafah.
I don't think you're going to see any strings attached to that aid. I mean, this is unlike the Ukraine situation where a lot of Republicans are saying, listen, we need to have a lot more accountability in terms of how that money is spent. But really, the Israel aid, no, there's not going to be a big link between the policy. I mean, the bipartisan support for Israel is so big, and that money is really going to be spent mostly on defensive systems so that Israel has the ability to defend itself from incoming rocket attacks from both Hamas and from Hezbollah in Lebanon.
Nick, is the clock, though, ticking? How much time does Israel have? How much? You talk about the support that Israel has in D.C. I think that's unquestioned at this point. But is there a clock ticking around that support? Does it degrade over time?
Well, I think what you're going to see, not so much a degradation of support from the U.S. in terms of money and from the vocal administration support, from President Joe Biden himself. But what you are going to see is more pressure to put a focus on aid going into Gaza from Egypt, more concern about civilian casualties. I mean, Bibi's setting the expectations. They're saying this is going to be a long war. So he really wants to go, as long as necessary to get rid of Hamas. And right now they're giving a very open time frame of saying 6 weeks to 6 months. So I suspect it's going to be several more months before you really start to see this administration say, okay, we need to wrap this thing up.
Right. Which, of course, is then you're getting into election year. So what do we need to see from Ukraine to get maybe more support and more bipartisan support?
Well, it's a great question because there's not really a lot of clarity on what Ukraine actually can do there. I mean, you do have Republicans saying that they believe Ukraine should get the funding, but they really want to see this issue of accountability, so making sure that money is well spent. But, I'm not really sure how much Volodymyr Zelensky can actually do to provide that sort of accountability aside from reassurances. I mean, a lot of the way that money is being spent is through U.S. weapons systems and the ability to purchase weapons from U.S. defense contractors. So it's not like money is just being funneled into Ukraine. It's much more coming in terms of weapons systems.
Nick, great stuff. Always appreciate the update. Thank you very much indeed. Bloomberg's Nick Wadhams joining us from D.C. Big week for central banks. We need to talk more about what is happening there. BOJ, Bank of England, Fed. We're going to talk about it next. This is Bloomberg.
Let's suppose you're on a plane and somebody realizes who you are. They say, I have $100,000. I don't know what to do with it. Where should I invest it? Where should they put their money?
So today, it's a easier decision than it was maybe 2 years ago because Treasury bills are 5%. So I would say, regardless of how much risk you want to take, you have to put a portion there. Then you would have to ask really, an individual is the same, I think, as any institution. What is your time frame? Do you need to get access to this $100,000 in the next few weeks, the next few months, the next few years, not until you retire? And that will determine your investment decision.
So, what do you think is the most common mistake investors make when they have 100,000, a million, or whatever they might have? What is the most common mistake you have observed that investors make?
I would say hubris and thinking you know more than you do, because every decision that you make has many, many layers. So as you're creating a portfolio, look at the risk as well, not just excited about the return.
And what's the best investment advice anybody's ever given to you?
Continue to learn about innovation in whatever you do, because that is where it's not exciting, that's where returns will go.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open. Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
This is Bloomberg.
Europe's clocks have changed. Normally we'd be doing the close at this point. It's going to be an hour later for our US audience. Let's talk a little bit about what's next, though. Coming up in Europe tomorrow, we continue with the earnings narrative. BP, OMV earnings are going to be out. It's going to be interesting to see what happens in the light of what we've learned from the US majors last week. We then get into the bank earnings. Vontobel out with earnings as well. Today we've got HSBC. And then we get into the data. And Alex, there's a lot of data. France GDP. Italian GDP, Eurozone GDP, and the CPI data, I think here is going to be fascinating, how this is going to work. We saw German CPI data, maybe not providing the shock that we thought it would, but it came in a little softer than anticipated. The regional numbers gave us a clue. But nevertheless, a big part of the Eurozone economy, maybe a little bit softer than we would have anticipated. Does that mean that Eurozone CPI data is also going to be a little bit softer than we anticipated? The German data today, I think, is a really interesting tell.
Yeah, the German data really showing that the economy is getting hurt under higher interest rates. And that is not just a German story. It is all across Europe. HSBC CEO Noel Quinn spoke exclusively to Bloomberg TV about how those higher interest rates are hitting the bank's bottom line.
I do think we're at a level of interest rates now that we need to give them time to work on the inflationary environment. So I do believe it will be hold. I do believe it's higher for longer. Because I do think there are underlying inflationary pressures still in the global economy.
So let's get more perspective on the market impact, what to expect. Althea Spinozzi is Saxo Bank Senior Fixed Income Strategist is with us. Now, what do you expect from all the data this week?
Well, our expectations is for the Federal Reserve to keep interest rates on hold. And the reason behind that is that we have seen that decision well advertised among Federal Reserve members. You see, right now, Alex, the Federal Reserve is more concerned about the rise in long-term yields, and it sees it favorably, especially because from September, 10-year yields went from 4.4% to 4.9%. That 50 basis points rise has been entirely real yields. So we can say that financial conditions are much tighter now than they were 6 weeks ago. However, I'm really believing that the big news this week is the Bank of Japan tomorrow and the quarterly refunding announcement from the US Treasury on Wednesday.
Yeah, I think we've already started to get a hint that maybe the BOJ will be tweaking policy a little bit out there. So we'll be watching for that overnight into tomorrow. What do you think the European data is going to tell us this week? The US economy still looks like it's running fairly hot. What do you think the data out of Europe is going to tell us? How big a gap economically are we seeing across the Atlantic?
Well, I believe that this week European data are painting a picture of European stagflation. We already have Germany in a recession, the Netherlands, maybe Italy is going to follow, and the BTP to Bund spread is going to continue to widen. Right now, we just have the confirmation that on both sides of the Atlantic, we might already have seen the peak in interest rate hiking cycle. What will follow will be a higher for longer, and the big question is whether central banks on both sides of the Atlantic will be able to keep rates high for long without anything breaking.
Yeah, that'd be a tough order. I think they probably want that. What about across the Pacific? What do you think the BOJ is going to do tonight, and do you trade it? How do you play it?
Well, really, the BOJ, our expectation is for the BOJ to revise economic projections. In July, we have seen already inflation projection revised to 2.5%, but that's not enough. In the past 2 months, we have seen Japanese inflation above expectations, and it's very hard to believe that it will revert to 2.5% by April next year. We expect an upside revision of inflationary pressures to come along with a tweak in yield curve control. And what does that mean? It means higher yield in JGBs, so less scope for Japanese investors to buy European and US Treasuries.
Althea, we're asking the question today, do you buy the dip? And what we're really asking is, after the price action of last week, is now the right moment to step in? Talk to me about what you see the opportunities looking like in fixed income right now, given what the BOJ is saying, given the refunding operation that we're about to go through in the United States. Do you think, how much higher do you think yields could get from here?
We believe that the front part of the yield curve is somewhat anchored. The long part can go much higher. What we have seen in the past few weeks is the yield curve to disinvert, and with 3 months T-bills trading at 5.3%, it's not hard to see 10-year US Treasury yields moving to break above this level. We have to think that when we look at the SOFR yield curve, the expectations is for rates not to drop below 4% during the next 10 years. Considering that historically 10-year yields priced between 100 basis points and 150 basis points above this rate, it's not hard to see 10-year US Treasury yields around 5 to 5.5% throughout 2024. However, Guy, when you ask me, buy the dip, is this the dip that we want to buy in US Treasuries? Maybe, because from a risk-reward kind of perspective, 10-year US Treasuries provide upside, diversification, and also protection in case of rising geopolitical concerns or an eventual recession.
Yep, and as you say, maybe there's not that much more downside still to come into the market. There's plenty of people sitting on some pretty tough positions, but if you're re-entering the market, maybe that downside is fairly limited. Althea Spinozzi of Saxo, great stuff. Thank you very much indeed. And Alex, this is going to be fascinating to watch, isn't it? By the end of this week, I think we'll have a lot of answers to some of these questions. We won't be able to factor fully in the geopolitical risk, but we're going to have a better idea of what the summary of economic projections is going to tell us. Are we going to see cuts next year? Are we going to see more supply coming in? What the Europeans are going to tell us, I think, is going to be fascinating as well. But the BOJ, I think that's the real wild card still, despite what we've learned today.
Yeah, for me, I feel like it's going to be, do you buy tech? Like, does Apple help provide a bottom or open up the room for more downside? Yep. And the other that I want to learn is, like, where and when do you buy treasuries? So where across the curve, and that obviously is based on the refunding, if you see more issuance in the back end, is it time to buy the long end? So I feel like those are the two things that I want to answer by the end of this week.
Our treasuries on the list for Christmas. I think we're gonna collate a little Christmas list and see what it looks like.
My 9-year-old would be like, thanks,
by the end of the year. Yeah. It's gonna be like, honestly, I think my kids will be happy maybe with a few treasuries. I think the kind of the Amazon voucher, the voucher is a kind of fungible products as well. That's near cash. Anyway, coming up, we're going to talk more about what's happening in the auto sector. General Motors and the United Auto Workers Union appear to have reached a tentative agreement. We're going to figure out what is happening here. RBC Capital Markets are getting us the take next. Are we done? Are we really done? This is Bloomberg.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg. City. We're in London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
General Motors and the UAW appear to have come to a tentative agreement. General Wokers, that probably isn't exactly what I should be saying. This agreement could bring to an end the union's unprecedented strike against all three of the nation's unionized automakers. Let's get some analysis. Tom Narayan, the global autos analyst at RBC Capital Markets, joins us now. He's got an outperform rating on GM, price target 48. Tom, is this what we could have expected? Is this a good deal? It appears to be a good deal for the unions. What does it mean for the auto workers? The automakers, not workers. Wow.
Sure. Yeah. I mean, I think this is largely expected, right? We've heard about Ford striking a similar deal than Stellantis on Saturday. So 25% increase is kind of where we were headed for the past few weeks anyway, both sides moving together. We've actually done some math on what that means from a margin impact. Remember, this is over 4+ years. So once it gets to that point, our math suggests it's about 100 to 120 basis point increase or decrease to profit margin. So what does that mean? Your 7% margin goes to 6%. I mean, it doesn't kind of destabilize profitability. It's definitely not a positive, but it's something that I think these guys can manage. There are other topics, though, in Autoland that probably are of more importance.
So to that point, Guy, I can't talk on Mondays either, or like most days, so it's all good. And you're jet lagged. Okay. Tom, to that point, Ford's getting hit a lot harder today, down over 2% versus GM. Is that a function of the elephant in the room that's EVs, or is it something else?
Yeah, it's the EV fallout. And you remember last week when they reported results, the stock was down 12%. So they are, they definitely are farther along on EVs. They have a much bigger fixed cost structure than, let's say, GM does. So with the EV slowdown, we saw what losses they had in 3Q, right? It was over $1 billion in losses. That's actually annualized to $5 billion of losses. So the EV slowdown probably hits them harder than it does GM. So it's just a follow through of that already happened.
Tom, is there any read across to the rest of the auto sector? If GM is paying this, is Tesla going to have to pay something similar, or is Tesla a different case? what does this mean for the supply chain story? How does this ripple through the entire industry?
Yeah, on UAW specifically, I think it really depends on the OEM. Certainly, my math that I did, that 100 basis point math, was only UAW workers. So it could filter out to other non-unionized labor. I'm sure that'll happen to some extent. But if you look at Tesla, a name you brought up, a lot of their workers are paid in stock-based comp. That's really the driving force there. And it's more likely for a software engineer, for example, you're going to get paid stock-based comp to work at Tesla than maybe a legacy OEM. So they may be less likely to really hunger for wage increases, which is really a feather in the cap of what Tesla has that no other automaker really can say they have.
Yeah, and that's why Tesla also operates in right-to-work states, right? Like they're just in different locations. That's also a different issue as well. Tom, I don't get the problem with EVs. Like there are subsidies. There are subsidies for building them. There is a big push into getting charging stations out. Like, what is the problem?
Yeah, that's the big question. I think there's no real long-term problem. I think it's just, we had a lot of early adopters that came in, a lot of Tesla people came in and bought $60,000, $70,000 cars. And now we're left with the rest of the folks, the kind of Main Street people, not the early adopters. So for them, they need to get their head wrapped around it. Charging infrastructure, as you pointed out, pricing they consider to be quite high. There's the potential culture war topic, right? We have to acknowledge that exists. So I think it's just something near term that's been happening. Over time, it'll dissipate. Pricing needs to come down. Charging infrastructure needs to get better.
So, Tom, when do we make that shift? When does an electric vehicle stop being a premium product?
That's a good question. I think it has to do with subsidies, IRA in the U.S. really getting to maximum benefits. It takes a few years to build these plants. I think battery prices need to come down, right? So right now it's probably around $150 per kilowatt hour. The break-even point with ICE is around 100. So we need to get some of the manufacturing that gets better, maybe better chemistries. LFP chemistry is a big direction. We've been doing NMC so far. So there's things that need to happen to get there, but I think we'll get there. We have the government subsidies. Batteries prices are coming down. It's just going to take some time.
It's just what we saw with solar and with wind. Like, we're going to get there. We're going to need the stuff, but it's really hard right now. It's just really expensive, and there are some serious problems. They're not going to work their way out in the next 24 hours. Hey, Tom, we love talking to you. Thank you so much. We really appreciate it. Tom Narayan of RBC Capital Markets. Thank you. All right, coming up, in today's Money Undercover, we're going to look at trends in private equity. Andrea Arkbach is a Cambridge Associates head of private investments. She joins us next. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
new money undercover, a look at less visible parts of global markets that are attracting more and more money. And today we're going to explore opportunities and risks in private equity. Joining us now, Bloomberg's Lisa Abramowitz. Lisa?
Thank you so much, Alex. This is going to be a really great conversation because we want to take a look at not only the opportunities to come, but what we have to deal with that was created, that grew up out of the financial crisis that was triggered by the pandemic. Joining us now, I'm so pleased to say, is Andrea Auerbach. She's Cambridge Associates Head of Private Investments and who's been in the market for a very long time, has extensive understanding of the different cycles. Andrea, I want to start with the reckoning that still has yet to fully be realized. How much more is there to go in private market valuations?
Yeah, wonderful question, Lisa, and the reckoning is underway. What we're watching right now is shifts and changes in valuations in the private markets, which tend to lag the public markets by a considerable distance, actually. So far, what we can tell is across more recent vintage years, think 2017, 2018, 2019, and 2020. And vintage years is a common construct in which we talk about the private markets. The returns in those vintage years have dropped an average of 1,600 basis points from December 21 to third quarter of 23. And then for venture capital, those same vintage year performance, those IRRs, if you will, have dropped 3,000 basis points. But we're not done yet, right? As we're waiting for the evidence of the companies that have been invested in, let's say the 21 calendar year, for their valuations to truly become more firm and more obvious to the rest of the market. So we're waiting. That reckoning is underway.
Andrea, just to sort of develop a little bit more for people who don't think of things in basis points, if you're going to compare in any kind of apples to apples way, which I know that you can't, but if you were going to, public markets with private market valuations, how does that equate? We have seen significant revaluation in just benchmark Treasury yields, right? 60% write-offs in some capacities. How would this compare in the certain private market assets?
So one of the ways we think about comparing the private market valuations to the public markets is we're watching the change in valuations from quarter to quarter, just like we would monitor the change in the valuation of the S&P 500, Lisa. And so one of the things we've noticed from COVID is that venture capital valuations spiked up by 90% as of December 21 and are now hovering at around 50% above COVID valuations, sort of the teeth of COVID, if you will, while the S&P 500 is up 75% from its COVID low. Let's use that as an example. So there's been a lot of volatility in the venture valuation. From a private equity valuation, it's actually been hovering at around 50% above COVID low and kind of just trending along sideways at the moment. So private equity is actually going to be a very interesting market to see where valuations head, given the increased interest rate environment and a lot of the unknowns that have become known affecting exits for that cohort of deals that were done a few years ago.
And you pointed to the idea that fundraising has really lagged, that it's at a 7-year low. You were pointing this out. So there's a question of where the opportunities are in the future and also how you get access to capital to invest in those opportunities.
Yes. So as you well observed, fundraising, it looks like it's trending to be at a very significant low compared to the last, let's say, 5 years, which actually means a couple of interesting things for investors that are able to invest today, right? Which is this year, 23, potentially 24, despite the increased interest rate environment, could be very good vintage years because capital is dear. There just isn't a lot of money coming into the market, which means there's less money to go into the transaction environment and acquire companies and potentially not aggressively bid up valuations, which are no longer supported by a zero interest rate environment either. So could be a very interesting investment environment for those looking and able to commit capital today. And Lisa, the one thing I'll add on that, because there's been a distribution drought, it's more difficult for certain LPs who may not have been receiving that capital to turn around and reinvest it into the markets. So again, it's a tight market, which could be good from an investing perspective.
How much are some of the LPs who you're talking to thinking about just the asset mix, about how much debt versus equity they really want to be going to? Since private credit, people are talking about a golden era, and private equity, people are saying, it's probably going to atrophy here.
Interesting question. And what I would say is private credit obviously looks much more interesting today, given the increased interest rate environment, tighter, let's argue, tighter, more calibrated underwriting that's happening, more honest EBITDA measurements being used to determine the level of leverage, among other things. And so the returns coming off of private credit are very attractive relative to where they were several years ago. And what I would say is institutional investors that are looking to augment or complement their fixed income exposure may fund private credit from that fixed income bucket, if you will. But some private credit strategies are knocking on the door of private equity returns in certain corners of the market. So we are definitely seeing an increased interest in private credit relative to private equity. From a private equity standpoint, Lisa, what I would say is many investors may have been overserved. Certain types of high aggressive, non-profitable growth tech strategies, and maybe wanting to augment that by adding some more value-oriented or defensive types of companies into their portfolio.
Just quickly here, I'm wondering, Andrea, how much do some of the LPs who you speak with count on yields returning back to something much lower than where they are now in order to make some of the investments work over the long term?
You know, given the investors that we work with at Cambridge Associates, many of those investors are expecting their illiquid book to ultimately deliver significant returns of capital so that they continue to field and fuel their specific mandates. And from a yield perspective and a private credit perspective, depending on the type of investor, insurance companies, pensions, et cetera, may really need to rely on that yield in order to fuel their programs for their constituents. So it's always a mix depending on the type of investor we're talking about.
Andrea Auerbach, thank you so much for being with us. Really appreciate the insights, especially at a time of so much mystery around an area that accounts for so much capital and so much investment. Over to you, Guy. Thanks so much.
Lisa, thank you so much as well. And our thanks to Andrea as well. A fantastic conversation. Money undercover. Let's talk about what else we've got coming up for you. It is an incredibly busy week. We're going to have the European close. That's going to be in the next hour because of the time change. We're also in Bloomberg Technology going to be hearing from SoFi's CEO, Anthony Noto, joining Bloomberg Technology. Caroline Hyde, Ed Ludlow, of course. That conversation coming up. That stock having a very good day. I'm fascinated to hear what Anthony has to say. Some great coverage coming up throughout the week from Alex and from me. This is Bloomberg.
Do you think there's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well? Or mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea. But technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
And the markets are on the move.
The focus, of course, is on Ukraine.
The market is so hyped up about AI.
Unless we see dramatic changes, it's just going to keep getting hotter.
The Fed, the market analysis, we're going to go
straight to some breaking news.
We'll have a full roundup.
Going through some of the numbers.
And what investors should make of them.
We have so many important conversations. Let's check in what you need to know.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg. From the heart of where innovation, money, and power collide in Silicon Valley and beyond, this is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
I'm Caroline Hyde at Bloomberg's World Headquarters in New York.
And I'm Ed Ludlow in San Francisco. This is Bloomberg Technology.
Coming up, we'll talk the state of fintech and, of course, earnings with the CEO of SoFi as the company beats and raises its revenue forecast for the year.
Plus, President Biden plans to issue a sweeping executive order on artificial intelligence today. We'll break down the details and its impact.
And we push ahead to the all-important Apple event of the year. It's the last one they have, and it's set to unveil 2 new Macs and processors later tonight at the Scary Fest. But first, let's check in on these markets because, look, there's a tug of war going on, whether it's geopolitics on the one side, whether or not it's, well, questions of whether the direction of travel we sold off too fast when it comes to tech. We're actually seeing money move into stock markets today, particularly the NASDAQ up a percentage point. Other benchmarks, well, rallying off of what have been oversold territory, particularly as geopolitics still does swell. And we're seeing some concerns about the conflict in the Middle East, but maybe not escalating the way that many had imagined. So we actually see perhaps a move out of some of the havens of choice. Yields actually pushing up on the 10-year yield. It's notable, though, also we've got the all-important Fed, and we've also got, of course, what we see from the Treasury in terms of bond issuance coming up for the last quarter in the next year. We're looking at crude just off by 3.5%, that really playing into perhaps some of the anxiety, just pulling back ever so slightly, cautiously, when it comes to, of course, Israel and Hamas. Let's move on and have a little look at, well, the risk asset of choice when it comes to the Bloomberg Technology. We're looking at crypto. Look, actually, not much volatility on a day where actually we've seen such buying in the previous week. There is still thin liquidity here, Ed, but we're seeing 34,000, a level that's being sustained for now. That's as the dollar is on the downside.
Yep, 3 single names I'm watching. The first is Apple. You have the Scary Fast event this evening. The expectation, a new iMac and an updated higher-end MacBook Pro, but also an emphasis on chips. We think they'll unveil the M3, latest generation processor. The stock being supported up 1%, then we get earnings on Thursday. Big week for Apple. Meta, actually some news out of Europe. The stock up 2.5%. We will have an ad-free, subscription-based version of the Facebook app and Instagram. That supported the stock in the session. One interesting name that we're watching is kind of the main one of the show is SoFi. This is an earnings story. We're down 1.7%. Following the open, we were up almost 15%. That is a big swing now to the downside, down 1.5%. Upgrading revenue guidance for the year, beating expectations on that front. Deposits tripling from a year ago and coming in ahead of expectations. But this is a really interesting stock reaction. Strange one, Cara.
And funnily enough, I'm pretty sure our next guest doesn't always want to talk about stock reaction, but will want to talk a bit more about the numbers. Let's bring in SoFi CEO Anthony Noto. And I'm sure you're going to say, oh, we don't go by the day-by-day fluctuations. What do you make, though, of the optimism originally seen around the numbers? And what more do you want to say to an investor base that maybe just, well, maybe take some profit on the day?
Well, first, thank you for having me. What I'd say is we're really excited about the results that we delivered today. I think they're extraordinary in a number of different ways and equally as positive on the outlook. There's very few companies that are driving durable growth the way we are, plus 25% revenue growth, really strong member growth at 47% accelerated. We had a record number of new members added as well as products, which is a testament to the value proposition that we're delivering. Our profitability continues to improve.
stories that
Taking you from the U.S. market's close
a lot of this was priced into the U.S. session
to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
This is Bloomberg.
Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. Time now for the ETF brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with volatility between treasuries and stocks. You're looking at TLT's 10-day volatility versus SPY. What you need to know is that is the highest gap ever. So that really tells you that the bond market has been more volatile than stocks, which we already knew. But let's also talk about emerging markets. This is an interesting one. This is the fund VWO. This is Vanguard's Emerging Markets ETF. You're taking a look at short interest right now, and it is super low, 0.01%. That is the lowest going back to 2006. So short sellers throwing in the towel when it comes to emerging markets. And let's quickly talk about what we're seeing in regional banks. We're taking a look now at KRE. This was the eye of the storm in March. And as you can see, this ETF really hasn't recovered from what we saw just less than a year ago, Matt. So it started to bounce a little bit in the summer. It started to give back those gains. And all told, it's a pretty scary chart.
Yeah, it's definitely not confidence boosting. Before we go, here's a look at another special ETF that will spook a lot of investors.
The 2x long VIX Futures ETF is one of the scariest funds around. It triggers a red light in the Bloomberg Intelligence traffic light system with a fitting 10 alerts for heavy leverage, daily resetting potentials, futures roll costs, and for the fund being actively managed. Better known for its ticker UVIX, this fund is not for the faint of heart. It's intended to be a daily trading tool, even if just for a few hours for sophisticated investors who demand the risk. How? By doubling the returns of the long fixed futures index for a single day. This particular index offers exposure to a daily long position in the first and second month VIX futures contract. The index rolls continuously throughout each month from the first month VIX futures contract into the second month with the goal of maintaining a 1-month weighted maturity. Along with SVIX, these funds from volatility shares are effectively revamped versions of ETNs that were sent to the graveyard in the February 2018 Volmageddon episode and delisted after the COVID turmoil. In addition to adopting the ETF structure, the new strategies use a time-weighted average price to set closing values rather than a 4 p.m. New York time VIX settlement price. Steady volume means liquidity is not an issue. UVIX is traded around 90 million in assets and is not cheap, with an expense ratio of 278 basis points. Since its revamp in March of 2022, UVIX has a scary return of about negative 95%. That dramatically trails the S&P 500 over the same time frame, but since it's meant to be a tactical product with jackpot potential, long-term performance may not matter to most investors, so use UVIX at your own peril.
Our own Charlie Pellet narrating that animation for us. You may recognize his voice from the subway.
Every day, twice a day, at least, when I don't see him in the office.
So it's Halloween coming up, and you're a city person, so you probably won't really trick or treat.
I mean, I don't have kids. I have a cat.
Also
so,
that.
Yeah, I feel like you need a smallish child in order to do that. What are you dressing up as Halloween?
I am going to be Fabio Di Gianantonio.
Okay.
Motorcycle racer, and I'll go around Scarsdale with my daughter Edna. She's going to be Moana.
Adorable.
Yeah.
Adorable.
And we'll eat as much candy as we can.
I'm going to be a cat, but I'm just going to be answering the door. But
a cat.
Yeah. So maybe I'll dress up as UVix, if you will. But
yeah, that would be more
fun. That would
fun.
require some exposition, a little bit of explaining, and it's an expensive product, so I don't know if I want to do that.
Yeah, but you're in the right place. If you're going to be in any city in the world and want people to know that you're UVix, this is the right city. If you can't get enough of ETFs, a reminder you can listen to Eric Balchunas and Joel Weber on Trillions. It's their podcast that covers the industry fortnightly. That does it for Bloomberg ETF IQ. I'm Matt Miller, along with Katie Greifeld. This is Bloomberg.
Paul Jacobson assured me that when he takes the new Hummer EV on long journeys, it's not just fun to drive, it's equipped to go the distance.
I hear so much about road trip anxiety that I wanted to experience it myself. My family likes to drive a lot, so I brought my daughter home from college in this, and it was great. I mean, the computer system is all intuitive. It tells you how to keep track of the battery. It tells you where the charging stations are. It tells you how much power you'll have when you get to the charging station. So it really puts a lot of your anxiety at ease. But as far as driving it, it's a treat.
So where are you on the charging stations? I know General Motors has made an investment in one company. How are we doing in this country generally in getting charging stations in?
So I think this is an area where obviously we can continue to improve as a country and a society. We're doing our best. We've committed almost $1 billion to EV charging. So we've taken that and looked at home charging solutions, local community solutions, and road trip charging solutions. With my daughter, what we would end up doing is probably stopping, grabbing a bite to eat, plugging it into a charger, usually a high-speed charger, to get as much charge as we can, and being there for 20 to 30 minutes. Get us a lot of range, and by the time we've used that range, we're tired, ready to stop again, etc. So it was a really good experience for me, and it's taught me, number one, what are the concerns of the consumer that are ultimately going to drive our vehicles, and then number two, where do we need to focus on addressing some of those anxious points for people?
Do you think there's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, or mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
And the markets are on the move.
The focus, of course, is on Ukraine.
The market is so hyped up about AI.
Unless we see dramatic changes, it's just going to keep getting hotter.
For further market analysis,
we're going to go get straight to some breaking news. We'll have a full roundup.
Going through some of the numbers.
And what investors should make of them.
We have so many important conversations. Let's check in what you need to know.
I'm John Olipman. Welcome to Bloomberg Markets.
And I'm Matt Miller. Let's get a quick check on the markets at this hour. We are seeing gains on stocks, even as yields rise as well. We're also listening to comments from Benjamin Netanyahu right now, speaking in English, talking about the Israel-Hamas war. Let's listen in.
Hospitals is the command post of its vast terror tunnel network. It will continue to use mosques as fortified military positions and weapon depots. It will continue to steal fuel and humanitarian assistance from UN facilities. While Israel is doing everything to get Palestinians civilians out of harm's way, Hamas is doing everything to keep Palestinian civilians in harm's way. Israel urges Palestinian civilians to leave the areas of armed conflict, while Hamas prevents those civilians from leaving those areas at gunpoint. Hamas is also preventing foreign nationals from leaving Gaza altogether. And most despicably, Hamas is holding over 200 Israeli hostages, including 33 children, holding them, terrorizing them, keeping them as hostages. Every civilized nation should stand with Israel in demanding that these hostages be freed immediately and freed unconditionally. I want to make clear Israel's position regarding a ceasefire. Just as the United States would not agree to a ceasefire after the bombing of Pearl Harbor or after the terrorist attack of 9/11, Israel will not agree to a cessation of hostilities with Hamas after the horrific attacks of October 7th. Calls for a ceasefire are calls for Israel to surrender to Hamas, to surrender to terrorism, to surrender to barbarism. That will not happen. Ladies and gentlemen, the Bible says that there is a time for peace and a time for war. This is a time for war for our common future. Today we draw a line between the forces of civilization and the forces of barbarism. It is a time for everyone to decide where they stand. Israel will stand against the forces of barbarism until victory. I hope and pray that civilized nations everywhere will back this fight, because Israel's fight is your fight. Because if Hamas and Iran's axis of evil win, you will be their next target. That's why Israel's victory will be your victory. But make no mistake, regardless of who stands with Israel, Israel will fight until this battle is won, and Israel will prevail. May God bless Israel, and may God bless all those who stand with Israel.
Israeli Prime Minister Benjamin Netanyahu there making a speech about the Israel-Hamas war, pushing back on any calls for a ceasefire. We'll bring you more on that conflict as it crosses the wire. John, right now I think we should get back to the business that we plan to cover today, because we have the end of the UAW strike, GM finally agreeing with unions a way forward, and that follows Stellantis on Saturday and Ford on Wednesday.
It does indeed, and I want to bring in Matt, Bloomberg's Detroit bureau chief, David Welch, who has been extremely busy covering every twist and turn and was busy breaking those headlines this morning on this GM portion of the story. David, how did that all come together? I mean, when did we find out that GM ultimately and the UAW seem to be finally finding a path forward?
It was fairly early this morning. They had some talks yesterday after the union had briefed everybody on the Ford deal, which is what set the pattern for a deal with Stellantis and then with General Motors. And look, everyone's being pretty hush-hush about it right now. All we know at the moment is that, like Stellantis, they had to agree to the pattern, 25% raise, cost of living allowances for workers, and some better pay and compensation for temporary workers, which was a big issue for the union. So those are the big deals, and we'll probably find out more detail to see if the GM contract varies much from the other two over the next few days.
So we don't know all of the details, but we do know that this is a pretty rich deal, David, and it strikes me that, if they want to add any new capacity, they're likely to do it in Mexico and Canada.
I think that's a very big possibility that the union has to look at here. Is they pushed up costs a lot. And to be fair to the union, a lot of this is making up for raises workers didn't get over the past 4 years because they had a contract. And because of a tight labor market, a lot of workers in other sectors did get raises. There has been some decent wage growth in this country along with the inflation we've seen over the past 4 years. But it's still a very rich contract for the union. They scored a lot of victories here. And I think it does, the companies are going to have to think twice about hiring new people under these terms if they're going to expand anywhere. And I think they'll look to Canada, which has a similar contract, but not quite as rich, and certainly Mexico, where the costs are far lower.
David, Thanks very much, David Welch, our Detroit bureau chief, covering the strike for us. And will be interesting to see also, how the UAW brings this, I guess it's got to be seen as a victory, right, to Spartanburg for BMW or to Fremont, for Tesla. We're joined by Betsy Stevenson, University of Michigan professor of economics and public policy. She joins us now. She was chief economist at the U.S. Labor Department and a member of President Obama's Council of Economic Advisors. Very impressive CV there. Betsy, what do you see in terms of the results of the deal that GM has struck, and obviously Stellantis and Ford as well with the UAW?
I felt like the UAW really had to be out there fighting for everything they could get. If we look at the shape that unions have been in, lowest unionization rate on record. So they're losing, market share in the economy. We also saw just tremendous decrease in real wages, meaning inflation-adjusted wages, relative to what non-union workers were getting. This was a time where unions had to prove themselves. I think they did. But I think that we shouldn't oversell the victory they got. They definitely proved their worth, and auto workers should be very pleased with the deal that was negotiated. But they had to fight tooth and nail to get something that, in a lot of ways was just making up for what they had lost due to not having cost of living adjustments during a time of unexpected high inflation, and then remaining to keep their foot in the door by agreements around unionization at the new electric vehicle plants and abilities to strike if plants are being closed. This is all about preserving unions. But, some of the big things they were looking for, coming down to a 4-day work week without sacrificing pay, they didn't get that. And so I think what we saw here was the limits of, workers' bargaining power right now.
Do you think that it will prove beneficial in terms of expanding union membership? Are they going to be able to convince employees at BMW, at Tesla, at Mercedes, at Volkswagen to join the union as well?
That's obviously the big open question here. I think they did prove themselves. And so I think they've got as strong a case as they've ever had to make to those workers that they're here for you. And there's really something to be said for centralized bargaining, that, having each and every worker trying to negotiate this on their own is just not working. And what we've seen is the labor share going down while shareholders are getting a big chunk of the revenue, a bigger and bigger chunk of the revenue. So unions have proven their worth, and now they're going to have to go out there and make the case to people who would join a union and pay those union fees and hand over some of their own autonomy for negotiating to a union. I think there's a case to be made, but I want you to realize that they're in a decline. So even if they make the case and get some victories, what they may be doing is stemming the decline rather than actually seeing unionization grow. At 6% of the private sector unionized, we're not going to see unions making a huge comeback anytime in the United States. What they've done is shown that there's still a place for them in American society, but there's a long road to go for them to really become a bigger player in the labor market again.
Betsy, you talked about the UAW fighting for all it could get. You wrote last month about the fact that we have seen so many strike actions, in part because both sides aren't exactly sure what ultimately the right math should be, and that has played, the idea of uncertainty has played a role in some of the strike action that we've seen. What's been your general observation on the fact that we've just seen so much strike action, period?
When the unemployment rate came below 4%, a lot of economists were like, whoa, that's it. That's as low as unemployment can go. And now what we're going to see is just massive wage gains because workers have all the bargaining power. And that's one of the reasons everybody's so worried we couldn't get inflation down, because with all that really, really tight labor market, workers with all that bargaining power, the fear was it would spark inflation. That's not actually what we saw. Now, that means two things. It means, first of all, that we shouldn't overinterpret low unemployment as saying that the labor market can't expand any further. But that also means that low unemployment didn't mean that workers had quite as much bargaining power as some economists might have thought, particularly the economists who are saying, unemployment's going to have to go way back up in order for us to bring inflation down. I think what we've seen in these negotiations is that workers are in a better position in terms of bargaining power than they were, say, 4 years out of the 2008 recession. That's unquestionably true. But I think we've also seen that there's a limit to how much bargaining power they currently have right now. And when we're just not really sure how much workers can get, how much employers need to give, that uncertainty is what creates the clash and therefore the strikes. So I think we're going to continue to see workers pushing for as much as they can get and employers holding on and giving only as much as they think they have to give. And we're going to see those erupt into some strikes like we're seeing with pharmacists.
Betsy, great to get some time with you. Hope we can get you back soon. Betsy Stevenson there from the University of Michigan talking to us about the end of the strike and unionization in America. I want to just to recap what we were hearing earlier from Israeli Prime Minister Benjamin Netanyahu. He just wrapped up some remarks about the war in which he was pushing back against calls for any kind of ceasefire with Hamas. He gave us those remarks in English just to point out that he's giving them to us. He also dismissed any calls for his resignation as prime minister. He said in the past, and I'm sure many others in the government are saying as well, that's something for after the war. Right now, let's focus on crushing Hamas, and that is obviously their main goal. So we'll keep you updated on any developments out of Israel as the day goes on. This is Bloomberg.
I think this will probably go down in history as one of, if not the largest financial crime ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Season is here.
Tons going on, lots of earnings.
Beat wherever you look.
Bloomberg breaks the numbers first.
It's a tale of two earnings. Results from Goldman Sachs, Bank of America, and Morgan Stanley.
Netflix is out, guys.
With exclusive expert analysis.
Recovery is underway.
They crushed it. It was one of their best quarters ever.
This is a story all about pricing power.
We're going to make more money. We're going to make more money. And we're going to make more money.
We're going to make them bank. And I think that is what we can take away.
Bloomberg Television and Radio. Context changes everything.
This is Bloomberg Markets. I'm John Olupin with Matt Miller. Time now for our stock of the hour. We continue to cover the GM tentative deal with the United Auto Workers, and the most telling stock story is the performance over the past 6 weeks since this all unfolded. GM's market value has declined by more than $9 billion, with the strike, Matt, taking a big bite out of profits, but also, as we learned with the reporting of their latest results, forcing GM to pull its earnings guidance.
Yeah, and also forcing Ford to do the same. Let's bring in Jessica Caldwell, Executive Director of Industry Analysis over at Edmunds. And Jessica, you know, I think we all hope that the strike is over. They've got agreements with, the UAW has agreements with the big three. They still have to ratify those agreements, which is why we're not 100% certain. But when we look back, you know, in next earnings season, what are we going to see in terms of the damage done, in terms of both the top line and the bottom line? What do you expect?
Yeah, I mean, they've already sort of hinted to what has cost them. I think GM had said last week $800 million and $200 million for every week going forward. Ford said over $1 billion. So this is going to take, you know, a bit of hit, which isn't a surprise considering how long the strike had been. It's been since September 15th. And I think a part of the reason why we're seeing it the end is that the UAW started to pull some of its big cards out by closing factories like Arlington, Kentucky Assembly. Once those go, those are the big players in terms of the bottom line for both of those companies. So we knew that it had to be kind of coming to the end because they do not want to lose too much production there, because that's what they're gonna, you know, that's what they're gonna be selling, and that's what so much of that earnings relies on. Those are the products.
And Jessica, if we're going to try to get a sense on the focus on vehicle sales for these automakers, but also where the consumer appetite is, because if we had talked to you, you know, 7 weeks ago, I'm sure we would have been talking about the EV transition and how these different automakers are navigating new vehicles that are part of their big future versus some of their legacy products. And the economy itself is a big question going forward. So what are you seeing and hearing right now?
Right. I mean, I think EVs, we just have to put to a side at some point. We have seen over the past few weeks, they're putting pins in some of the programs as we kind of develop what that demand actually is. So I think right now what we're looking in the short term is how profitable will those factories and those car lines be that make them all of the money, the truck factories, the large SUV factories. We know that cold weather months are approaching. That's when those vehicles tend to sell the most. So you want to do all the all-wheel drive, full-size trucks. That's what contributes to the bottom line. So the fact that they're able to kind of move on and not be that affected by the strike in terms of product production, that's definitely key. But yes, I think it has been an interesting transition where we're talking about the future holistically with EVs, but it's very uncertain, and them trying to suspend some of those programs and take more of a realistic look at what the next few years looks like is probably an important part of this entire story as we look at just their profitability overall.
Yeah, you know, David Fickling wrote an interesting column for Bloomberg about the electric car market and the demand really just not being there anymore as much as everyone, probably the automakers as well, thought it was going to be. The ICE production and the big trucks that you're talking about with these huge margins are partly that profitable because they haven't really had to put a lot of investment into development on that side of things. They figured we're going to make EVs in the future, so why, would we want to develop this, for example, at GM, the 6.2-liter V8? It's a fantastic engine. Everybody likes it. Let's leave it as it is. But are they going to have to start putting more money onto the gasoline side of things if they produce fewer EVs?
They may have to, and I think that's a part of this whole transition is no one knows exactly how fast or how slow it's going to go. I think there were bets last year that we had it transitioning a lot quicker. Now we're seeing market is slowing down, high interest rates. People don't want to put the money out for these EVs. Maybe they're not even ready to transition to EVs. So automakers have to pump the brakes on that. And then what happens in the interim is that there is a refocus on some of the internal combustion engine vehicle programs that are going to get them through the next few years and are ultimately financing the transition to the electric future as well as autonomous technology, because we know that there's not really profitability in EVs yet, even the ones that they do sell. So there likely will be a reemphasis, but right now it's a tough time because they're juggling so many things. It's essentially running one business, the ICE business, and then also planning for this new future, which, they really haven't had to do. Autos have stayed the same for so long, and now suddenly things are changing at a rapid pace.
Insightful analysis as always, Jessica. Thanks so much for your time. We appreciate it. Jessica Caldwell from Edmunds, and we'll continue to track the auto story. Coming up, the market's waiting to hear the latest from the U.S. Federal Reserve on Wednesday, but investors may be even more focused on an announcement from the U.S. Treasury that same day. We'll explain why next. This is Bloomberg.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets. China open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg.
This is Bloomberg Markets. I'm John Oakman with Matt Miller. Time now for today's For What It's Worth. How about $114 billion in a week where the Fed's interest rate decision is seen as the main event? The Treasury Department's new borrowing plans could steal the show. We're awaiting the so-called quarterly refunding announcement, which gives us a sense of the government's needs in the face of big deficits. Right now, many bond dealers, Matt, are predicting the refunding size to be around $114 billion. So we're going to be watching that very closely.
Yeah, absolutely. We're going to find out. I believe it's at 3 o'clock this afternoon exactly how big it's going to be, and then we'll find out the details of their plan to raise that money on Wednesday morning. Let's get to the corporate side of issuance, though. This week is off to a fast start with Morgan Stanley, Hyundai, and others all announcing deals. It's the busiest day since Labor Day in terms of issuance. Joining us now to discuss why we're seeing this rush is Bloomberg Credit Markets reporter Olivia Raimonde. Olivia, thanks so much for coming on set with us. So why is this such a busy day in terms of one-day issuance?
Of course, yeah. Thanks for having me on. What's happened is that we've created a very small window for which companies can come. And the reason for that is over the past 2 weeks, a lot of deals were sidelined because of rate volatility. And then if you look ahead to this week, you have the jobs report, the Federal Reserve is meeting, Treasury auctions, all things that could really inject some volatility into the market. So corporations are rushing to issue now before things maybe get rockier.
And Olivia, right now with the Treasury yields where they are, you keep hearing this narrative around higher borrowing costs, possibly making life more challenging for a lot of businesses. But in your story today on the high-grade bond market, for example, we do see companies that are at the ready with a lot of creativity. What would you say in terms of how they're approaching financing right now?
Yeah, I mean, rates are certainly higher. I think what's happening is that the market is beginning to adjust to the fact that it might be higher for longer. We've definitely heard of companies trying to hold off, especially last year, from issuing because they wanted to wait until rates potentially got lower. Now that does not seem to be happening, it's prompting more borrowers to come to the market.
We were talking with Alex Morris earlier from FM Investments about the Treasury, and he was saying, you know, they're going to want to go more short-term maybe because they're going to have to pay up for duration. On the other hand, the shorter you go, obviously the more often you have to do it, come back to the market. So what do you expect in terms of the individual deals that we'll see?
Yeah, it's really tricky. I think most companies are looking to issue on the short end because of what you just said. They do not want to lock in these higher rates at, for 40 years. But Bristol Myers actually was in the market today to help fund an M&A, and they issued 40-year debt. So for the right price, companies are willing to do it. And there is really strong demand. With yields this high, we're seeing a lot of strong institutional investor demand for these bonds.
I can imagine people want to get in on that. Olivia, thanks very much. Olivia Raymonde covers the corporate credit market for us. We are seeing, John, a spike in the S&P right now. We're trading right around session highs on stocks. You can see right now 41.66 the level there, even as yields rise on the 10-year to 488.36. For John Ehrlichman, I'm Matt Miller. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
The top names at the Fed are on Bloomberg.
The economy is handling much higher rates, at least for now, without difficulty. So notionally, that might tell you that the neutral rate has risen, or it may just tell you that we haven't had rates high enough for long enough.
The bond market has tightened quite considerably. If financial conditions are sufficiently tight, our work is not necessary because we don't need to boost them more.
Nobody covers the Fed like Bloomberg. Context changes everything.
From New York City,
in London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
U.S. stocks resume their winning Mondays. Live from Studio 2 at Bloomberg headquarters in New York, I'm Scarlett Fu.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. And with about 2 hours ago, you're actually looking looking at an S&P 500 at session highs right now. Still have a little bit of wood to chop before we get there, but the S&P 500 up by 1.2%. Big tech, too, also up. The NASDAQ 100 up by 1.1%, even though we are starting to see that sell-off in the bond market resume. You have 10-year Treasury yields up by about 5 basis points right now at 488 or so, below that 5% level that we just touched last week. And I also wanted to talk about crude really quickly here, Scarlett. Of course, I remember when we were talking about $90, $100 a barrel just a couple of weeks ago. Right now, crude extending its slide down by about 3.3% to under $83 per barrel.
Yeah, very volatile moves in the energy space. Also a truly epic week on the calendar. You've got Apple earnings, the jobs report, and policy decisions from 3 major central banks, including the Fed. But what may end up being the most consequential is the U.S. Treasury's quarterly refunding announcement that could send bond yields climbing. It is the government's new borrowing plan that will reveal just how much Uncle Sam needs to ramp up debt issuance to fund the widening budget deficit. And forget AI. Weight loss drug makers are the better bet. That's according to the majority of investors in a Bloomberg survey. They say Novo Nordisk, which makes Ozempic and reports earnings this week, is a more attractive investment opportunity than Nvidia. The backdrop here is that U.S. stocks, especially the Magnificent Seven, are seen as overvalued. And as such, most respondents see the NASDAQ 100 and S&P 500 posting losses for this quarter, which sets us up perfectly for how earnings estimates are now looking against this weaker equity backdrop. And Katie, you've got the numbers. What are they showing?
They're not good, Scarlett. You take a look at the equal-weighted S&P 500. You actually have earnings estimates for future quarters coming down. Of course, we're in the thick of earnings season right now for the third quarter, and hasn't been too pretty. You have seen a little bit of an uptick when it comes to profits, but you wouldn't necessarily know it looking again at the equal-weighted blended forward EPS. That has been coming down, and we're looking at the equal-weighted index here, which really strips out the power of big tech, and you can see in white that that index has really taken a beating. But even still, what we're seeing in the equal weight, in the market cap weight, you're starting to see investors try to call the bottom here. You're taking a look at CFTC positioning data right now. We had a really huge net short buildup in the S&P 500. That's flipped, Scarlett. Now we're back to a very small positive in the S&P 500 futures. So we'll see if some of these bottom buyers are rewarded or whether they're just setting themselves up for more pain.
All right, great wrap up. So let's kick things off with Kuei Wynn, CIO of Equity Strategies over at Research Affiliates, to get her take on where we stand in the equity market with earnings feels like more than halfway through. Kuei, what is your take? Clearly there's some extreme positioning. There's a lot of concentration risk in equity markets, but have the declines that we've seen brought valuations down to a somewhat more reasonable level?
So I think it depends on where you're looking at in the market. I mean, clearly what we've seen is a massive amount of concentration in terms of performance and now in terms of the broad indexes. So it's not just happening in the U.S., though. I mean, the U.S. has really come to dominate global stocks as well. So if you look at the global index, of the top 20 stocks, about 19 are U.S. companies. And the only one that's not a U.S. company is Taiwan Semiconductor. And so not only do you have a concentration in the U.S. market in particular, about half of those 20 stocks are in the tech or fintech ecosystem. So what you're seeing is a massive amount of concentration. And at the backdrop of geopolitical uncertainty and higher interest rates, that understandably leads to higher volatility. And so one of the problems we have is, are markets overpriced? Markets are only overpriced if they don't deliver the goods. And what we see is that when stocks are priced for perfection, anything less than perfect in terms of earnings results in outsized price repercussions. So a good example is Google. Beat earnings estimates, had great EPS, except that their cloud business wasn't as good as expected. A slight flaw, and they got severely punished. So we'll see. That said, I'm sorry, go ahead.
No. It's clear that the bar has been set a lot higher with the gains that we saw earlier this year. What does this mean, Kuei, for the prospect of a year-end rally that typically people look towards?
So first of all, I just want to say that downward revisions in estimates and earnings at this time of year are not that unusual. People always start the year with very, very lofty expectations. Reality sets in, and then you can have more realistic growth through the end of the year. If you look outside of the Magnificent Seven, you actually find some stocks that are very reasonably valued. So if you look at a value-oriented index, such as our fundamental index, index, the Research Affiliates Fundamental U.S. Index, you'll find multiples of around 14 times earnings compared to 20-ish for the S&P. So it just depends on where you're looking. And with volatility this high, it usually portends room for a rebound going into the end of the year.
Clay, what do conversations with clients sound like? Because, of course, if you look at value indexes, to your point, maybe you'll find some bargains there, but you take a look at fund flows, you take a look at performance. When you see big tech reassert itself, that becomes a very painful trade. It just feels like, in general, investors are hesitant to go too heavily into it. So how do you sort of advise your clients that now's the time?
We don't advise our clients to go on one side of the boat versus the other. I mean, I think that a good portfolio is really relatively balanced between value and growth. I think what happened leading into 2019, 2020 was everybody piled out of value into growth, and many people missed the opportunity to rebalance into value. So our message is not necessarily buy lots and lots of value, but that value really has a place in the portfolio. And if you miss the opportunity to get back into value in 2020, 2021, then now gives you a really, really great entry point.
And how do you think about the volatility that we're seeing in the fixed income markets and how that's translating over to equities? Because over the past several months, obviously, the bond market's volatility, it feels like it's really spilled over into every market, including equities. Do you look through that, or what signals, what takeaways do you take from that?
So higher interest rates and higher fixed income volatility keeps a damper on equity valuations. So it's not necessarily that valuations have to fall from this point. It's just that, unfortunately, they don't really have a lot of room to expand. And so what you really need to look for is, are the earnings going to come through? That will ultimately drive the equity returns. And so far what we're seeing is earnings are okay. They're not great. And so what we're seeing is sort of mediocre equity returns and a reset in terms of expectations. Having said that, it's not unusual for an equity market to correct about 10% in any given year. It doesn't necessarily portend, a market collapse or any sort of a crisis in that regard.
I like that summary. Okay, but not great earnings. Quay, really appreciate your joining us. Quay Wynn is CIO of Equity Strategies over at Research Affiliates. Coming up on the close, the Fed, the Bank of England, the Bank of Japan, all out with rate decisions this week. We'll get a preview of what to watch for.
Plus, AI regulation is one of the big topics as AXA releases its Future Risks Report. We'll hear from our interview with the CEO at the Martin Trust Center for MIT Entrepreneurship.
And McDonald's tops estimates on higher prices. What happened to value meals, even as U.S. customer traffic dipping for the first time this year? We take a closer look at what this means for the broader economy. This is The Close on Bloomberg.
Do you think there's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well? Or mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea. But technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
here.
Tons going on, lots of earnings.
Beat wherever you look.
Bloomberg breaks the numbers first.
It's a tale of two earnings. Results from Goldman Sachs, Bank of America, and Morgan Stanley.
Netflix is out, guys.
With exclusive expert analysis.
Recovery is underway.
They crushed it. It was one of their best quarters ever.
This is a story all about pricing power.
We're going to make more money. We're going to make more money. And we're going to make more money. We're making bank. And I think that is what we can take away.
Bloomberg Television and Radio. Context changes everything.
AXA has released its 10th Future Risks Report, and the CEO discussed key factors, including climate and concerns, of course, around AI. He spoke with our own Romain Bostic at the Martin Trust Center for MIT Entrepreneurship in Cambridge, Massachusetts.
Climate risk has, apart from the year 2020, where we were all suffering from COVID, been the number one risk. But over time, it has really become also more homogeneous across all segments of the populations in all countries. And what you obviously see that other risks, in particular geopolitical risks and technological risks, have really risen over the last couple of years. And I guess that will not be the end when I think about the 11th and the 12th edition.
What progress do you think that we've made in trying to address not only just climate change overall, but some of the targets that nations have set for themselves coming out of either the Paris agreements and some of the interim agreements since?
I think we've made a lot of progress in terms of conscience and readiness to tackle the issue. When you look at today, the various strategies, in particular of companies, in really wanting to tackle climate change, a lot has happened. I would say today we are still, unfortunately, in the space of listing the intentions. We're not yet in the space of a full-scale implementation of these transition strategies. And I think that's where we need to come next. And secondly, I believe that the governments also need to follow what the companies have done in terms of their own climate transition, which is also an area that needs to follow now.
Another interesting data point that came out of the report was around how people viewed artificial intelligence. There seemed to be a broad understanding that there is a tremendous amount of risk there. There also seemed to be a broad understanding that addressing that risk right now is woefully inadequate.
Yes, so I believe AI opens a new chapter for our societies, and when you look at it with entrepreneurial glasses, the entrepreneur always looks at what is the upside first, and then looks at what do I need to do to protect myself against the downside. I guess the public debate started this time very much around what are the downsides without ever talking about the upsides, and I think getting this balance right going forward seems to me very important.
Just this morning, before we began our conversation, the Biden administration here in the U.S. released basically, finally, their own guidelines for what they want to see with regards to AI protections. And this really only applies to what the government purchases, but it was pretty broad-based. It really did restrict a lot of what these companies can do, how they use that data, whether they are actually supporting broader initiatives with that data here. Do you think we need to see more of a global framework towards AI and its regulation rather than just individual countries putting things out?
It would be preferable to have a global framework. I mean, what we have done around the whole question on climate, we could actually also apply to have an international energy association also for AI. But given the context in which we are in, it will be very difficult to assume that it's going to happen now. So ideally, what we should do is certainly in certain blocks of governments that can work better together than others, make sure that we agree on principles that apply then to a larger range of countries.
And Romain is in our Boston bureau right now and joins us with more on his conversation. So it's interesting that he says the climate change discussions can form a framework. It took us decades to come to any kind of agreement on what to do about climate change.
I know. It was an interesting comment because, of course, he's talking about COP28, which is still kind of really more about resolving business from almost 2 decades ago. And this idea that we would have sort of enough stability, global stability, to create a broader framework for AI. I don't know. I mean, he's a pretty optimistic guy, I can tell you that, and he seems to think that we'll get it done. But right now, when you look at the geopolitical landscape, both the willpower that governments have and even to an extent the public, right now there's just very little confidence out there that we're prepared right now for what AI is going to bring.
And it's not just governments, too. I mean, you look at the details of this survey, and it's private companies as well. Just 16% of those experts saying that corporations are prepared for these risks.
Yeah, and I mean, we're talking about when you go through all the risks that are in this report, from climate change to geopolitical tensions to income inequality, the confidence that these survey respondents had in the ability for the government or corporations to mitigate these risks, it was the absolute lowest level of confidence when it came to AI. They basically just said, we're not prepared here. And, you know, this whole report kind of looks at the idea as sort of what sways into a solution. And even the report was kind of inconclusive. And when I talked with Thomas about this, he was kind of very clear here that right now, there just is nothing out there. This is kind of everyone doing their own thing. There are going to be a lot of benefits, but the risks are very prevalent, and there still has not been a solution to address them.
What other risks did he cite beyond AI, beyond climate change? Because it's interesting that AI was obviously a concern, but it came in 4th overall among all the emerging risks.
Well, right above it, well, climate change was number one, but it's been number one more or less for the last 6 years, with the exception of the pandemic year where the pandemic took over. But then once you get beyond that, it's about the geopolitical tensions. It was also about cybersecurity, which was number 3. And he said this is a big deal, and it kind of dovetails with AI as well. But this idea that you can sort of instigate, I guess, warfare, and I use that term very broadly, from, you know, the seat behind a computer. And there are a lot of companies and a lot of governments that really haven't adapted to this new reality.
All right, Romain, great interview. Appreciate your time, of course. That is Romain Bostic.
Yeah, anything for you too. Yeah.
The co-anchor of The Close. He'll work his way back to New York City. But before he does, coming up on the program, big week ahead for central bank decisions. We'll break down what to expect next. This is The Close on Bloomberg.
I think this will probably go down in history as one of, if not the largest financial crime ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
The Fed, the Bank of England, and the Bank of Japan are all out with rate decisions this week. Ludovic Sobran, Allianz chief economist, joins us for more on what we can expect. And Ludovic, I suppose we kind of know what the BOJ is going to do. The Nikkei reported that the Central Bank of Japan will discuss a further tweaking of its yield curve control at its policy meeting tomorrow morning, and is likely to allow more flexibility. And we saw the yen surge as a result. How much do you trust this report?
I think it's
pretty trustworthy actually, and that's quite a surprise. You saw the yen and the bond, the 10-year bond, Japan 10-year bond actually moved to it because I think 25% of observers were actually waiting for this yield curve control bands to expand. I think some bankers actually reported the possibility of increasing the threshold to 1.5%. After having had increased to 1%. So I think it's quite a huge move, right? And I think it's pretty interesting to see that the inflation reports in Japan were not good, but also the pressure. The BOJ was basically doing QE yesterday. They've been buying bonds like there's no tomorrow because they wanted to be within this range. So I think widening the range lowers the pressure, but we still have extremely low yen, and we still have, it's a global tightening cycle. So Japan cannot defy gravity forever, and I think that's why markets get a bit excited about this news, even though it looks a bit far, because it has global effects on, who's going to buy, Eurobonds, for example. Who's going to buy also into the rally in the US right after the sell-off we've seen. So I guess it's quite important to see what's happening in Japan right now, even though it looks quite far.
Yeah, Japanese fund flows of huge importance to the rest of the global markets. The BOJ introduced yield curve control back in 2016 as a way to, cement control over monetary policy, keep its policy loose. How would you grade the effectiveness of it? Is it an A, a C+ effort?
I think it's quite effective. Actually, it's a very cautionary tale for what could happen to maybe Europe going forward as fragmentation risks increase. We see you guys look at the 5% US 10-year yield, but we look at the Italian 10-year BTP also at 5%. So everybody's looking also at this spread control mechanism that the ECB has been mentioning, the TPI, the transmission policy instrument, because that's maybe a cue for us to see what happened with Japan. And more globally, I think if we are serious about climate change and greening monetary policy, we may have to revert back to some form of yield control, because some of these investment needs to green the future, to green investment, may actually require yields to be under a certain level, so that the fiscal discipline on the real rates, which is already quite high, and we see that this debt servicing costs are increasing everywhere, could be lessened for the green investment. So whatever lessons we get from Japan, we should really take them seriously and also look at whether they are transferable to other parts of the world. But I would say for Japan, it worked. It was like a B+.
Okay, B+. It's not bad. That's passing and then some. If we look over the totality of this week, of course, we have the Bank of Japan, we have the Fed, and if I can be honest with you, that's what I'm really focused on. Is that a mistake? Should I, also care about what we're going to potentially get out of Norway, elsewhere in the UK as well?
I think the UK is quite interesting because I think it's one of the central banks where it's a catch-22. I think the UK is one of the few countries in the world where there is a risk of a wage price spiral. We expect wage growth to be around 8%. We see, UK households taking credit like there's no tomorrow. The political, backdrop is also quite interesting because they are talking about elections in a year from now, but nothing is confirmed. So there are several policy changes that have been happening. So I think, the Bank of England is expected to keep rates unchanged, but that could be a mistake because there is, everywhere you look, there is this risk of overheating, and there is this need maybe for the Bank of England to go one notch higher. So that could surprise market. But of course, talking about the US, because everybody has been very worried about the bond routes over the past couple of weeks, I think, the Fed is going to skip. We still believe at Allianz that the Fed may actually increase one more time in December. And of course, what is much more important now is to understand the equation with QT, the quantitative tightening pace, whatever fiscal deficit financing the Treasury needs, and Wednesday is this big refinancing report, so everybody's going to be looking also at this, and whether there could be some additional pressure on the 10-year yield of the US, right? Because in all models, I think everybody expects the 10-year to go back to 4% sometime, in the middle of next year. But it could be that there are some resistance factors because of this mismatch. Everybody's looking at that. So that's why whatever comes out of the Fed is actually important for the US, but also for the rest of the world, as you can imagine.
All right, Ludovic Subran, thank you so much. Allianz chief economist for joining us, giving us a preview of the big central bank meetings. Katie, I love the fact that you threw the Bank of Norway in there, just for kicks.
I mean, they're on the schedule, so we do have to pay a little bit of attention. But I mean, between the Bank of Japan and the Fed, it's going to be a really important week. Also, it's not just the Fed. We also have the Treasury Department playing a starring role in this week's drama when we finally get that refunding announcement. You think back to the last refunding announcement, that was a surprise. They said that they were going to sell off more debt than had been expected. things have been weird since.
Yeah, things have been really weird since. This whole idea of there's too much supply, where's the marginal buyer? The buyers have all disappeared. We start off at the Bank of Japan. The central banks around the world, including from China and from Japan, maybe they're not soaking up as much as the Treasury supply as they did before. So who does that leave us with?
Not the Fed. Not the Fed.
Not the Fed either. Yeah, they're out of the game, right? They're net sellers.
Yeah. So I mean, the concept of there being a lack of price-insensitive buyers, it's a pretty scary thought, the day before Halloween. But we'll see what we actually get from the Treasury, what we get from the Fed, and all of that looks forward to the jobs report that we get on Friday.
And the best part of it, the Treasury refunding announcement comes a couple of hours before the FOMC decision on Wednesday at 2 p.m. So just to make Wednesday extra interesting.
Oh, yeah. Yeah. But in any case, take a look at these markets. You are looking at a rally on your hands. You take a look at the S&P 500 rate now, Scarlett. I see it higher by about 1%. Not quite session highs, but almost.
So that correction was pretty short-lived in the S&P, right? I mean, it's not yet at 4,200, but that dip from the July 31st high to Friday was just over 10%. Now we're within that 10% band again.
Well, it'll be fascinating to see how we settle up at the end of this very busy week. Much more markets coverage coming up. This is The Close on Bloomberg.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
check as we head towards the close of commodities markets. And Abigail Doolittle has been looking at the declines in the energy complex.
Yeah, for sure. And stocks may be higher, but overall, we do have the commodity index, the Bloomberg Commodity Index, down about 1%. And these are some of the biggest drags, really, to your point, Scarlett, here in the energy complex. New York crude down 3.7%. And it has something to do in part with the fact that German consumption is expected to drop in 2023 by about 90,000 barrels per day. We also have the fact that the Middle East conflict remains somewhat limited amid Israel's push. So there are less concerns around supply constraints. Natural gas down 3.6% on milder weather. Wheat down for a second day, down 1.7%. And we have corn down about 0.5%, so some weakness for the grains. Now, relative to oil, we've been talking about the possibility of a big move. If we just check in on it quickly, it's probably likely. So overall, you can see oil out of June is in an uptrend, but this consolidation, all this volatility, the near-term uptrend has been broken. The longer-term, medium-term uptrend has been broken. There's an area of congestion here that suggests we could just see oil drop down toward, I don't know, let's call it 74 to 76 in pretty quick order, Scarlett.
Yeah, that would continue the volatility we've been seeing in oil prices ever since the start of the Israel-Hamas war. We'll keep an eye on that one. Thank you so much, Abigail. Now, in a week where the Fed's rate decision might be seen as the main event, the Treasury Department's new borrowing plans could actually steal the show. The quarterly refunding gives us a sense of the government's needs in the face of big deficits. So joining us now is Ira Jersey of Bloomberg Intelligence. And Ira, we know we get a lot of details on Wednesday, the same day as the Fed announcement, but actually we get a preview of everything today, right?
3 o'clock, in less than half an hour, we're going to get what the borrowing needs are for the next 2 quarters, or what, anyway, the Treasury Department thinks that they'll need. Remember, this is based on their own assumptions. Now, the fourth quarter, what's interesting about the current quarter that we're in now, it's actually usually pretty easy to forecast. It's really the first quarter of the year when you get all these tax receipts and also tax refunds that come in that winds up being pretty volatile and a little bit harder to forecast. But it's almost guaranteed that the government's going to continue to need to borrow a fair amount of money, and we're going to see increased issuance over the course of the next couple of months at least.
So we'll get a few more details in less than 30 minutes time. And of course, once we get those details, we look forward to Wednesday and the refunding announcement that we'll get at 8:30 a.m. Eastern. What are you expecting in terms of the split of those new issues between the short end and the long end?
Yeah, so my expectation is that they'll issue more bills, a little bit more front end than the long end. And the reason is because the government wants to minimize its borrowing costs to the taxpayer. Now, you might say, well, because the yield curve is inverted, if they're issuing more 2-year notes and 3-year notes as opposed to 10s or 30s, isn't that actually increasing the amount of interest? Well, that's true in the near term, but if in 2 or 3 years from now, interest rates are lower, it means that the Treasury Department can refinance that debt at lower interest rates than what they can issue right now. So it's instead of locking in for 10 years or 30 years, they can do shorter term debt. So I think that they'll still probably grow everything throughout the curve, just a little more slowly in the long end than they did in August, which was one of the reasons why you saw a pretty decent sell-off the last time that they had the quarterly refunding.
Yeah, it feels like the Treasury, the U.S. government, is kind of like U.S. homeowners just waiting for the opportunity to refi on their mortgage or on their debt. What would this mean for Fitch and the other ratings companies that are looking at the U.S.'s credit rating and determining our credit worthiness?
Yeah, I think it's not going to change that much right now because we know that the deficits are going to stay reasonably high, 5-ish% of GDP and maybe a little bit more. But they will continue to look at it. Remember, Moody's is the only company right now that probably is going to have to make a decision whether or not the United States remains AAA rated. I suspect that maybe over time we'll get more rumblings of that. But the U.S., unlike say emerging market countries that have a lot of their debt in foreign currency, the U.S., like Japan and like England or the United Kingdom, they have all of their debt in their home currency. So the chances of default actually are very low in those situations because you don't have to worry about a currency crisis. Now, what it does do, though, however, is it reduces fiscal flexibility, right? So you have a ton of debt, you have to refinance that, you have to pay a lot of interest on that debt. So it doesn't give Congress a lot of wiggle room as to what they can do with the rest of the budget. And that, I think, is kind of the more concerning thing that will continue to happen as deficits are so large.
Well, Ira, I know you're going to be a busy man this week. Really appreciate your time today. Our thanks to Bloomberg's Ira Jersey. Now, still ahead, a supersized beat on sales and profits for McDonald's. We'll talk about what the future holds for the Golden Arches. That's up ahead. Stay tuned. This is The Close on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability. And so they are looking at brands that are greener, but you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
From New York City.
In London, in Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside? Time now for top calls. Look at some of the big movers on the back of analyst recommendations. And first up, we have AbbVie. Shares on the move after Barclays upgraded the stock to overweight. The analyst says that the drug maker's top-line evolution over the next 12 to 18 months is clear, and he's confident on, quote, the timing of the trial. Shares currently up by about 2.8%. Next up, we have Chevron getting fueled up over at Bank of America with an upgrade to buy from neutral. The analyst says that the sell-off induced by the Hess deal is, quote, overdone, and that weakness provides a tactical opportunity to upgrade. You take a look at the shares right now, only up about 0.8%. And finally, we have a fun one. Truist, no longer sweet on Krispy Kreme, downgrading the donut company to hold from buy. This firm says that it's really struggling to recommend the stock given the unclear impact of GLP-1 weight loss drugs. They see the current overhang of these drugs on packaged food stocks lasting at least 6 months. Price target also chopped down to $13 from $20. Shares right now up about 0.5%, so managing through it. And those are some of our top calls. Now, another company facing the Ozempic threat, McDonald's, shaking it off in the third quarter with sales and profits that beat expectations thanks to higher prices. Let's get into it now with Nick Setyan. He is equity research analyst over at Wedbush. He has an outperform rating on the stock. And Nick, when you parse through the numbers, this really seems like it was about those higher prices. But how much pricing powers does a McDonald's have left?
Well, I mean, I think they're going to have to keep taking pricing, but I do think we're already starting to see the ceiling in terms of pricing. When you talk to franchisees, a lot of them are very hesitant to take any more prices for the rest of this year and probably into the first half of next year, particularly as guest counts have now turned negative. So I do think we're reaching that point where pricing becomes a lot more difficult to take.
We also take a look and you see that U.S. customer traffic dipped for the first time this year, slowest sales growth of the year. But how does McDonald's stack up against some of their peers when you think about the overall macroeconomic environment right now?
I mean, I think the QSR category is still a sweet spot. They continue to benefit from a trade down. McDonald's has been gaining so much share from everyone else that it's been very tough. Whether you think about the pizza guys or the fellow sort of burger competitors, McDonald's has just been the primary share gainer. So it'll be interesting to see as guest counts have now turned negative, whether some of those peers can actually retake some of this share. They're being a lot more promotional than McDonald's has been. So I think in the near term there is an opportunity for some of the McDonald's competitors to actually retake a little bit of the share. So I actually think this is actually good news for some of the peers in the QSR segment, despite sort of guest counts being negative at McDonald's.
Right. Maybe there's a little bit of the halo effect fading here. McDonald's says, of course, it has raised prices, but it's done so in a strategic way in order to not to hurt comparable sales, those same-store sales that everyone pays attention to. Nick, any idea how they keep doing it strategically, if they want to continue to raise prices, but do it, as they say, strategically, surgically?
Well, I think no one has a better view of their customer than McDonald's through their loyalty program. A lot of the value has been concentrated within loyalty, and so they don't have to do national, biggie bag types of deals. And so I think there's a way to increase some of the pricing on the loyalty, be a little bit less promotional on the loyalty app. That's a big way that they can potentially, increase prices, and then focus on the premium segment. That customer continues to be very healthy, so there is still some room to take pricing there.
Wait, who's the premium customer, and what does the premium customer buy?
Well, the premium chicken sandwiches, the premium burgers, for example, they kind of look at premium customers as above 75K household income. That lower income value customer is below 45K income. So I think there's still an opportunity above that 75K household income level.
All right, Nick, really great to catch up with you. Our thanks to Nick Setyan of Wedbush. And I mean, it's an interesting conversation to have. You think about the pricing power that McDonald's has relied on, as well as some of its peers. But as Nick was just walking us through, maybe some of that is coming to the upper limit.
I like what McDonald's CFO said, that they benefit from this affordability perception that allowed them to take market share. People feel like everything costs too much out there, so I want to, go budget a little bit with my, lunch, so I'm going to have McDonald's, even though you can't walk out of McDonald's with an extra value meal that doesn't cost at least $10 these days.
That was the point you made in the commercial break, which I thought was so good. I mean, we were talking about McDonald's versus some of its peers, and I said that's kind of fancy, but you think about the prices at McDonald's, it's not like it's exactly a bargain.
It's not cheaper than Smashburger or Shake Shack. And by the way, McDonald's fries are still top notch. I know we have a dispute here on that.
I know, no. More of a Burger King kind of gal.
Too crispy.
Yeah.
No flavor.
Well,
All right.
in any case.
To be continued. Coming up, we're going to be joined by Adrian Harris, Superintendent of the New York State Department of Financial Services, to discuss the current state of our banking system and whether we might expect, or she expects, additional shocks. This is The Close on Bloomberg.
there's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, or mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg. Top experts. Great questions.
It is time now for our Wall Street Week daily segment, and the host, David Weston, joins us now. David, who do you have?
Scarlett, thank you so much. Well, as you know, here in New York, it's all about the financial industry, and we're welcoming the woman who really oversees all the financial industry in the state of New York. She's Adrienne Harris. She's superintendent of the New York State Department of Financial Services. So welcome back. It's really great to have you, Madam Superintendent. So let's start with the banks. There's a lot of things you have responsibility for. Let's start with the banks. Go back to last March. We had a sort of a hiccup in the system that had to do with some interest rate risk. And we have some banks still to this day who have a lot of losses on their balance sheet with some of those longer term securities. How big a problem is that right now?
Well, I think the banking system now is very stable after the federal regulators took the actions they did with the systemic risk exception in March. But there's still lots of issues looming. As you mentioned, the interest rate risk and the unrealized losses. Certainly commercial real estate exposure is high on the minds of regulators all over the country. So the regional banking crisis, I think, is over. The banks are stabilized, but certainly we're mindful of other risks in the system.
You mentioned real estate, and obviously that's a big topic here in New York City. We have a lot of empty offices. And it's not clear what's going to happen with them. What about the time when those buildings need to get refinanced? Could we have another form of a crisis with the banks?
Yeah, it's an important issue. We look at our banks and their real estate exposure, whether it's office space, multifamily housing. I think regulators across the country and in Washington are looking at loan to value in the event of a refinance. And they're looking at diversification. They're looking at the segment overall to make sure that that risk is being managed proactively before these loans come due, and thinking about the new normal. What is this going to look like post-COVID? Are these office spaces going to be converted to housing, especially in big cities where there are housing shortages? So it's a very interesting policy area right now.
Hindsight's always 20/20, and there's no point in saying woulda, coulda, shoulda. At the same time, we can learn from what happened in the past. And what do you think regulators, including you, but not limited to you, might have learned from what we went through with Silicon Valley Bank and Signature Bank?
Yeah, I think there's so many learnings we've taken, and DFS as well as other regulators published reports about that. I think one is thinking about the modernization of regulation. When we think about the liquidity issues that these banks were facing and how fast the deposits fled, first from Silicon Valley Bank and then how that fire spread from California here to New York and other banks around the country, now understanding the digitization of money and how that impacts deposits. So, of course, the FDIC is looking at the insurance thresholds. But I spend a lot of time thinking about how we operationalize our regulations. If we're examining banks in a certain time frame, can we make that examination go faster without sacrificing rigor, give feedback to the institutions more quickly, and then hold them accountable for remediation so that that feedback loop becomes tighter and we don't have some of the issues that happened with SVB and Signature where things were going unremediated for cycle after cycle after cycle with respect to examination. So there's a lot to be learned with respect to the rules in particular, but also how regulators are doing their job and how bank management's doing their job.
Another area where you really have taken a leadership position is on virtual assets, including crypto and things like that. There were regulations in place before you came in, but then you've really moved it forward. fairly aggressively. At the same time, last time we talked about what about the feds? Where are the feds?
Yeah.
And we thought we were going to get legislation. Didn't happen. How much of that at this point is a little bit of a tug and pull about state versus federal? Because you've wanted parallel regulation, but it sounds like some people in Washington don't want that.
I think that's right. We are very keen to make sure that there is a federal regulator, a federal cop on the beat in the virtual asset space, because we've seen the risks and the dangers that that space presents. But we in New York have been leading in this space for a long time. The regulations were in place when I came into office, but now we've built a team of over 60 professionals devoted to this day in and day out. We've issued 9 pieces of guidance. We oversaw the unwinding of BUSD. So we're really leading here, and it'd be such a shame to lose that expertise and that experience. So just like we do on the banking side, we're eager to see parallel regulation between federal and state regulators, and that's reflected in some of the bills we've seen moving in Washington. I'm hopeful that they'll get done.
Some of the bills, but there are reports at least, and you can correct them if they're wrong, that some people in the White House would like to have preemption, essentially, have the feds take it over. Is that right? And if so, why are they doing that?
I think it's dangerous. I understand the desire to have one set of rules and avoid what some people think will be the race to the bottom. But you see in New York, what we have is the most rigorous set of rules and regulations around the world. There's no bigger crypto team than what we've built at DFS. There are no more rigorous regulations anywhere in the world than what we've had on the books. And I think it's important to preserve that.
Let me ask you the obvious question. If we had all the right regulations, could we have avoided FTX as we're watching that trial go on just a few miles south of here?
Well, we did in New York, where FTX was not licensed to do business, and they made public that they were seeking a license from DFS, and they didn't get one. And in fact, their very business model was antithetical to the standards we have on the books. So if we had that nationwide, I think we would have been much better off.
You've been forward leading on cybersecurity. I understand you've been contemplating a possible regulation. Where does that stand right now? And what would it do if you did adopt it?
Yeah, well, New York has been leading in cybersecurity with the original cybersecurity reg that was promulgated in 2017, became the model for federal regulation and for other states across the country. We're now in the process of amending and updating that regulation, so that will come out soon. But we're focused on things like how we tailor the regulation for the diverse sets of businesses that we regulate, from insurance to banking to crypto. We're thinking about governance and incident response and business continuity, and of course ransomware, because this is a thing that didn't exist the way it does today 6 years ago when the reg was originally promulgated. So this is an update that we have to make. So I'm eager to get this out. You'll see it soon, but we're excited about the standards.
You've got a lot on your platter.
Yeah.
Do you have the resources you need to really address it? I mean, because right now, New York State doesn't have a lot of extra money floating around that I've heard about.
Well, we are assessment funded at DFS, so we cost the taxpayer nothing. We then refund about $500 million a year to the state in the form of restitution, reappropriated assessment money. So just in the 2 years that I've been at DFS, we've gotten $277 million back to New Yorkers in the form of restitution. So it's really a great investment where you don't have taxpayer money to fund the agency, but you get that much return. But any regulator will tell you that they need more bodies. In fact, in my 2 years at DFS, we've hired 350 people. We've promoted about 250 people, but that's just the beginning. We're still so short-staffed, and I'm looking forward to continue to build the agency because, as you said, we've got such a broad remit and so much we're responsible for.
Finally, Madam Senator, you've talked about New York State as being the world's financial capital.
Yeah.
Is it still today, after all that has happened, and what do you need to do to try to ensure it will be tomorrow?
I think it is, absolutely, and I was just hosting a delegation from the UK. I've hosted delegations from the UAE and similarly gone to their jurisdictions. New York still is the financial capital of the world, but we can't rest on our laurels, and the trick is having robust regulation that protects consumers and markets, but also that grows a healthy and thriving competitive marketplace, and I think both can be accomplished at the same time.
Well, that's the question. Is it a zero-sum game? The more regulation you have, the less people want to be here.
No, not at all. In fact, to the contrary, especially in crypto, where we've seen we have the most rigorous regulations on the books, and the demand for our licenses and charters only goes up and to the right because companies get that clarity from the regulator, and so it drives demand to be in the market.
Superintendent, thank you so much for coming back again. It's really great to have you. That's Adrienne Harris. She's Superintendent of the New York Department of Financial Services. Tomorrow, we're going to talk with Pfizer CEO Albert Bourla about what comes next for the company who brought us the COVID vaccine. And then on Friday, we'll talk with former Chief White House economist Cecilia Rouse about the jobs numbers out that day. That's coming up at 6 p.m. Eastern Time on Wall Street Week on Friday.
All right, sounds like it'll be a great lineup of guests there. Thank you so much, David. Now, as we head towards the close, we've got just over an hour to go. You're looking at yields moving up, although they've given back a little bit of that advance. And of course, in about 4 minutes, we're going to get the Treasury refunding statement. There are details, of course, coming up later on in the week, but the number will come out at least.
The number will come out at 3 p.m. And of course, that informs what we're going to see at 8:30 a.m. on Wednesday morning in terms of the details of the Treasury's refunding announcement. So we'll see how some of these lines move right now. But you can see the S&P 500 stocks broadly having a good day. And Scarlett, I'll note that it's on the back of some pretty hefty volume. You take a look at the S&P 500 right now, trading volume rather is about 10% higher than its 20-day average.
Yeah, that usually doesn't happen on up days. It's usually more the case when stocks are falling overall that you see a pickup in volume. But of course, this is a big week overall because in addition to the Treasury refunding announcement, we've got the FOMC. We've also got Apple earnings later this week.
That's true. Don't forget about earnings, of course. We think about the disappointment that we saw last week out of some of those, those big tech reports. They were a little bit of a bummer, so we'll see if that can rescue sentiment in this market.
All right, from New York, this is the close on Bloomberg.
What are some of the measures the government are working on in terms of addressing the artisanal challenges there?
Oh, a host of them. But fundamentally hinged on two policy pillars. One is reformation, which is reforming the sector, licensing regime, getting them equipment for the extraction of the gold from the ore without the use of mercury. As you know, we are parties to the Minamata Convention, and therefore we respect the dictates of the Minamata Convention. And then the enforcement regime, deploying law enforcement to make sure that people are arrested and so on and so on. So we're making that effort. But my point is that my fundamental point is exploiting these mineral resources in a sustainable manner are not mutually exclusive. I think that they can peaceably coexist. You can exploit the resources, and several countries have done so. I don't want to mention, give examples, but I know of countries which have gone about their mining sector and their mining industry in a manner which is also protected the integrity of the environment and the climate. We can do all of that. My friend Josephine mentioned the day we'll use solar to mine and use gas and all of that. These are all very ambitious technological interventions we can rely on. And Ghana is doing just that.
Treasury to come out with its net borrowing estimate for this current quarter. And of course, last time, Katie, they did this 3 months ago, it caused a lot of surprise in the markets.
And this is a market that is basically hanging on every word that we can get out of Treasury, that we can get out of the Fed. So we'll see what the reaction is. Of course, you remember the upset that we saw about 3 months ago when Treasury came out and said that they would actually borrow more than had been expected by markets. So we'll see the details, but this is a very nervous bond market.
Okay, we have just gotten the numbers, and the U.S. is cutting its quarterly borrowing estimate to $776 billion from previously $852 billion. Treasury says California receipts helped actually boost revenue. So it now is releasing its net borrowing estimate for the period. It sees $816 billion net borrowing for the January to March quarter as a result. So, Katie, this sounds like it needs to borrow less money than we previously thought.
And of course, it's still, we're seeing this get digested in the markets right now, but you're seeing a slight tick lower in yield, still much higher on the day if you take a look across the curve. But right now you can see that 10-year yields only up about 3 basis points. We had been up closer to 5-6 basis points. So a small move overall. We'll see how that develops. But yeah, interesting to finally get some of these details.
Yeah, and of course, on Wednesday in the morning, we will get the actual breakdown of how the Treasury is going to issue the debt, whether it's going to be in bills, whether it's going to be in bonds, and how much. And that obviously going to move markets, especially with the concern that there's a lot of supply to absorb. When you look at how the markets are trading overall, we have equities pretty much near their session highs. The Dow Industrial is doing the best here, up by more than 1.75%. The yen, of course, a big focus this week because there was a report that the BOJ will tweak its yield curve control, basically lift its cap on bond yields at tonight's meeting. Maybe the surprise is now gone because of this report.
We'll see, but let's get into some of these individual movers on the day because there's quite a few of them. I picked 3 gainers because why not? Western Digital, one of the big stories, say it's going to split into 2 separate publicly traded companies. Of course, it had been in talks to merge with the Japanese storage maker. Those fell apart. Now it's going to spin off its flash memory from its HDD unit. Shares up 7.5%. Let's also talk about SoFi. It came out, it raised its revenue forecast for 2023. It also said the deposits more than tripled from a year earlier. Third quarter total deposits jumped to $15.7 billion. The average analyst estimate had been for $14.9 billion. So some good news out of SoFi when it comes to the deposit story.
Yeah, but the stock it surged right at the open, and the gains have really faded over the last couple of hours here. So whenever I think of SoFi, I always think of the student loan refinancing, but it's so much more than that now.
It is so much more than that. Really a financial services company. I did want to talk about GM, of course, also coming to an agreement with the UAW. Still needs to be voted on, ratified, etc. But some progress there as well. GM shares only about 0.2% higher.
I guess everyone thought it was going to happen after Ford and Stellantis. It was kind of like it has no other choice at this point, right?
That's true.
All right, we're less than 1 hour away from the closing bell. We've got cross-platform coverage of today's top stories starting right now as we count you down to the close. This is The Close on Bloomberg.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Scarlett Fu and Katie Greifeld here with you, joined now by our colleagues Carol Masser and Tim Stenovic, allowing us to welcome in full everyone across television, radio, YouTube, and originals. And we did get some headlines, Carol, just now about the U.S. cutting its quarterly borrowing estimates to $776 billion. We don't have to borrow as much as we thought we needed to.
God, all right, let's go out and spend some money then, I guess. No, it's interesting, right? It's basically a health check on the U.S. government and their spending. So it is interesting to hear that because, right, there was a little concern about maybe less revenues coming in recently. So that's an interesting number and something that we think about with the backdrop of a week that we are so much focused on the Fed. And I'm curious about Jay Powell, whether on Wednesday he'll make some comments about our fiscal situation with another deadline ticking.
I think he steers far away from that. He's like, that's Treasury. That's
going to be asked about it, though. You can pretty much bank on that.
Yeah, right? Because he's like got to look at this whole picture and wonder about, in terms of raising rates. And we think about what it costs for the government, basically, to service that debt. Having said that, all right, serious stuff aside, no more Treasury stuff.
Hey, this is serious.
Let's talk about the sweet stuff, if you will, because we did have Truist Securities coming out. They got a call on Krispy Kreme, our Doug Krisner in the newsroom said we're going to call it sour cream because Truist basically downgrading it to hold from a buy rating. They cut the price target to $13 from $20. And this is, I feel like, a familiar refrain that we're hearing. They cited the uncertain impact of drugs known as those GLP-1s on packaged food snacks, Tim.
I think the uncertainty here is key. And the analysts come out and said, it's too early, Scarlett, to understand what the impact is actually going to be. But there is some concern that, if people are taking these GLP-1s on a widespread basis, then they will not eat as many donuts, I suppose. But I'm just going to take a step back and say, wait a second. We don't know how many people are going to be taking these. Yeah. We don't know how insurance is going to cover them. We don't know what they're going to do to consumer companies like Krispy Kreme. It seems like the market's kind of like overreacting. I want to say overreacting. I'm not.
But you said it.
I did. I know. I stopped myself though.
It's the uncertainty that no one knows about. I mean, maybe the weight loss drugs.
There's a lot of things that are uncertain.
Absolutely.
In this world.
Maybe the weight loss drugs will mean that if I want the donut, I'm going to have it, and then if I need to, I'll take the weight loss drugs afterwards.
And when it comes to the stock market, just sell now. Ask questions later. I wanted to talk about candy. This is tangentially related, but we talk about some of the risks for these food companies. You aren't necessarily seeing it reflected in the prices of candy right now. This is very much a story that's hitting as we talk about Halloween tomorrow. Consumers facing steep prices for candy this year because candy costs are surging. When you look at the price of cocoa, you look at the price of sugar. Of course, we've had a lot of weather events globally that is impacting crop prices. So looking at some steep costs for tomorrow night.
The big number here that really gets your attention, Americans expected to spend $3.6 billion on candy this year for Halloween, up from $3.1 billion. We are spending $500 million more this year than last year. Yes, because of higher prices, but that's a lot of candy.
Yeah, I actually went yesterday to the local store in my neighborhood to buy Halloween candy, and I was shocked to see how expensive it was. $32 for a bag of like Snickers and Kit Kats, and there's only 150 pieces in there.
Wow.
So
that's a
we're
nice
gonna run out. We're gonna run out. The Stenovic house a little bit.
You're gonna have to ration.
I think we'll probably do is
on their costumes.
Take our toddler's candy, dump it in the bag.
All the Mounds and Almond Joy will be like redistributed again.
Exactly. Scarlett knows what I'm talking about.
It's time to put out a bowl of apples again.
We're not going to be them.
All right. You're not going to be known as that family.
Or raisins. Remember that? That's from our childhood.
Also.
Boxes of raisins.
Not interested. All right, guys. We're going to be back in less than an hour's time. Our cross-platform radio, TV, YouTube, and, of course, Bloomberg Originals. We do have some earnings coming after 4 Pinterest, so we'll be breaking them down as well. Join us at 4 p.m. Wall Street time.
All right, we continue the markets coverage here on the close as we count you down towards the 4 p.m. close. This week's MLive Pulse survey results are out, and the survey asked, how would a 10-year Treasury rate above 5% impact the U.S. economy? And the majority, 53%, responded it would lead to a hard landing. 47% says the economy can manage. Let's get the perspective of our next guest, Ethan DeWitt, Moneda's Chief Investment Officer. Ethan, thank you so much for joining us. What's your take on the 5% yield? We got there last week on the 10-year, but we came back pretty quickly after that. If we get to 5% again on the 10-year and stay there, what economic ramifications does that have?
I'm going to go with the 47% of your survey takers who said the U.S. economy will manage. As we can see, this economy is extremely resilient. We're seeing that through the consumers' ongoing spending. You just spoke about candy there. That's the ultimate discretionary expenditure, perhaps. And we've seen that in the resilience of the housing market with these mortgage rates, and we're seeing it in the company earnings. So yes, 5% is clearly a bit of a milestone, a crossing of that milestone, and many market participants will never have seen that. However, if it's incrementally higher, not everyone is affected. Although I will say we are still seeing the transmission effect working its way through the economy. So we can say that the entire effect of these rate rises have yet been felt.
Yeah. And of course, at the top of the hour, we did get headlines from Treasury in which they cut their quarterly borrowing estimates to $776 billion from $852 billion previously. We'll get the breakdown of how the Treasury will issue that debt on Wednesday. How much nervous anticipation was there ahead of this number, Ethan?
I'd say quite a bit. We can see that movement around in treasuries we've seen with really markets not knowing whether to be risk on or risk off or what bonds constitute. There's been a lot of murkiness around supply demand for bonds. And whereas much of this political wrangling doesn't usually disturb markets, it is raising the question about whether we can trust this government or any government to be prudent on the fiscal side. And that perhaps has been leading to some of the sell-off, although Janet Yellen had refuted a suggestion that the trading off of bonds was anything to do with confidence around the government's sovereignty and ability to pay. So I would say that perhaps was a little bit overstated. What was driving the bonds was really this movement in equity markets, the ongoing volatility that we're seeing, and just markets really looking to settle and understand how to cope with a higher for longer environment.
Well, talk to us a little bit about earnings, because heading into last week, which of course was the biggest week of earnings by market cap, there was a narrative that emerged that, okay, it's big tech is going to take the stage and it's going to really be the balm over this very stressed out market. That didn't seem to happen. When you look at the reports that we've gotten so far, the commentary from the C-suite, how are you feeling about the state of corporate America?
Very good, very good. At least looking backwards, which is all the earnings do, we all knew that this earnings was going to be a robust set of period. It is a lagging indicator. The issue with tech is that the Magnificent Seven have been talked about so much now. It's almost been primed to fall from that precarious perch. And that's exactly what happened. There was a sense that this was too much concentration. The rest of the market had not participated. And although actually the tech numbers were good, investors were prone to find any little hole in that narrative, and that's what they did. We saw that with Google last week, perhaps an overreaction to their numbers. It is still all about AI. We know that it's a new arms race now when it comes to tech. I'd be very interested to see how the Apple numbers are received. I suggest again there will be a proneness among investors to look for the holes, look for the cracks, look for any weakness, simply because the Magnificent Seven have been priced for perfection. I'm waiting to see the rest of the sectors start to participate in some way and reflect the overall resilience that is perhaps surprising across these other sectors.
Well, to that point, when you talk about that Magnificent Seven falling from their perch, where does that open up opportunities in the rest of the market?
Well, areas like infrastructure, utilities, healthcare, so-called value sectors, quite defensive, they have been essentially quite overlooked. And when their fundamentals are not changing, everything that was driving them around infrastructure and real assets being good inflation hedges. Remember, we're still dealing with inflation. It may still not be in headlines and it may have come down from its peak, but we are still dealing with it. The Fed is still mindful of it, and we need to have portfolios that are resilient and are participating in inflation. Equities do that to a degree, but infrastructure, real assets, real estate, they really participate in that. So I'd say that's been completely overlooked. Many babies have been thrown out with the bathwater in the last few weeks. We've seen that in some of the sustainable and renewable energy stocks, complete essentially washing out of those stocks simply because some of the expectations, the business models, the demand have not been up to scratch. That's probably a bit of an overreaction there. So I'd say there's lots of value in the so-called value sector and the defensive sectors that have not been participating in the Magnificent Seven.
Having said that, what are areas that you want to avoid completely?
I will say that I will say real estate right now, listed real estate, it is just too difficult to pick the sectors that are likely to prevail. I'll say that that's not one of our priorities at the moment. Other sectors, we're actually not that, we've always been avoiding areas like digital assets. There was a discussion earlier around some of the new financial mechanisms and exchanges. We've always been quite wary about those. We think they're unproven. And in a sense, we have not really got over the regional banking crisis within financials. So I'd say financials, whereas many of them are very strong, we've seen good earnings and good trading volume in financial stocks. I would say that most investors are just not interested right now in getting involved in financials with this uncertainty around the interest rate environment, as well as that overhang. The FTX trial is currently going on. We know about governance and about oversight and complexity that sank some of those stocks. I'd say that's an area I would want to avoid.
All right, Ethan, it's really great to catch up with you. Appreciate your time. Our thanks to Ethan DeWitt, Moneta Chief Investment Officer. And coming up, speaking of a second day on the stand for FTX founder Sam Bankman-Fried, we'll have the latest on his testimony.
And SoFi raises its revenue forecast after its deposits more than triple. You'll hear more from our interview with the CEO, Anthony Noto.
And we'll look at the growing demand from air travelers for so-called premium economy seats, and also how the airlines are responding. All that and more coming up. This is The Close on Bloomberg.
history as one of, if not the largest financial crime ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. Earnings season is here.
Tons going on, lots of earnings.
Beat wherever you look.
Bloomberg breaks the numbers first.
It's a tale of two earnings. Results from Goldman Sachs, Bank of America, and Morgan Stanley.
Netflix is out, guys.
With exclusive expert analysis.
Recovery is underway.
They crushed it. It was one of their best quarters ever.
This is a story all about pricing power.
We're going to make more money. We're going to make more money. And we're going to make more money.
We're making bank. And I think that is what we can take away.
Bloomberg Television and Radio. Context changes everything.
All right, 45 minutes or so to go until the closing bell rings. You take a look at what's working in this market right now. Honestly, it's a lot of tech names after the hosing that they got last week. Now you have the likes of Microsoft, Amazon, Apple powering this market higher. Take a look at what's not having too good of a day, and it's the likes of some of these chip names behind me. Tesla, too, you can't even see it. It is down by about 4.8%. You think about the heft of Tesla, that is the biggest points contributor to the downside. But with a lot of those other big tech peers rallying today, this market is managing to shake it off. And you can see that if you take a look at this dashboard here, the S&P 500 taking a look at its session highs right now, up about 1.3%. That's as the bond sell-off eases just a little bit, though. But you look at 10-year yields, still higher by about 3 basis points. But after the few months that we've had, maybe you can call that unchanged. The dollar not seeing much of a haven bid, down about 0.4%. And again, equities higher, and then the bond market also suffering a little bit, but just a little bit. But it's time now for Options Insight. We want to get you up to speed with the day's options trading. Abigail Doolittle standing by, taking a look at the relationship between the BOJ and volatility here in the U.S. Take it away, Abigail.
Absolutely, Katie. Well, it is a big week for central banks, and of course the BOJ is Tuesday, or tonight for us here on the East Coast. And there was a story floated by the Nikkei earlier speculating that the BOJ may let the 10-year JGB go above 1%. Now, Samantha Leduc, founder of Leduc Trading, thanks so much for joining us. You've been all over this all year. I remember in late February, early March, the topic you wanted to talk about the next time we were talking was the BOJ, because you said you were watching the BOJ this year much more than the Fed. I think you're one of the few people doing that, but you're really out in front of the curve. What do you expect, and what would the influence on asset classes here in the U.S. be?
Well, the correlation between the dollar yen and the dollar yen, in other words, the U.S. 10-year with the dollar yen is just indisputable. So it's very, very strong correlation. And today with the Bank of Japan announcing that it may consider letting the 10-year exceed 1% is their effort towards a hawkish stance, which is normalization. And that's actually very different from the rest of global central banks, which are at the place of pause for the Fed. And in some cases, some regimes are kind of doing a pause and cut. So all eyes have already been on the Central Bank of Japan for a possibility of this yield curve control shift to normalization because of rising inflation. It's a really sticky point of contention. And obviously in the U.S., we've kind of done this dance where now it's perceived as very much entrenched, and the 10-year has been spiking higher after the last quarterly refinancing announcement from the Treasury back on July 31st. So, of course, all eyes are on the QRA this week. FOMC, there isn't much expected. In fact, the options market is pricing in very little move because very little is expected from that announcement. So all eyes are and should be on the Bank of Japan and what they do next.
So we were just taking a look at the VIX versus the yen, which I know that there's not much of a correlation there, but it does look like the VIX, at least over the last 2 years or so, and it depends on the time period, to be fair, that a rising dollar against the yen has suppressed volatility. So it'll be interesting to see, and I'm curious to know whether or not you think that could go higher if there's a technical case there for sure for the yen to strengthen, as in the dollar yen to go down. Maybe volatility spikes on that. What are your thoughts there, Samantha? And earlier today, this had stocks off of the highs, and now we have this borrowing report from the Treasury just talking about stocks back at the highs. What influence do you expect to be stronger on stocks?
Well, for me, the worry is, I should say the market worries that the Bank of Japan will reverse negative rates and pivots. So this could be an exit from the dollar safety and yield spread that they have been playing in this carry trade to the yen. So you can kind of see it last night into this morning. The Japanese yen, in fact, has gotten a bounce. It's been a nice chase trade. But the swing trade or even the trend is much more important, meaning the implication for U.S. Treasuries. It kind of bears reminding that the Bank of Japan has been the last bank to shift. This is a hawkish tone. Maybe, it creates this kind of price instability from a longer term standpoint. But in the short duration, what they typically do is we do some kind of dollar swap arrangement to kind of stem the volatility that the Bank of Japan moves can make. So this is very much the USD JPY 150, right? So this is like that point of intervention that they've promised to come in to keep the bond vigilantes at bay.
Right.
So if that is in fact the case, that we really could see the dollar, the U.S. dollar, fall at this kind of very key support of 105.77 Dixie. And if that's the case, it will give a little bit of relief to equities. Otherwise, it's very, very negative to equities and can trigger not only higher bond yields in the U.S., but also volatility.
Yeah, especially if that yen carry trade does to some degree unwind. But they're going to have to walk the talk that they're talking, because back in the summer they walked it back, but it sounds like you think they might be pretty strong. Samantha LeDuc, founder of LeDuc Trading, thanks so much for joining us for Options Insight today. And from New York, this is Bloomberg.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
City.
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
of premium economy. Now, according to the reporting from the Wall Street Journal, U.S. airlines are expanding offerings labeled Premium Plus, Premium Select, or Premium Economy, which typically come with roomier seats, early boarding, free alcohol, and nicer meals. And airlines say they appeal to travelers with more disposable income, especially on long-haul flights where business class seats can run thousands of dollars more. Scarlett, I know you have a lot of feelings.
Yeah, well, if I can't afford business class when I'm flying, maybe I want to spring for things I used to be able to get for free 20 years ago, right? Like a pillow, food with real silverware, maybe not earplugs, headphones, a blanket, more seat room.
No.
But, you know, since they've shrunk economy into just sitting there like a sardine, now they have premium economy where you can pay up for it.
Yeah, you still have to pay up. These are still expensive flights that we're talking about. Yep. I also think it's interesting reading the article, thinking that maybe this will appeal to corporate flyers from companies who maybe don't want to pay for business, because apparently that's also...
But we're not going to stick you in economy, so we'll pay up a little bit so you have premium economy. Yay!
You can extend your legs a little bit more. Interesting to watch.
Painful.
And in any case, stocks up. We're going to get into it next. This is The Close on Bloomberg.
Let's suppose you're on a plane and somebody realizes who you are. They say, I have $100,000. I don't know what to do with it. Where should I invest it? Where should they put their money?
So today, it's a easier decision than it was maybe 2 years ago, because Treasury bills are 5%. So I would say, you know, regardless of how much risk you want to take, you have to put a portion there. Then you would have to ask, really, an individual is the same, I think, as any institution. What is your time frame? Do you need to get access to this $100,000 in the next few weeks, the next few months, the next few years, not until you retire? And that will determine your investment decision.
So what do you think is the most common mistake investors make when they have 100,000, a million, or whatever they might have? What is the most common mistake you have observed that investors make?
I would say hubris and thinking you know more than you do, because every decision that you make has many, many layers. So as you're creating a portfolio, look at the risk as well, not just excited about the return.
And what's the best investment advice anybody's ever given to you?
Continue to learn about innovation in whatever you do, because that is where it's not exciting, that's where returns will go.
And the markets are on the move.
The focus, of course, is on Ukraine.
The market is so hyped up about AI.
Unless we see dramatic changes, it's just going to keep getting hotter.
We've had the market analysis. We're going to go get straight to some breaking news.
I'll have a full roundup.
Going through some of the numbers. And what investors should make of them.
We have so many important conversations. Let's check in what you need to know.
trading day on this Monday, and Katie, we're continuing the streak of up Mondays for the S&P.
It seems like, I know you have some amazing size and scope. We're going to get to it, but you are looking at an S&P 500 that's looking at its session highs. You take a look at the circle behind me, it's all green, every single sector, all 11 in the green right now. You take a look at what is leading the rally. Communication services up top, 2.4% higher. Financials too having a great day, up about 1.9%. Consumer staples seeing some love. You go down the list to the relative underperformers. They're still green too. Energy up by about 0.2%. So too is real estate up by about 0.2%. Scarlett.
All right, let's take a look at some of the individual movers, and there's more green than red, clearly, given the overall broader market moves. Western Digital up by almost 8%. The storage maker will be splitting into two publicly traded separate companies after its talks to merge with the Japanese storage company collapsed. Western Digital will spin off its flash business, leaving it with just a hard disk drive business focused on selling memory to cloud data centers. SoFi Technologies had gained as much as 15%, but it's paired some of those advances, now up by only 1%. This is the financial services company that started its life as a student loan refinancing business. It had jumped after reporting its revenue forecast for this coming quarter will be better than what analysts had anticipated, thanks to a tripling in deposits. Now, the lone decliner here is on semiconductor, losing 20%, the worst performance in the S&P 500. The third quarter was fine, not a problem, but the fourth quarter revenue and profit outlook was weaker than expected, and that is dragging the semiconductor complex lower. At least it was when I checked earlier. And Krispy Kreme donut was off, was in the red earlier, but it's bounced back and is now up by 0.5%. True Securities downgrading to hold from buy, also reducing its price target to $13, saying that the uncertainty over Ozempic and those other weight loss drugs means we're not really clear on whether Ozempic will hurt demand for things like really yummy donuts. Katie?
Well, let's go from donuts to cryptocurrencies, because FTX co-founder Sam Bankman-Fried, he's back on the stand at his fraud trial today, where he faced cross-examination from prosecutors. Joining us now for the very latest is Bloomberg's Shonali Bassick. And when you think about what we heard today, what was the tone? What was the line of questioning that we saw from the prosecution?
Well, there are a few things here. There's the prosecution, and also remember his own attorney had come up too in his defense. We know that the prosecution has really been line by line bringing up a lot of evidence, including what Sam Bankman-Fried himself has said to different news outlets pre and post bankruptcy, online and in tweets. And there's so much ambiguity. It's actually very, very hard to follow this case, because Sam himself will be disputing some of the things that were said in the press about him that he was even quoted on in relation to how he operated Alameda and FTX, or rather didn't operate Alameda anymore, but his relationship to Alameda.
He has said so many different things. You've got to pull it from the different times he's spoken. How did he explain his relationship to Carolyn Ellison and, of course, his former girlfriend, who is the CEO of Alameda, and how much did he refute her testimony in particular?
This is really important because she was such a big part of not only the prosecution's own case, but Sam Bankman-Fried's own defense. And importantly, in the defense's kind of pushback here to show that Sam Bankman-Fried didn't know everything that was going on, he spent a lot of time really disputing certain parts of her testimony as well as others. This idea that he was not a programmer and he didn't have a background in computer programming, so he wasn't reading or writing any of FTX's code, for example, or this idea that he didn't know exactly how much was owed between Alameda and FTX at the end of the day. And importantly, this was a big part of this idea that he asked them in the summer of 2022 and earlier to put on hedges, very particularly Caroline Ellison to put on hedges to hedge any crypto decline. And you even hear parts of Caroline Ellison's own testimony there, that there are moments of pushback. But the reason this is so critical is at the end of the day, we're seeing something we haven't seen to this scale in history before, which is him trying to convince a jury that he didn't know certain things about how Alameda operated. Now, will this be convincing enough? Certainly, if you weren't following for the last couple of years, it is hard to follow.
Yeah, the defense's incompetence.
Yeah.
I'm not really good at this.
That it wasn't fraud. I just made a lot of mistakes. We'll see if that resonates, of course, with the jury, to your point. What do we have to look forward to through the rest of the week and through the rest of the trial, really?
So the prosecution has said that this would take a while, so into tomorrow we expect the testimony to continue here of Sam Bankman-Fried, the prosecution really drilling into him, but then the prosecution also has a minute to rebut. They have a rebuttal case that they could put forward as well. By Thursday, maybe Friday, Judge Kaplan had said that they may not finish by Thursday, could go into Friday, and then potentially a verdict by next week. So that's kind of the timeline we're looking forward to for the rest of the week.
Potentially a verdict by next week. Okay, what has surprised you the most? Because you've been following this closely. You've been talking to the different players from the very beginning. What kind of caught you by surprise?
Is it weird to say none of it? I mean, the reason it's not surprising to hear him be so ambiguous is this is what he has always done, isn't it? I did know this, I didn't know that. And so even right now, as we speak, very recently, he's very physically being presented quotes in CNBC and in Bloomberg. Did you say this? Did you spend 11 hours with Zeke Fox? And he says things like, oh, I'm not sure if I did this, or I'm not sure if that happened. And so it's very hard to hinge on him not knowing whether he said or did certain things. But, you know, frankly, a lot of the testimony, if I had to describe the tone, it was a pretty frenetic time for all of them. Now, again, the prosecution had put forward their own witnesses, and I think at the end of the day, it's one man versus the other.
The others.
The others, exactly, which is the weirdness of this entire case.
A frenetic time with some pretty shoddy record keeping, as I understand it, of course, just complicating this case even more. Shonali Bassick, thank you so much for that breakdown. Now, coming up on the close, shares of SoFi on the move after seeing deposits triple from a year earlier. It's our Stack of the Hour coming up next. This is the close on Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
excited about the results that we delivered today. I think they're extraordinary in a number of different ways and equally as positive on the outlook. There's very few companies that are driving durable growth the way we are, plus 25% revenue growth, really strong member growth at 47% accelerated. We had a record number of new members added as well as products, which is a testament to the value proposition that we're delivering. Our profitability continues to improve. We now have all three of our business segments that are profitable, that being the lending products as well as tech platform and now financial services. 67% growth in our absolute dollars on a year-over-year basis from non-lending, and that will continue to be the driver of the growth of the company. And we meaningfully grew tangible book value over the trailing 12 months of about $170 million. So I feel like we're executing across the board on both growth and profitability and shareholder value, and it's just a matter of time before that's reflected in the stock. We just have to keep delivering the way we have been.
That was SoFi CEO Anthony Noto, a bit in autopilot mode as he broke down the company's latest results. And we saw SoFi shares rally as much as 15%, but they have since pared their gains on the back of that positive earnings release. So let's bring in Sally Bakewell, who leads Bloomberg Finance coverage for the Americas. Exactly how does SoFi come off this quarter doing so well? It was a student loan refinancing company originally that then became a bank, but do its results match up with what we've seen from other banks?
That's right. It's been on a pretty impressive trajectory. So it started up as this kind of fintech upstart, and then in mid-2021, it merged with a SPAC and went public. And then about 8 months later, it actually bought a very tiny California bank called Golden Pacific Corp, which only had about 3 branches, but that enabled it to go from sort of fintech maverick to fully fledged bank that could take in deposits and issue loans. So now it's sort of diversified away from just being a student loan business and a personal loan business into a lot of other areas, including IPOs and SPACs. In fact, in the past quarter, it helped underwrite a number of IPOs, including the Instacart one, and that has enabled it to sort of expand its revenue sources so that it actually got 67% of its adjusted net revenue from non-lending businesses. And I think this is why it was able to have more positive earnings than perhaps some of its fintech peers.
Yeah, definitely a wide umbrella that SoFi has cast. But talk to us a little bit more about the deposit growth, because that definitely caught my attention. The fact that deposits tripled in the third quarter. Where are those new deposits coming from?
So Anthony Noto, the CEO, he said that they're very high quality direct deposits. Now, if you look at what SoFi is offering, it is offering 4.6% APY on one of its accounts with no fees. And when you compare that to what's available elsewhere, it's pretty compelling. You can understand why it has this lure. And also, if it pulls in more deposits, well, that deposits are the lowest form of funding for banks, and so that helps it expand who it lends to, and ultimately, therefore, that is a source of growth, and the company was able to raise its revenue guidance for 2023 as a result. And we also heard about this potential deal that it's working on with BlackRock, which is a personal loan securitization of about $375 million that would be placed exclusively with BlackRock funds. Now, that, again, is another kind of sign of confidence. If it's able to work in the sort of in that tier with that kind of firm, that this is on a solid footing.
It's great that you can give us the full picture of what SoFi does, all the different fingers, all the different pies it has its fingers in, because typically when there's some news, some headline on student loans, SoFi stock moves in reaction, even though that's just a part of its business now. How sensitive is it still to all those student loan headlines?
So Noto, again, he today said it was less of a sort of consequential part of its business. And, you know, the company has been very sort of active and vocal in the student loan space. Yeah. It actually sued the US government earlier this year over the moratorium, which was eventually dropped as part of the debt ceiling talks. So it dropped its complaint. And I think as part of this big diversification, it has been sort of expanding beyond that business in order not to rely on a business that is so subject to political whims.
All right, Sally, great breakdown. Really appreciate your time breaking down SoFi's earnings. Our thanks to Sally Bakewell. She is the head of Bloomberg's America's finance team. You take a look at markets right now as we head towards the closing bell. About 15 minutes to go. The S&P 500 up by about 1.3%. Big tech too as well, even as we start to see, of course, that bond sell-off resume. We got a little bit of a wobble, a little bit of a bid come back into the market after we got an update on Treasury's borrowing needs, but you can still see 10-year yields higher by about 5 basis points at this time.
You know, I look at the industry groups for the S&P 500 just to get a sense of what's up, what's down. 23 out of 24 groups are in the green. The only group that's down, do you know which one?
Tell me.
It's autos because of Tesla.
Because of Tesla. Yeah, that would do it. Interesting to see Tesla down pretty mightily on a day where the overall index is up. It's not too often that you see that. Still ahead, of course, as we go down to those closing bells. We're counting you down to the close with Amanda Agati. She is Chief Investment Officer at PNC Asset Management. That conversation coming up next. This is Bloomberg.
Season is here.
Tons going on, lots of earnings.
Beat wherever you look.
Bloomberg breaks the numbers first.
It's a tale of two earnings. Results from Goldman Sachs, Bank of America, and Morgan Stanley.
Netflix is out, guys.
With exclusive expert analysis.
Recovery is underway.
They crushed it. It was one of their best quarters ever.
This is a story all about pricing power.
We're going to make more money. We're going to make more money. And we're going to make more money.
We're making bank. And I think that is what we can take away.
Bloomberg Television and Radio. Context changes everything.
We've been so used to the fact that every time there's a problem, central banks come and ease. This has been the kind of playbook, throughout my career, before that, after I left. Now we're in a very different environment. Central banks actually have to create a recession, in essence, to get back to price stability. So it's a complete reversal of the modus operandi, in a sense, of central banks as they've known it for the last several decades. So that's why it's not so much that they're getting something wrong. They've now acknowledged that there is this trade-off, these costs to pay, but it's a completely different way of thinking about central banks, and it's a different role. Another way to put it is they have to be unpopular now in order to get inflation back down, where it used to be you could count on them each time to rescue you, to stabilize the system, to bring support. And that has shifted, and I think many people, even in the markets, have not quite understood in my mind how much we are now in a different regime compared to the last 4 decades, effectively.
So it's what, almost an easing bias in the markets? How would you describe it?
In the U.S., yes. And I think it's this idea, this almost pre-programmed idea, when there is a problem, i.e. potential recession, central banks will come and ease.
The top names at the Fed are on Bloomberg.
The economy is handling much higher rates, at least for now, without difficulty. So notionally, that might tell you that the neutral rate has risen, or it may just tell you that we haven't had rates high enough for long enough.
The bond market has tightened quite considerably. If financial conditions are sufficiently tight, our work is not necessary because we don't need to boost them more.
Nobody covers the Fed like Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg.
Kate Greifeld.
And we're at the start of a pretty momentous week when it comes to news events that'll trigger moves in the market, right? You've got earnings from Apple, you've got the FOMC decision on Wednesday, you've got the jobs report on Friday. No shortage of catalysts here.
No shortage of catalysts. It's going to be a lot of fun. And honestly, in terms of what is the biggest market moving event, I don't know, and I'm sure there's a few surprises out there that we aren't even thinking about.
Yeah, notably, the Treasury refunding announcement that did come in at 3 p.m. that indicated the U.S. won't have to borrow as much as perhaps it thought it did, providing a little bit of relief, although you still see yields moving higher.
Yeah, and you can see that the S&P 500 it's floating near its session highs of the day. Again, as we count down to a big, big week. And to help us do that, let's welcome in Amanda Agati. She is Chief Investment Officer at PNC Asset Management. And Amanda, I'll bring you the question that we've been trying to answer all day. When you look at the full spectrum of this week, you have central banks, you have earnings, you have economic data, the list goes on. What are you most focused on?
Well, thank you so much for having me. It's always nice to be with you. I feel like a broken record because the thing that we've been focused on all year and will continue to be focused on for this week is what is the Fed going to do or perhaps not do is more what I should be saying for this week. That matters most in terms of the path forward. Try as we might to get the Fed out of the driver's seat all year, the Fed is still very much in the driver's seat. And so we think that is the single most critical catalyst for the market's path forward.
And so with that in mind, what would be the surprise that we could get on Wednesday that would drive the market?
Well, we're not expecting a surprise. So our view on what happens this week is that we get a very hawkish tone, but a pause in terms of any kind of policy action. And so to the extent that it's anything other than that, I think it will certainly rattle markets and perhaps catalyze a little bit more of a downdraft than what we've already experienced here. I think the markets and the Fed are just still very much not on the same page. Market is so quick to expect a policy pivot here to rate cuts. And just given how the data is coming in, how strong the consumer, how resilient they continue to be, there's plenty of ammo for the Fed to take another step if they feel like it's warranted. And so that's the thing that's perhaps keeping me up at night the most, that the Fed may still need to take some policy action, even if they don't ultimately do it this week.
Yeah, a hawkish pause is basically what you're describing, and maybe to some extent what markets don't want to hear, but are also reluctantly pricing in as well. When you look at the yield curve, and of course we've seen the longer end of the yield curve move more quickly than the shorter end, we've had this flattening yield curve this inverted yield curve for so long. Now that it's moving the other direction, that's raising a lot of eyebrows and causing some concern that that's an indication that things are going to get really tough here.
It usually tends to be a pretty strong signal of, oh boy, look out below. Something major is about to change in terms of the backdrop, but it really depends on what is driving the yield curve kind of normalization or steepening. And so when we're looking at long-term rates rising here, there's a whole series of potential reasons for it. It could certainly be a reflection of how strong economic growth has been coming in. It could certainly be a reflection of the consumer, but I think it could also be this recognition that the Fed's going to have to do more. And so it's not a perfect predictor for what comes next in terms of the economic cycle, but it's something that we certainly have taken note of, and it's certainly going to continue to put a lot of pressure on high valuation stocks here.
And of course, over the last couple of days, we haven't had much Fed talk to dissect because they've been in their quiet period, and that'll be the case until Wednesday. So we're really sifting through all the corporate earnings. What have you observed when it comes to margins for companies? Because for so long, they were able to pass on higher costs to their customer, to the end consumer, but it looks like perhaps they've hit a wall with that.
That's absolutely what we're starting to see. Outside of the Magnificent Seven, who continue to kind of lead the charge here from a results perspective, starting to see quite a bit of pressure in terms of the ability to price through cost increases. But of course, the inflationary backdrop is still pretty elevated. It's moderating a bit, but we're not moving in the opposite direction. We're not seeing deceleration materially here in terms of inflation. And so the ability to pass through those price increases just gets harder and harder. And I think that's really why you're starting to see the Magnificent Seven, a lot of pressure in terms of earnings growth rates, both in results for Q3, but also expectations for Q4. A lot of negative revisions starting to come into the equation here. That's starting to accelerate. And so as that continues to weigh on the backdrop, we think that's going to continue to put pressure on the market, even at these valuation levels.
And is that a market-wide sentiment? If you take a look, for example, at the different sectors, are there any sectors or industries that are bucking that trend and actually benefiting from this environment?
It doesn't really seem like it. When you look under the hood, X the Magnificent Seven, it's really sort of exactly what we would expect to see in the later innings of the cycle, sort of muddling along. I can't point to one particular industry or sector as a standout, and so I think that speaks volumes about where we are. If you look under the hood, market performance and even the underlying fundamental results are suggesting that we are in the late innings of the cycle. And so I've said all year, this market continues to be pretty delusional. We finally started to see a bit of a reality check here with the 10% drawdown or correction that we've had. But I think the bias is still down a bit further from here, if not choppy and range bound, just because I don't think there's a lot of room for companies to materially move the needle in this environment, and certainly at these valuation levels, and certainly where margins are sitting today. There's just not a lot of upside from here right now.
And Amanda, we only have about less than a minute left with you, but what is the late cycle playbook? What should your portfolio look like?
Well, we're still very much running a defensive playbook. We've kind of been in this mode all year, but defense to us is not running to the sidelines and raising a ton of cash. It's trying to de-risk, trying to be very thoughtful around strategic positioning, long-term targets, staying very well diversified, and leaning very much into quality exposures, both on the equity side and fixed income side. So in fixed income in particular, with rates where they're moving, very, very attractive opportunities in high-grade, investment-grade fixed income. Investors aren't getting paid at these spread levels to take on the risk in below investment-grade credit. So we'd be leaning quality on both sides of the equation.
All right, good stuff. Amanda, thank you so much for joining us. Amanda Agati is with PNC Asset Management, and we are looking at a stock market that is in rally mode here with the S&P down, NASDAQ, each up by more than 1%. In fact, 10 out of the 11 industry groups are higher right now, the exception being the group that includes Tesla, which, you know, odd to see Tesla continue to struggle here.
Yeah, Tesla having a tough day. Market overall doing well, of course, as we've been saying all afternoon. This is a busy week. There's a lot of fundamental catalysts here, so it's going to be really interesting to see how we trade.
All right, we're moving closer to the closing bell. We've got full market coverage right here on Bloomberg. As we take you to the bell and beyond, this is the close on Bloomberg.
Beyond the bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
We're about 2 minutes away from the end of the trading day on this Monday. Scarlett Fu and Katie Greifeld here, counting you down to the closing bell, and here to help us take you beyond the bell with a global simulcast, Carol Masser and Tim Stenovic. Welcome to all of our Bloomberg audiences across television, radio, and YouTube. Carol, there have been 17 weeks in which the S&P 500 has, or I should say in the past 17 weeks, there are 16 weeks in which the S&P 500 has closed higher on a Monday, and today's looking like it's going to be one of those.
Interesting, right?
Yeah, what does it mean?
Wait,
I don't know what
can
to
we do
with
this on a Monday? Can we do this on a Monday?
Wasn't last week the first one in 16, Scarlett?
Last week was the 1 week in which it didn't close up. I'm not sure what to make of this either, except that lately, since the Israel-Hamas war began, there was definitely reluctance to be long on a Friday, so maybe there's a little bit of a make-back on a Monday, but that doesn't account for 17 weeks,
There's a lot of stuff. Fed meeting, Apple earnings, jobs report, right?
That's true. It's a big week.
Treasury refunding, that's happening too.
Nice job sliding that in.
Katie, we just spoke to Max Wasserman over at Miramar Capital, who talked today about this being a relief rally. He said, people were concerned going into the week, and as you mentioned, Scarlett, that things could escalate even more than they did between Israel and Hamas. But I question why we're seeing the bond market moves that we're seeing today, and we're also seeing the equity market moves.
Yeah, of course, you see that sell-off continuing in the bond market, even as we get the Treasury's borrowing estimates, less than expected, still, amazing amounts of money, but still that wasn't worth too much when you look at what happened in yields afterwards.
Yeah, just a bit of a leg lower in both the 2-year and the 10-year, but not enough to change the overall direction. There's the closing balance, and it does look like we're going to finish higher on the day. It doesn't look that way for the month, but that's a separate story. We have the S&P 500 up by 1.6%, or I should say 1.2%. I'm looking at the Dow Jones up by 1.6%, and the NASDAQ gaining 1.2% as well. And the laggard here is the Russell 2000 up by 2/3 of 1%, but notably higher as well.
All right, we're going to get a breakdown into the groups in just a moment. Some individual movers. We're watching some earnings, but if I look at the S&P 500, guys, 399 names, Scarlett, to the upside, 102 to the downside, 2 unchanged. So investors willing to do some buying today.
Willing to do some buying. That shows up in the industry groups as well. 24 industry groups. The only sector in the red right now is the autos and components one. That includes Tesla, off by 4.1%. See that red bar at the very bottom? That's the autos group. Everything else in the green, including, let's see, 4 groups that have gained at least 2%. Retail, telecoms, and transportation leading the way here.
All right, guys, let's get to some of the individual gainers in today's session. And McDonald's is definitely on that list. Up 2.5% at its highs, finishing the day with about a 1.7% gain. Has to do after it came out with its quarterly update. Third quarter sales and profits, it was a beat thanks to higher prices and movie-inspired ads. U.S. customer traffic, though, it did dip for the first time this year. So just something to keep in mind that not every report. What?
Okay, I'm sorry to cut you off. Romaine's not here, so I'm going to interrupt you instead.
What? No way.
Why are people freaking out about Ozempic and stuff when it comes to the donut places, but not McDonald's?
Donut places.
Like Chris, I don't know. I'm just asking a question. I don't know.
That's a fair question.
Because we still eat burgers. Burgers are protein.
They have salad.
Donuts
they
are
have
not
water. Like
they have some good
pricing power, which is also
they have water.
important.
They also have shakes. They're delicious.
And French fries.
And French fries are vegetables.
All right, comp sales also a beat. I'm
Sorry.
moving on. I'm ignoring the substitute Romaine today. Comp sales a beat, up 8.8% in the period versus 7.8% average of the estimate we polled here at Bloomberg. Delivery digital channels also contributed to sales growth. It was its slowest sales growth, though, of the year. So just a little bit of a caveat. Western Digital, number one gainer in the S&P 500, up 7.2%. It was up more than 13% at its highs today. The company said it would separate its HDD and flash businesses into 2 public companies. It also reported its first quarter results and gave a forecast. So investors liking some of that news, although not as enthusiastic as it was earlier in the session, as we said, up more than 13% at its highs. And then Amazon, this was an outperformer in today's session as well. We'll bring up the numbers for you. It was up about 3.9% in today's trade. Top in the NASDAQ 100, Fidelity Magellan adding Amazon to its investments, a new buy. They added about 9.14 million shares valued at $1.16 billion. So that was definitely a standout. Also, the analysts have been raising their price targets on the company since it reported. So there's some momentum in that one, you guys.
All right. Well, I was actually, even though we were up on the day, had a pretty easy time finding in the S&P 500 stocks that did move lower. Scarlett, you talked about Tesla a little earlier. The worst performer on a points basis in the S&P 500, down 4.81% today. It closed at its lowest level since May, we should note. Panasonic Holdings earlier in the day reported that its automotive batteries operations fell to their first loss in the quarter in 3 quarters on lackluster demand for Tesla Model S and Model X. So that could have been one of the reasons it moved lower. We also saw BYD, it's China's top-selling car brand, did report record quarterly profits. So perhaps because a competitor did report some good numbers, especially in the wake of that recent earnings call where we heard a dour Elon Musk on the call. On semiconductor, the worst performer on a percentage basis in the S&P 500, closing down more than 20%, 21.77%. Biggest intraday drop going all the way back to March of 2020. The company gave fourth quarter forecast that was weaker than expected in terms of adjusted earnings and in terms of revenue. Similar reason we saw move lower for Revity, closing down today, more than, 16%? Wow. The deepest intraday plunge since December of 2008, at its lowest down to 2002 levels at one point in the day. This after the company cut its revenue forecast for the full year, Scarlett.
Actually, it's my turn,
Katie.
Tim. Let's get to the bond market because this is really interesting here. We did get the Treasury come out with its net borrowing estimates. Net borrowing estimates for October through December for that quarter came in at $776 billion. That had been predicted at $852 billion. Even still, even with a little bit of relief there, maybe Treasury is going to announce that they're going to have to sell less debt on Wednesday. You didn't see too much of a reaction in the bond market. That sell-off continuing. You can see 2-year yields up 3 to 4 basis points. 10-year yields, similar story. Less so across the curve. But all told, pretty small moves, but just continuing that trend, Scarlett, of this sell-off, those marches towards higher yields.
Yeah, today's the stealth sell-off, but it's still happening, right?
Exactly.
As long as you see those yields moving up. You know, when it comes to U.S. earnings, we've seen the bulk of the numbers. I'm really excited about Apple because I can't wait to hear what the company has to say about China in particular with Chinese consumers. I wouldn't say souring on Apple devices, but the government certainly is souring on Apple devices. And
we are getting some evidence,
Huawei
Scarlett, that the Chinese consumers are souring on at least the latest high-end version of its iPhone. We're going to be talking about that with Mark Gurman a little bit later because it sounds like there's some real competition from Huawei.
No, it's interesting, right? Yeah, the increased competition in the domestic market. It's one of those markets that Apple has certainly, identified, like so many other companies, as a tremendous growth opportunity. So you do wonder if you have individuals there saying, nope, they're going to be buying. Although Mark has said to us that it's still considered kind of a coveted device, right? An Apple device
it's
in China.
Super high end, but it's also not as sticky in China because a lot of the apps that they use there are over the top apps, right? These super apps that you can use equally well on an Android or an Apple.
Well, before we get to Apple, we do have some results from Pinterest coming out with their third quarter numbers. Third quarter revenue came in at $763 million. The estimate had been for $744 million. Third quarter EPS, though, 1 cent, had been expecting a loss per share of about 10 cents over year. You take a look at the third quarter adjusted EPS, that was 28 cents. The estimate had been for 20 cents. So a beat there, and you can see that reflected in the shares, toggling around a bit, but clearly higher, up by more than about 5%. And this was a company that needed it because coming into today's close, this company only up about 3% year to date, but clearly some good news here, at least in after hours initial trading.
You wonder if some of this, the big bounce in the aftermarket, up 5.5%, is because about 5% of the float was shorted. So maybe a little bit of short covering potentially. Keep in mind that this is a stock, 25 and change that it's closed at in today's session, but it is down more than 70% from its February 2021 high. So a lot of ground to make up if that was the more accurate valuation, if you will, or metric.
Yeah, I'm going through the press release here, and the company's CEO, Scarlett, Bill Reddy, saying that the company's seeing its best market fit at this point in years for Pinterest.
I still don't get this company and what it does and why people go to it.
I'm glad you said it and not me. Weddings and renovations.
I'm with you too.
The amount of time that I spend thinking about Pinterest relative to the amount that I hear about Pinterest is pretty skewed. But apparently, if you look at their monthly active users, 482 million. That is an 8.3% increase year over year, and it beats estimates. So people are clearly using it.
We gotta work on our vision boards.
Apparently,
I think.
Yeah. Who would have thought the business model would be, I'm going to monetize mood boards?
Oh, did I say it wrong? Mood board.
No, mood boards, vision boards. Same thing.
It's whatever you want it to be.
I'm just going to mention real quickly, Tenet Healthcare also out, and that stock's up about 3% in the aftermarket following its quarterly update. So for more information, head to Bloomberg.com. And Pinterest, still up 6%. Scarlett, I'm with you. We'll try and figure out.
Yeah.
What
in fact, we'll get into it with Mandeep Singh next, right after the closing bell. That does it, right, for our cross-platform coverage?
Yeah, that's a wrap. We'll see you guys again tomorrow beyond the bell. Join us at 4 p.m. Wall Street time.
All right, and coming up, we've got more on Pinterest results, those 482 million monthly active users for this vision board, this mood board.